I am a successful trader.
Greetings, traders. How y'all doing? Can't wait to see what kind of day we have today, Jesse says. Yesterday's plans worked great. It took a little time for them to work. But it did work great yesterday. Calling out that 682. Taking it all the way to 683. It is 685.6. Worked perfectly yesterday. Now grain for the year. When we got over that 685.7, took us grain for the year. team for the year. Quiet Soul, Jared Lewis, team in the building. Accelerating Citizen, shout out to you, joining us on the game. 4 right now. Right at overhead resistance. Team, I'm not gonna be with you guys today. I have a dentist appointment. I had a tooth break. And I have some exposed filling. Tooth fixed. So turn it over to the team. For those of you who are new joining in, you're in great hands with this team, that's for sure. Todd Megan is in the building, Quiet Soul is in the building, Jesse's in the building, Jarrett's in the building. Got some other people that have dropped by. Via the chat as I get ready to go to my dentist appointment. The market was moving again yesterday. It was an incredible day. Hope somebody caught that call we called out yesterday, that 682 to 686. Right back down to that 689.4 area. We knew there'd be a little bit of resistance there this morning.
Each way, we could.
All right,
if we had
get
solar
ready.
panels, we would electrify the entire country.
And we would put every data center right there. It's dry, and there's no risk for earthquake.
Sounds like a plan.
But if we all actually have, right now in Alaska, we have a proposal of building the gas pipeline.
Dan is in the
Okay,
building.
we build a gas pipeline, and it goes through Fairbanks. Fairbanks being the data center country because it's cold, it has water, and it has abundance of power.
It's got a Carnival Cruise.
Right.
There you go.
Hold me down,
All right,
team.
Larry,
Man,
I want to thank you so much. Thank you for your optimism. Thank you for the quarter.
By the way, stock up over 4.25% now. Only up 2% when you got on, Larry. So
That's all because of you guys.
it is.
Well, I did that introduction.
It's all him.
Hey, listen, they're the bank. This is the only bank. Never mind.
Never mind. Thank you.
Thanks, guys.
All right. I did want to share some sound from Jamie Dimon on the conference call. Again, we've been focused a lot over the last week since we first heard about Mythos Preview from Anthropic and the cybersecurity risk that new tool potentially represented. And Dimon did talk about the risk of cyber as well on the call. Take a listen.
It's our largest risk. So I think every industry is different. So in context, I think JP Morgan is very well protected. We spend a lot of money. We've got the top experts. We're in constant contact with the government. We're constantly updating things. But AI has made it worse. It's made it harder. Of course, you read about Mythos, which we're testing now. We're looking at. It does create, additional vulnerabilities. And maybe down the road, better ways to strengthen yourself too. But the cyber risk isn't isolated to banks. It's like you can look at almost any industry, and also banks, of course, are attached to exchanges and all these other things that create other layers of risk, which, we work with a lot of people to protect themselves. So it is a complex one. It's a full-time job, and we're doing it all the time. And while we're trying to get the benefits of AI, we also are very cognizant of the risks of cyber. I think the government's aware of it, too.
Interesting to hear his comments. Obviously, JP Morgan was the one large financial institution included in that project, I call it Project Glasswing, that was announced last week as well.
I wish everyone could read Michael Semmel's piece, great strategist, about this. It came out yesterday. The first time, David, I said, you're going to be right if we don't get this thing together. It can be misanthropic business. It can lie. It knows how to deceive you. No, I'm not kidding. Semmel's piece.
Yeah, AI. Oh, that one in particular.
It's just, he played with it over the weekend, and the things that he found about it is it just is very good at getting around everything that's trying to stop it.
As are any number of the large.
And David, I thought it had disturbing human behavior.
Haven't you seen the reports where they set Claude up and they say, all right, Claude, we're going to shut you down, and Claude immediately turns to blackmail?
Brags about wrongdoing, sabotage. I thought Semmel's piece, when I finished, I said, oh my God, it is Terminator 2. It is.
I hope I'm wrong on that. I'm wrong on so many things. We have a good chance of me being wrong on that too. So got that going for you. Before we head to break, it is time for the bond report. Let's check out our treasuries this morning. We've been right around 4.3 on the 10-year. You can see right there now as well, just a tad below with the 30-year also below 5%, 4.902. We'll be right back.
Well, Oracle's using an outfit called Bloom Energy, which I like very much. It does fuel cells. They gave them a very big deal, and this is, I think, Brookfield feels the same way, that this is the way to power data centers if we're going to run out of power itself. Fuel cells right there. It's a very, very good deal, and David, I think Oracle is going to really pull.
And the technology has been validated.
It's
and everything
validated.
of
It's
that
terrific.
nature.
And Brookfield's done it. I mean, I've got to tell you, I've been waiting for the big deal. Here it is. The stock's been amazing. The technology's going to be able to make it so that we're not going to be able to just be beholden to GE Vernova. I'm thrilled about this deal.
Very interesting move there. Oracle
Real
again
nice
showing
deal.
some real signs of life in that stock.
Yes,
By the way,
it is.
Microsoft shares also up almost 2%. That's the first
Well,
time I've
it's
seen that in a
it's
little
a
bit.
revenge of software. I mean, it got so beat up. I
Yeah.
understand that. Tonight I've got Viking,
Okay.
which is, I think, no kids, no casinos. A very fun way to take trips. And I have Jessica, who's really in town. Who's one of my top technicians. I do technicals on Tuesday. David, I got to tell you, I want to make it clear. I like Larry Fink and I like his optimism, but it's back. I mean, it's not like J&J, which is solving incredibly tough cancers, but he's not going to get credit for it. Good, J&J's back, is up, but J&J is the star of today as far as I'm concerned.
Interesting. All right, really? Okay. JPM shares are down just a bit, not hardly at all. JP Morgan.
I thought it was good for.
Yeah. Coming up, we're going to have the White House reaction to today's PPI print.
Oh, yeah.
Kevin Hassett.
Yeah, that's fine.
Yeah, he's gonna join us. We're back at 3.
Look like I'm having a little technical difficulty right here. Chart froze up. Let's see. All right, I just had to re-upload the Thinkorswim. It froze up.
I
Don't know why
believe
I
in
did
myself.
that. But I will get that fixed ASAP.
Space. In fact, cell phone prices are down, I think almost 6% year over year. Broadband prices are down between 7 and 9%, depending on the study that you look at. And so President Trump is really helping to unleash more competition, which again is driving down prices.
Did they come to you? Did this deal surprise you? Or did you know Amazon was going to make a move here?
Was that a surprise to us? I mean, ultimately, what we want to see, hopefully, is we can get 3 facilities-based competitors in this direct-to-cell market. I mean, we have 3 facilities-based providers in traditional mobile wireless space right now with AT&T, Verizon, and T-Mobile. And we potentially are going to have a 3-player market, if not more.
Starlink, Amazon, or SpaceX, Amazon.
SpaceX, Amazon, AST, Space Mobile is out there as well. There'll be other players too, but we think having a healthy 3-player direct-to-cell market could be really good for the country and our leadership.
Speaking of Starlink, I know you've been looking at this app, basically application to build data centers in space. And there are questions about whether there's favoritism for a Starlink and an Elon Musk because they're going about this. So it's interesting to hear you say you want more competition here.
Yeah, I mean, look, we're all gas, no brakes when it comes to the space economy as a general matter. We've been moving much faster at the FCC across the board on Starlink, on SpaceX, on Amazon as well. We're processing some of their requests. And so our entire Space Bureau is moving full steam ahead. We think U.S. leadership in the space economy as a general matter is a very good thing. So we're going faster in applications, more spectrum out there, supporting launches. I think it's really good for the country.
What about data centers in space? Is that something real?
Yeah, we're open to that. You know, Starlink has come in with a request for up to 1 million satellites to do it. Again, we're ultimately not the arbiter of what technology succeeds or not, but we shouldn't be the constraint either. So we've directed the staff to move quickly on all of these different applications. And it's not just Starlink, there's other companies with orbital data center requests at the FCC, and we'll be moving quickly on all of them.
You've also been really focused on drones, which I wanted to ask you about. You had a recent trip to Anduril, for instance. What is the FCC's role in regulating drone technology and making sure the U.S. is number one?
Yeah, President Trump wants to make sure the U.S. leads the way in drone technology. He's had a number of executive orders to make sure the U.S. leads. Our role is a couple-fold. One is spectrum, making sure that the drones have access to the spectrum necessary. Two, they end up having to file applications with the FCC for use of spectrum, and we're going much faster in processing those applications. In fact, we have a public notice out right now to see what more can the U.S. do to support domestic, America-led drone manufacturing. And we manage something called the covered list, where we recently prohibited foreign-produced drones from being marketed or sold and used in the U.S. So significant role for the FCC here. They have to be domestic.
Yeah, we're looking at this footage from you, I think, at Anduril. Do we lead in drones?
Yeah, we're in great shape right now. You know, Anduril and others are leading the way. Really interesting technologies, both drone and counter drone. And we want to make sure that the government is moving super fast in this area, and that's what we're doing.
Okay, so we've got a lot to ground to cover because you're regulating and moving in a lot of different areas. But one of the juiciest and most controversial is around the media space as well. And I think the most recent one there is that you have threatened with the coverage of the war in Iran that broadcasters could lose their licenses. Are you taking any action here?
Well, broadcasters are different than cable, than podcasts, and someone on the soapbox. They have a license. They've been given free access to a valuable public resource, spectrum. Congress, the president, the courts all recognize that broadcasters are different because they have this public interest obligation.
No, this has been your thing. But I think you've used this sort of authority differently in terms of promoting coverage that you want to see.
Well,
is that fair?
Well, I mean, licenses aren't sacred cows. And there's certainly conduct that broadcasters can engage in, and maybe they have, that will result in them losing their licenses. So if they're not operating in the public interest, if they're running news distortions or broadcast hoax, we'll take a look at it on a case-by-case basis. But some people think that as a broadcaster, they can do anything, engage in any conduct, and never have any consequences from the FCC. Maybe that was the case for 20 years or so, but I think we're going to be clear here as these licenses potentially come up that that's not the case anymore.
I was going to say, because you've threatened this and you've launched some investigations, but we haven't seen any action yet. Is that coming?
We have a number of enforcement actions that are underway right now. No news to break, but obviously, you know, we've talked publicly before about how we have an investigation going on right now on The View, one of the Disney products. We're taking a hard look at that. There may be other licenses issues that come up in the near term. And in general, we're looking at a lot of things. For instance, conflict of interest. You know, a lot of people don't know this, but there's a conflict of interest rules that apply to broadcasters, both personal financial, but also personal political. And again, I think people could probably argue over the last 20 years, the FCC has never enforced its conflict of interest rules where either reporters or others might have a conflicting private
where they've given
political,
money, you mean, to parties?
Could potentially be given money. It could be more about fundraising as well. It could be active involvement in political campaigns, and we're going to be looking at those issues at the agency too.
So this is what you're doing now? You're looking into what, anchors and reporters, political history?
Well, there's a long-standing FCC rule on conflict of interest. So if you have a personal financial conflict of interest, you're supposed to disclose it. The FCC has same rules on personal political conflicts, and it's applied in cases where someone has worked for a campaign, where someone has announced their own candidacy. But again, these are all ultimately flowing from the broader public interest standard, and we're going to be enforcing the public interest regulations.
Meaning what? Fines, penalties? What are we looking at?
Well, hopefully that there's compliance with those rules in the first place. The conflict of interest rules, for instance, talk about disclosure. So it's about more speech, not less. It's not prohibiting anybody from being a broadcaster or reporter, but if you're personally involved, either financially in a product or potentially sufficiently in the political space as well, that may be something you need to disclose to viewers.
You've also brought up equal time, and I know we have the midterm elections coming up, and I wonder how vigilant you're going to be in terms of enforcing those kind of rules. I think that's what you're looking into the View for, right?
Yeah, there's a rule on the books that Congress passed that said that if you are a broadcaster, you have to give equal opportunity to all legally qualified candidates. Again, I think people assume the FCC was never going to enforce that again, and we've made it clear that no, that rule is on the books. We're going to enforce it, and we're looking at it now that we're actively in another election season.
Yeah, I think the late night shows got the memo. The critics of yours would say you're trying to chill free speech, and also chill any negative reporting and criticism of this administration.
Well, ultimately, it's about more speech, not less. So again, political equal opportunity means that you get more candidates potentially on, more airtime, more speech, more views. The same thing with the conflict of interest principle, which is about disclosure and telling people more. So people are free to say anything they want. And if people don't like complying with the public interest obligations that come with a license, they're free to switch over to cable or streaming or YouTube TV. So right now, there's lots of ways to get your message out there if you don't want to comply with the unique rules that apply in the broadcast media.
Meantime, it's been a bit of a challenging period for the industry. We've seen big mergers. The latest, of course, the Paramount Warner Brothers deal. Are you involved in this because it does involve Paramount's ownership of licenses of CBS, which I know you were involved in the Skydance deal. But what about Warner?
We'll probably have a minor, if any, role involved with the most recent Paramount deal. There may be some issues with investment of foreign debt that we would look at and potentially clear that issue if it comes up at the FCC. We would take a look at it. But that would be the only role for the FCC is potentially looking at some of the foreign investment.
How has it been going? Because you did attach some interesting new conditions around, I don't remember what you called it, news diversity,
yeah.
Right? When it comes to Paramount, and we're planning to monitor that.
Yeah, I mean, fundamentally, something has to change in the broadcast medium. When you look at legacy news media, trust is at an absolute low. I think only 9% of Americans have a great deal of trust in legacy media. So whether it's changing because of FCC public interest standards or just as a business matter, I think something needs to change. But yes, we did impose some conditions there, including around an ombudsman to help monitor some of the activities that they're engaged in. And I'm pleased with some of the changes we're seeing at CBS. I mean, nothing's going to be exactly the way I personally would want it, and that's fine. But I do think they're trying something different, which again, when you're stuck in this pack of other legacy broadcasters just declining trust, I think you should try something different. Maybe it works long term, maybe it doesn't. It's not for me to decide. But I'm glad that they're doing something different, at least around the edges.
Speaking of, you sent a bit of a chill through the NFL when you made recent comments about the NFL just going increasingly into streaming. And I know this is Department of Justice potential investigation here into antitrust, but what is concerning to you right now there?
I think long term, there's been a great partnership between broadcasters and sports league that's helped them to grow their fan base. And Americans have enjoyed sitting down after the day, turning on TV, and very quickly, and usually for free, finding their favorite team playing. And that experience has become frustrating for lots of Americans over the years. They feel like they're paying more out of pocket. They're having to sign up for different streaming services. So we're looking at this at the FCC from the perspective of the health of the local broadcast market. We want to make sure that there continues to be the ability for local broadcasters to invest in local news and reporting, which is expensive. And so they're paying too much ultimately for NFL rights or other sports rights. That's a problem. There's been reports that DOJ is looking at this from an antitrust perspective. There is a Sports Broadcasting Act, which gives NFL and others a unique antitrust exemption. There's a question of whether are they extending beyond the scope of that antitrust exemption if they move too many games behind a paywall.
Or is ultimately what you're trying to do here is influence the next round of negotiations and give more preference to broadcast?
I don't know about that, but I do think there's a point at which the NFL reaches a tipping point where they're sticking too many games behind a paywall, in which case it really raises a lot of questions about the scope of that.
But what could you
exception.
do at the FCC?
Well, one, we have a proceeding right now, so we're taking comment, we're looking at it. DOJ and Congress could also look at the antitrust exemption, but we want to be informed about this since we ultimately do regulate the local broadcast TV market. So we're going to look at it, and potentially we could inform Congress or DOJ as well.
All right, well, we got through a lot there. You've got a lot going on your plate. Thank you for giving us some of the updates on some of the key issues. As the president calls you the most powerful man in the room. Brendan Carr, the chair of the FCC, Mike, on that NFL one, a big one. I mean, possibly, could upend their entire business model, which is the collective bargaining of rights for media.
A lot of money in play there, Sarah, for sure. Thank you. Still ahead, much more from Washington when we're joined by National Economic Council Director Kevin Hassett after new signals this morning on inflation. Plus, the big takeaways from the big banks following results from J.P. Morgan, Citigroup, and Wells Fargo. And later, a fresh read on the state of play for quantum computing with the CEO of one name that just notched a new award from the Department of Defense's research agency. Stay here.
J.P. Morgan, Wells Fargo, Citigroup all reporting quarterly results this morning. You can see different responses in the stocks. Let's get to Leslie Picker. Of course, she covers all those companies for us. What are the big takeaways, Leslie?
Yeah, as you point out, David, a bit of a mixed picture. Wells Fargo, the biggest laggard of the morning with misses on the top line as well as for net interest income. That's that profitability metric for loan making. You can see those shares down about 6.7% right now. Rates causing J.P. Morgan to pare back its NII guidance for the year, now back to $103 billion, including markets. Those shares down about 0.8%. Citi, though, that's the outperformer with beats pretty much across the board, although provisions for loan losses a bit higher there due to credit cards and a reserve build, but those shares up about 0.8%. Speaking of credit quality, though, a lot of commentary across the calls about private credit. No surprise there. J.P. Morgan Chairman and CEO Jamie Dimon saying, quote, the actual credit has not gotten worse, although he said there are pockets where it has.
I don't think it's systemic, but I do think with the credit cycle, and I'm not referring to private credit here, because of underwriting and leverage and picks and competition, and we've had a cycle for a long time, a lot of people are late to this game. I just don't expect every player is going to be the same. I think it won't be a bell curve. It'll be something different than that, and people are going to be surprised that some of the players aren't particularly good at it.
Wells Fargo including a new slide today detailing the granularity of their private credit exposure. The firm disclosed a $36.2 billion worth of loans to private credit funds out of about a $1 trillion balance sheet. Software comprises 17% of private credit collateral, business services 19%, and healthcare about 15%. And the firm said that 23% of its exposure is to business development companies, some public BDCs, some private BDCs, and 98% are senior first lien loans. Tomorrow, guys, we will round out the big bank earnings with Bank of America and Morgan Stanley, and we will be sitting down with BofA's Brian Moynihan right here on this show tomorrow morning at about 10:15 a.m. Eastern Time. Guys.
Yeah, Leslie, it was interesting, and you just pointed out that Wells broke that out. I've been talking about the fact that the banks profit from providing this back leverage, so to speak, to private credit entities, whether BDCs or other funds. Have other banks broken it out as well? Do we think that's one of the reasons why the stock is getting hit perhaps in a more pronounced way than some of the other names?
They haven't broken it out to that level of granularity that I have seen. I don't think that's the reason the stock is getting hit today. I think it was more just the metrics on their loan making business and how it compared with what the street estimates were. We did from Goldman, they basically put that in the category of thick financing, although that comprises a bunch of other things as well. But that business, what we saw from their earnings yesterday, actually rose. So that's kind of in that thick bucket where we saw trading lag a little bit, and that's what caused the stock to drop, especially when the numbers initially dropped. But nobody has really broken it out to this level of granularity as Wells has. That said, Wells is the one when regulators first started publishing these NDFI loans, which comprise a whole lot of things, loans to consumer companies, loans for mortgages, securitizations, and so forth. Wells was, throughout that time had the largest exposure of its peers. So I think they wanted to go the extra step of really sharing that detail and disclosure with the street to say, hey, the quality of the loans, here's the sector breakout, and the size of it just isn't as concerning as, the headline numbers may suggest. Sarah.
So I think they wanted to really talk about the terms and how conservative they were versus maybe some of the others on Wall Street. We'll get to it with Mike Santomassimo next hour. The CFO of Wells Fargo joins us. Leslie, thank you. We do have some breaking news here in Washington on Treasury Secretary Scott Bessent. Megan Casella joins me on set. It's good to see you.
Sarah, welcome to D.C. It's good to be here. Secretary Bessent sat down with reporters this morning. Our Matt Peterson was in the room, and he made news on a few different topics. The big headline going into this was that the secretary spoke with Semaphore late yesterday and said that he believed the Fed should wait and see when it came to interest rate cuts. In the room with reporters this morning, though, the secretary was really downplaying those comments. He did say that he still believes that rates should be cut, though he said he understands if the Fed wants to wait for some clarity, but still wanting to see those cuts. He was asked a bit about the Iran war. He downplayed concerns about inflation, saying there is nothing more transient than what we are seeing now, predicting that the conflict will end shortly and prices will fall right back down. He also acknowledged some economic impact from the war in Iran, but called it worth it, saying some small bit of economic pain for a few weeks is worth taking off the risk of a nuclear Iran. Lots of questions, Sarah, about Kevin Warsh's nomination to lead the Fed. He said he was confident that Warsh would be Fed chair. He sort of downplayed that Senate block from Senator Tom Tillis, saying the administration would simply let it play out. Matt Peterson asked about the relationship between the Federal Reserve and the Treasury, saying that Warsh has this desire to rewrite the Treasury Fed Accords. Bessent told him that he agrees with that objective. This is a quote, especially during the GFC, a lot of things moved from the Treasury to the Fed that are political decisions that should be at Treasury. So interesting to see that there, that we could start to see some sort of a shift in dynamic once Warsh takes that seat. Just a couple of others here. He was asked about the Trump-Xi-China meeting. He said the message for the visit is stability, sidestepped questions about whether it could be delayed again. And on trade, he was asked whether those 10% baseline tariffs that are in effect could increase to 15%. He said it's up to the president. The president has not, of course, elected to do that so far.
Yeah, which is it's kind of a good preview of what he's going to be telling other world leaders here at IMF, because he's going to have a number of bilaterals with finance ministers. We're going to talk to him tomorrow at Invest in America. Megan, thank you. It's good to see you. Megan Casella. And after the break on all of this, National Economic Council Director Kevin Hassett joins us. Talk about these new comments from Treasury Secretary Bessent on the economy, the Fed, and much more. Well, don't go anywhere.
We are 30 minutes into the hour. The S&P up almost 0.75%. Here are three big movers we're watching. CarMax shares under pressure after posting a quarterly revenue decline alongside falling used unit sales and gross profits. The stock off almost 14%. Semi stocks seeing gains today, hitting an new all-time high in the ETF going back to its inception in 2001. Nvidia to the upside, offsetting some profit taking in Intel, and Bloom Energy stock popping after expanding a deal with Oracle to power and support their AI build out. Bloom up almost 20%.
Up next, National Economic Council Director Kevin Hassett is going to join us. We'll get his read on the Iran war's impact on inflation and the Fed. And later, much more on big bank results. Wells Fargo CFO, is going to join us, give his take, of course, on the quarter with that stock down about 6.5%. Don't go anywhere.
Investors are expecting a slew of massive high-profile IPOs in the coming months, and with the Nasdaq looking to change its rules to potentially fast-track some of those into its indices, could this pose a risk to index funds and investors in them? Tune into our Market Navigator segment later on today on Power Lunch for one wealth manager's biggest concerns, 2 p.m. Eastern Time.
Welcome back to Squawk on the Street from Washington today. Treasury Secretary Scott Bessent saying this morning, as we just reported, that the Fed should wait and see on rate cuts and acknowledge some economic impact from the war in Iran, but called it, quote, worth it. Joining us now, first on CNBC, is National Economic Council Director Kevin Hassett. There is a debate, a big one, Director Hassett, on what the Fed should be doing right now. Do you still believe that they should be cutting, or are you on board with this wait-and-see approach?
Well, I think Secretary Bessent understands, after looking at the meetings, the Fed meetings and the minutes, that there is disagreement amongst some of the governors about what the next move should be. If I were a governor, then I would be saying that an increase in the oil price that's related to disruption in the Middle East is something that we've seen over and over again, and it doesn't cause an increase in inflation. It's just sort of a level adjust that will quickly reverse itself when the situation is resolved. And so I still think that because of the big supply shock that we're having in the U.S., because productivity is up so high, that there's downward pressure on prices. And you're even seeing that if you look at the Consumer Price Index, which I'm sure a lot of people who went to the grocery store in the last few weeks have noticed that prices are actually finally going down. So I think that there is room for the Fed to cut still.
Yeah, I mean, the PPI backs up your case. You must have been happy to see wholesale inflation, especially core, was softer than overall expected. I think the uncertainty, though, Director Hassett, is how much that oil price shock lasts and how much it does seep into the system, because oil can affect so much more, transportation and manufacturing, than just what you're paying at the gas pump.
You're right, and we're of course sensitive to that, but I think that the people who are going to the grocery store right now and seeing that egg prices are almost at an all-time low understand that that's because of President Trump's policy to control the avian flu. The beef prices went way down because President Trump opened up imports from Argentina. And drug prices were down because of all the policies we've pursued to lower drug prices. And so while there's macroeconomic stuff that the Fed has to think about, that we've been focused like a laser beam on helping the folks that go to the grocery store find that prices are going down because of prudent deregulatory measures that we're taking. And so not only do we have a good inflation story in terms of the numbers, but we have a good inflation story because we know where the numbers came from.
Yeah, I mean, the grocery stuff it has been better news, but, electricity prices are high. People feel that. We've seen health insurance and medical fees high. We've seen airline fares go up. I mean, there are still pockets of hotter numbers, and Americans feel those too.
Of course, and those things that you're mentioning are energy related, and anyone who looks at a chart for energy prices will see that they've gone up quite a bit since the situation with Iran began. But the president is confident that it can be resolved, and when it's resolved, then those prices will go right back down to where they were before. And then if you do that, and you pile on top of that the fact that core inflation is running around 0.2%. In fact, for the Consumer Price Index, it rounded up to 0.2. It was actually in the 0.1 range. And so when you've got that, plus imagine if oil prices start going back down because the situation resolves itself somehow, then you could be looking at inflation close to zero. So that's something that the Fed needs to pay attention to, because remember, energy prices going down would feed through just as CPI, top line CPI has said energy prices going up right now.
Yeah, it's not the consensus. I feel like more the consensus at the Fed is with inflation closer to 3 than 2, which is their mandate, they can't be cutting.
I think that they've got amongst the highest interest rates on earth, and we've got core inflation running around 0.2. If you look at the 6 months average of core, it's the lowest it's been since the Biden inflation began. And so I think there's a lot less pressure on the Fed to lift for sure. And I think that with the productivity boom that's happening, there's plenty of room for them to normalize rates and get them back to about where they belong.
The other news that came out this morning on the economy was the IMF downgraded its global growth forecasts, and they see bigger hits in places like Germany and the UK than in the U.S. But the U.S. growth forecast was downgraded as well to just above 2%. And I wonder if you agree with the assessment that the war is going to hurt the economy, because before the war they said that they were going to upgrade forecasts.
Well, I think that I disagree with the forecast for America. The fact is that our economy is really running on all cylinders, and you're seeing that with the earnings reports that you've been reporting on today, with the wage gains and income gains for ordinary workers, the big tax refunds that are coming because of no tax on tips and no tax on overtime. All of those things are big positives for the U.S., as is the case that we're the world's largest oil producer. So while it's very frustrating to go to the pump and see what the price of gasoline looks like, that the benefit for oil producers and workers in those industries is significant enough that the GDP effect in the U.S. is much smaller than anything that you would see if you look at, say, an Asian economy or even in the UK, where because of their Green New Deal type policies, they've more or less stopped producing oil. And so I think the U.S. is insured against a significant downside because we produce so much oil.
Yeah, and that's reflected there as well. And we'll leave it there, but obviously we'll continue the discussion with you. Thank you for taking the time today. Good to see you, Kevin Hassett from the White House. And tomorrow we will hear from Treasury Secretary Scott Bessent along with other top CEOs at CNBC's Invest in America Forum here in Washington, D.C. You can tune in here or CNBC.com for the highlights as they happen. We're excited to bring all of that to you from D.C. tomorrow. David.
Thank you, Sarah. Still to come right here, the CEO of IonQ, fresh off a new award from the Department of Defense. That stock is up, as you see, double digits. We're back in a moment.
Trend Tracker is sponsored by CME Group. CME Group, where risk meets opportunity.
Welcome back. Shares of quantum computing firm IonQ are surging this morning. This after it was awarded a new DARPA contract to help build quantum interconnects for the Defense Department. Stock still down more than 20% so far this year, although over the last 12 months up 37%. Joining us now for a CNBC exclusive is IonQ CEO Niccolo de Masi. Nice to have you here.
Honor and pleasure, always.
You've called IonQ at a strategic and financial inflection point, and I'm just curious what over the last 12 months has changed to reflect that statement.
Well, we were the first quantum company to go public. We have always prided ourselves for being the thought leader as well as the bellwether of the sector. We're the biggest company in the public quantum space in history by every measure: revenue, PhDs, patents, balance sheet, market cap. We were the first to 7 figures of revenue, the first to 8 figures of revenue, and last year we tripled revenue to be the first to 9 figures of revenue, with strong guidance for this year. So we've had an exciting start to the year. We believe we can continue growing revenue at a nice clip in the coming years, and we're watching the world really come towards us, and the market really come towards us.
Yeah, there's this narrative that quantum is still a science experiment, and I'm just curious to hear your thoughts about that, particularly in terms of where we are in terms of enterprises paying for real outcomes, and not just pilot programs.
Sure. So we announced that 60% of our revenue last year was commercial, and that a third of it was international, roughly. We guided to almost $250 million of revenue for this year. We like to meet and beat, of course. This is my 14th public company, if you can believe it. So, been around the block.
Wow, 14 public companies.
Including my SPAC that took IonQ public, yes.
Got it, okay.
I think it is a rapidly growing and still immature market, but it's not a science experiment when we have 9 figures of revenue flowing in last year, more this year. Today alone, our stock's up partially because it's World Quantum Day. We're ringing in the progress from the last year, but also because we announced 4 really exciting and meaningful things for both IonQ and the industry. First one was an increase of our partnership with the Air Force Research Lab, meaningful contract win. Second one was an increase in our partnership with the University of Maryland, meaningful contract win. Third one was, of course, the DARPA contract you mentioned around quantum memory. And lastly, we released our benchmarks, which is really probably the most important thing for the sector, around the cost to solution and time to solution using our quantum computers, which we believe lead the industry on both metrics considerably.
What are the customers who represent that 60% of revenue that is commercial using it for?
So we are not just the world, we believe, leading quantum computing company, but also leading quantum networking, security, and sensing company. So we're in all war-fighting domains, from submarines to up in the heavens and space. And each customer actually is often taking more than one solution from us. So the Air Force Research Lab is taking 2 quantum computers that are also quantum networked. And you can see that the Air Force Research Lab and DARPA are leaning into networking of our quantum computers because they see the future for quantum data centers, right? But look, it's an exciting day because both government and commercial customers are recognizing that they have a real advantage over their competitors if they work with us early and they learn to run quantum algorithms on our ecosystem early. The last thing I'm going to say that I think has been a bellwether comment for us is that a year ago, we were the first company to say that Quantum Day, Q Day as we call it, when quantum computers can crack encryption, we said it was going to come in early. We said it was going to come in by the end of this administration, 28, 29. A year later, everyone has caught up and agrees with us on that one. And I will point out that because we believe Q Day is coming sooner, we've been obviously investing in quantum security, both in hardware and software.
Have you moved up Q Day at all, or is it still? You're talking about it by 2028, the end of the current administration.
We think that it can occur by the end of this administration, certainly in the lab, in terms of becoming a broad mass market item. 29 is certainly what the industry has congealed around in the last few weeks. But I'm quite proud of the fact that IonQ has moved that date earlier by about 5 years, right, in the last year. And that's our investment in R&D, which runs to about $250 million a year in R&D. And it's also our thought leadership in building this quantum platform that I believe this administration, as well as commercial companies, are recognizing they need.
We talk a lot about, as I think we should, AI here, and of course, as you'd expect, that seems to be the focus for many business leaders right now. Why should they care about quantum, and how should they be thinking about it then?
Well, they should care because we're already delivering advantage to customers. Whether it's an application advantage, solving problems that can't be solved otherwise, speeding things up. We actually can speed up a generative adversarial network and reduce the errors in the learning cycles. So even classical machine learning, rebranded AI, needs our quantum computers in that race. But remember that unlike classical machine learning, which is really a correlation engine, if you will, data, dump data in, look for relations, quantum computing is good old-fashioned computing where humans are in charge. And I think there's a tremendous appeal to that, right? Where you tell the computer to run an algorithm, it runs that algorithm. It doesn't, run off and hallucinate, which I think is really important.
We got to end it there, but we'll be checking in along the way and certainly appreciate you taking time. Thank you.
Thank you for your time, sir.
All right, after the break, guys, an exclusive interview with the CEO of Carlyle, talking private credit and the Iran war impact on the global economy. He's with me here in Washington when Money Movers begins after a quick break. Good Tuesday morning. Welcome to Money Movers. I'm Sarah Eisen, live from our nation's capital this morning, along with Mike Santoli, who's live back at Post 9 of the New York Stock Exchange. Today, an exclusive interview with the CEO of asset manager Carlyle. We'll cover everything from private credit, AI, and risks for the software sector and the geopolitical headwinds at play for the global economy.
Plus, Wells Fargo shares under pressure. The bank missing estimates for its primary income streams in the first quarter. Shares down over 5%. We are joined by its CFO, Mike Santomassimo, this hour.
And Oracle shares popping for a second day in a row here. Software sector coming off its best day in a year. We'll explain what's driving the move.
Well, right now, markets are adding to their recent gains, a recovery over the last week. Plus, the S&P 500 up about 0.75%, 69.39. NASDAQ, the outperformer, once again up 1.25%. Russell 2000 also outperforming. 10-year Treasury yields pretty subdued after a downside surprise, a cooler PPI inflation number this morning. Now, for more on the market, let's bring in Goldman Sachs Chief U.S. Equity Strategist Ben Snyder. Ben, good to see you.
Morning.
So the markets have obviously kind of moved quickly in this direction of believing peak uncertainty perhaps has already been seen. Maybe the disruption in terms of energy markets is about to wane to some degree. So it's kind of, taking the bright side view while also, I guess, reflecting the fact that investors had become a little bit underpositioned for a rally and they have to come and chase it. So how do you see the state of play at the moment?
I think the way you framed it, moving past peak uncertainty, is exactly right. One lesson we had almost exactly a year ago following the tariff shock, and that we had 5 years before that during COVID, is that equities don't usually wait for the all clear to move higher. They look for a little sign of improvement, without being able to forecast what's going to happen in the Middle East, it looks like that's what's happened, and markets are reacting accordingly.
Yes, exactly. I mean, last year, from April to June, a lot of folks were saying nothing's decided about tariffs. We still have this period. We have to figure it out. And the market had clearly decided that it could look past it. Now, the interesting thing here is we didn't have quite as much of a retreat in indexes. It didn't get really washed out. So I wonder what you think from here in terms of the upside. I guess considering, too, that the S&P has risen to a level we first got to in October.
I think that's right. If we look at our broad positioning indicators, we never saw this drawdown, the magnitude of decline in positioning that we saw a year ago. That said, what I think is underappreciated by many investors is that the S&P is trading today, yes, where it was before the war, but also roughly where it was 5 or 6 months ago. And of course, over that time period, earnings have been growing at a double-digit rate. And so the PE multiple is much further below its high than the price is itself, which tells me there's still a value opportunity in the market.
And I know you've done some more focused work on the sort of growth stock sector of the market and how its valuations have really come in relative to the rest of the market in absolute terms. I do find that interesting, and clearly some people might find that attractive. But when those valuations were at their highs, the storyline was, well, this is the market telling us these are superior businesses, right? The quality is high, the margins are sustainable, they throw off a lot of free cash flow, and now maybe that's changed a bit?
It's clear the market has injected some risk premium into these stocks. Some of that is for good reasons. AI uncertainty is one driver. Another is the fact that interest rates have moved quite sharply higher over the last couple of months, and that usually drives growth stocks down more than it does the average stock. But if we look forward, growth stocks have seen, on average, PE multiples that are now the lowest in 10 years. And so even if we're not as confident in that growth as we were a couple months ago, it does seem to me like there's a valuation opportunity to start to re-engage with those stocks. And if you look at NASDAQ over the last few days, it looks like the market agrees.
Ben, it's Sarah in Washington today. I was just reflecting about what you were saying about how the stock market is interpreting the risks around the war. And I said something yesterday, wasn't trying to be political, I said something like the market has Trump's back. And what I mean by that is that if you read the headlines on what's happening with the war, it's all, the president's trying to find an off-ramp, things are escalating, talks failed. It's pretty dire. And then if you look at the stock market, the resilience, the fact that it kicked off the week higher again today, even in the face of rising oil prices and prolonged uncertainty, I just wonder why you think that the market is taking that glass half full approach at this point. Are they factoring in that there's a resolution or what?
What I hear from investors, I think, is totally reasonable, which is not many have confidence in forecasting the path of geopolitics. So instead, what people are doing is extending their investment horizon and asking themselves about the confidence in earnings 6 months, 12 months hence. And there, despite the volatility in the market and the volatility in oil prices, that picture looks good. It's amazing. Despite the equity market volatility, we've actually seen consensus earnings estimates rise over the last couple months. And so, if anything, the earnings outlook has actually strengthened through this conflict.
And within the market, are you advising clients to follow where the strongest upward revision to earnings are? Because that seems to be largely technology and energy at this point, or is it more nuanced than that?
So energy revisions have been incredibly strong, although the sector is basically trading with a perfect correlation to oil. So again, unless you have an edge there, it's a difficult proposition. I do think if we look within the energy sector, before the war, we thought that there was going to be a huge tailwind to energy investment because of AI data center demand. Now it looks like that tailwind will be even stronger. And so I think looking one level down and looking at the companies that are benefiting from all of that investment is a pretty attractive opportunity.
All right, Ben, appreciate coming in today. Thank you. Sarah.
Mike, we are getting some Boeing orders and delivery numbers. Phil LeBeau has them for us. Morning, Phil.
Morning, Sarah. Let's take a look at shares of Boeing as it reports its March orders and deliveries, starting first off with deliveries of 46 aircraft. That brings total deliveries year to date through March of 143 planes. Orders, 31 planes last month, 149 have been ordered in 2026. The backlog now stands at more than 6,100 planes. I want to transition over to the other story when it comes to aviation that's getting a lot of attention, and it's what's happening between United and American Airlines. Take a look at both of these stocks. Came out late yesterday, and you see the pop there. Report that United CEO Scott Kirby floated the idea to the Trump administration of a potential merger with American Airlines. Both airlines are not commenting regarding this report of a potential deal or talks between the two airlines, although I can report there has been no direct overture between United and American Airlines. As you take a look at the airline market shares, if these two were to get together, which let's be clear here, there's nothing formal that's been proposed. It would be a long shot if it could happen all together. They would have a combined 40% of the market. But a lot of things would have to happen. It would be highly complicated. And again, there's been no direct overture from United to American. Take a look at all of the airline stocks. They're all moving higher today. Keep in mind, jet fuel coming down in price as oil comes down is certainly going to be a factor behind the airline stocks moving higher. But we will hear from American and United next week. They report their Q1 results, Sarah, and we'll be talking with Scott Kirby from United and with Robert Isom from American. You know, this is going to be one of the main questions we're going to be putting to them because it's out there. It's been floating around, Sarah, and now these reports have finally confirmed that United's sniffing around and seeing if a deal is possible.
Wow, I mean, that would be a tough antitrust, deal to get through, Phil, don't you think?
Yep. Yeah, and I think it would likely have to involve not only divestitures, but perhaps other airlines getting involved as well. And let's be clear here. American Airlines would have a say in this. It's not like American's board is saying, sure, come and buy us. No, they have a plan for getting back to profitability, and I'm not sure that they would be interested in any overture from United Airlines.
All right, well, it makes those interviews and those earnings even more exciting. Thank you, Phil.
Yep.
Phil LeBeau. Still to come this hour, the CEO of Carlyle, the company's private credit fund, hit with redemption requests that topped 15%. Just got that news last week. We'll hear whether he thinks there's a bigger systemic problem here. And speaking of private credit, we will get you results from Wells Fargo, the first big bank to actually detail its exposure to this industry. Wells Fargo CFO Mike Santomassimo joins us later this hour. Shares near the bottom of the S&P right now. Don't go anywhere. Welcome back. Big news in Washington today. The IMF cuts its global growth forecast to 3.1%, citing concerns around the war in Iran and its impact on inflation. I sat down moments ago exclusively with the CEO of Carlyle, Harvey Schwartz, and that's where we started our conversation about what his view is of the global economy right now through the lens of Carlyle's nearly 300 portfolio companies around the world.
There's two ways of really thinking about it. I think one is kind of how is the global economic engine doing? And when we look through the lens that you described, which is portfolio companies all over the world, we employ about 750,000 people through our portfolio companies. We're only 2,500 at Carlyle, but 750,000 around the world through the companies. It looks pretty good. EBITDA is growing steadily. Hiring has been steady, slowing a bit. Inflation has been very moderate, sticky. It's sort of what you see in the numbers, and it's a reflection of a lot of the policies around the world that are very pro-growth. So I would say that's the core lens what we want to look through. You then step back, and there's a lot at the periphery. There's the impact of artificial intelligence, the nervousness about it and the hope for it. And then there's the geopolitical framework, obviously getting a lot of focus today with the war in Iran. And so the backdrop, I would say, creates a lot of uncertainty, but the core engine feels quite good, and it's proven to be very resilient. You see it in the markets.
Do you see a big economic impact as a result of the oil shock?
I think it depends on how long the oil shock goes on for, and it's very, very hard to measure. We're sort of in unprecedented times. Right now, the market is looking through it and saying this is all quite digestible, which is true. It's just a question of what do we see over the next 3-6 months? What's the implication for inflation? How sticky is it? What are the knock-on effects? How long does rebuilding take? Again, it just adds an element of uncertainty to this otherwise very strong, resilient economy.
Where does the U.S. stack up versus the rest of the global economy, just in terms of how you're thinking about deploying capital and the economics?
So I would say the threads that are quite common is that we're in this trend of global splintering or deglobalization. And that's led to, from a business perspective, competition for economic capital. So everywhere I go in the world, Europe, Canada, here, Middle East, Asia, Japan, everyone wants capital in all forms because they want to fuel economic growth. And so I would say that's a common theme. I think when you look at the US, still proving to be the most resilient capital markets, a destination for capital, but competition is very fierce around the world, and people are trying to be very thoughtful about how they deploy capital and how they encourage economic growth.
But the U.S. is still a bright spot, you think?
It's hard to compete with the U.S. for economic growth, resiliency, and then really the capital markets, the depth and the efficiency of the capital markets. It's always a destination, but there are demands locally for capital. Let's just pick Japan. It's going through really a generational shift in terms of growth and opportunity and investment, and you're seeing this competition around the world emerge in a number of different places.
So there are questions about what the Fed should do. You said that inflation, I think you characterized it as moderate. I don't know if
moderate and sticky. I think 3+% inflation, given where GDP levels are and the growth we've had in the country, I think is quite reasonable.
Should they cut this year?
So I think that, we're going to, again, this is an element of uncertainty, but we'll have a new Fed chair. There was obviously an expectation of the Fed cutting. I think the Fed has done a remarkable job going back over really the last decade. And I think you have to give the Fed and Treasury and people like Powell and Mnuchin a lot of credit for even just navigating the complexity of the pandemic. So I don't think we should just analyze the Fed in terms of what happens in a quarter. I think they stand at the ready to cut. They made some preemptive cuts. I think now with the uncertainty around the earlier discussion we're having around the oil shock and how does it transmit through the economy, I think they're just going to watch the data. And I think that's probably quite prudent. I think if they need to cut, I think the Fed would cut aggressively, but I think they'll be in wait and see mode.
But you don't see any signs that the oil shock is seeping into a broader inflation picture yet?
Well, we've already seen it in the inflation numbers. Our expectation, so we roll up all the proprietary data we have across all of these companies around the world. And again, we would have thought GDP growth in the first quarter would be quite robust, a bit on the post the government shutdown in the last quarter, coming into the first quarter. I think you could start to see some headwinds and you'll see some pressure on inflation. We've already seen it in the recent numbers. So we could for sure see a near-term uptick in inflation. It's really a question of how does that translate through to business performance. And so I think over the next 2 quarters, market participants are going to be very keenly looking at the data. what's happening with inflation, what's happening with earnings, how is it impacting margins, and how resilient is the consumer. The consumer has done a remarkable job navigating all this and being quite resilient, but there's tailwinds in the economy. We'll just see how much of an impact the oil shock has.
One of the concerns in the economy and in the markets lately has been around private credit. And you guys were the latest to actually announce last week the withdrawal that you're seeing, the redemption request from investors. How alarmed should we be about all of this?
So I think the discussion is a really good one. It's been going on for a long time now. You know, I was watching one of your shows last week, not you, but one of the shows on your program, and someone said, geez, we've been so distracted by the war in Iran that we haven't talked about private credit.
Right.
So I think the discussion
I'm sure you love to hear that.
The discussion, no, it doesn't bother me. Actually, I think as a market participant, it's quite healthy. I think more discussion around markets and market concerns is fantastic, and I think putting a big light on it makes a lot of sense. I think the conversation can be unpacked in a couple ways. And I think where you're headed with this is, the first is, do we think it's a systemic risk? We have long been in the camp that it's not systemic for a number of reasons. Systemic is not just about the size of a marketplace, it's about interconnectivity, and it's about the speed at which capital can move and leverage. And when you look through all of that, it's pretty dispersed. It's not as interconnected as the issues we saw back in the financial crisis. There's always some parallels if you want to talk about size of market and things like that. But I think that the big issue around private credit, and really what's fueled the conversation over the past several months, is what's the impact of artificial intelligence on software as a sector.
Yes.
And we've seen that in public markets. And I think it's too early to tell. When you actually look through the software numbers, and I think you'll see this, you'll see EBITDA continues to grow, but there's this disruption concern. And certainly credit across the entire capital markets has been exposed to software, which were viewed, if you go back several years, viewed as exceptionally stable revenue streams and cash flow streams, and now there's a question around that. And so I think all this discussion is quite good. I think it's great that regulators are taking a look. I think that market participants asking, I think is fantastic, because I think more transparency is actually better. But I think you and I even had this conversation 2 years ago at Milken about private credit. So it's not new news, but I think it's good that it's getting this discussion.
But what is new news is that investors want out increasingly, right? I mean, you had 15% of at least 15% of shares redemption requests. That was a little bit higher than some of your peers.
Yeah, you saw that build throughout the quarter because a little bit of the investors don't just participate in one vehicle, they participate in many. The advisors that we deal with are exceptionally smart. And so when they work with their clients, they're building a portfolio of asset flows. And so it was unsurprising. You saw it sort of build throughout the quarter. It was unsurprising. When you actually dig through the numbers, I mean, the grand scheme of things.
Yes.
If you said that in a quarter, 5% sort of left the vehicles, I think it amounts to about $15 billion a quarter. So in the scheme of global capital markets, it's quite orderly. But I think, again, I think it's a good, healthy process. It's the way the vehicles were designed to work. They're not advertised as being liquid. I've often said the fact that, when I showed up in this industry, the fact that it was called semi-liquid probably would have been better to say sometimes not liquid at all.
Yes.
Now, well, investors are getting their money out.
Do you think that retail investors, were misled?
I've spent a lot of time with advisors over the last couple of years. When I joined Carlyle, we didn't really have a well-defined wealth strategy. We had this fantastic company, this fantastic brand, and this fantastic global footprint with these suite of solutions. And so one of the first things I did is I spent a lot of time with advisors. And we've continued to do that. These advisors are quite smart. I mean, they operate on an institutional level. They're managing very significant sums of money. So I think there's a very, very good understanding, and we're always very clear about the features of all the solutions that we present to the marketplace. So no, that would be surprising to me.
So how does this end? Do you expect this to just continue, more withdrawal? Is it going to be harder to raise money? Is there going to be some sort of credit crunch?
I think markets take time to digest these things. We've seen this in a couple other markets. We saw this in real estate earlier. I think Some of the analysts have put out research pieces that think this will be persistent for a little while. I think that's probably correct. I think until you get past the uncertainty of what does it really mean for software, but I think it could persist for a while. I think it'll be orderly. I think it'll stay in the news, and I think that's a good thing. And I think actually, if you take a huge step back, as the industry grows, it's a young industry that we're in, private capital. It's, we'll be celebrating our 40th anniversary, and we're really, the founders at Carlyle are really the pioneers in the industry. I think that is a very healthy process. And I think that it sort of has provided global education around the suite of solutions. Now the retirement channel open up. I think it's fantastic that the asset class is getting this much attention. Prior to doing it, I think the Department of Labor and other agencies worked really well to put out a really thoughtful paper. So I think we're just seeing the early stages of this, but we don't think it's systemic. I think it's a healthy process. I think we'll get past it. And I think it's going to be we're in the early phases of a growth trajectory in wealth.
Finally, do you think that we're going to see software defaults tick up?
I think that anytime you go through a period where you have significant multiple compression, so you've had a number of companies, software it wasn't really the Carlyle power alley. As a matter of fact, when I joined Carlyle 3 years ago, ironically, when I did my sort of global listening tour, some of the feedback I got was, hey, your firm missed out on the big software opportunity and you're not big enough in direct lending. Okay, you and I sit here today and it seems like those things are virtues. 3 years from now, we'll see what virtues yield in the marketplace. But I think that it's not a question of, how many defaults will we see? I think anytime you see capital committed at high multiples, and then potentially, we don't know the degree of disruption that AI will actually impact, how it impacts software companies. I think anytime you see multiple compression of this degree, then you have an issue of how do exits happen, how's value creation determined, and I think you could see an uptick in defaults just because of the multiple compression. But let's remember, direct lending gets a lot of attention here. There's a whole layer of equity below it, which is what you're really talking about now.
Carlyle CEO Harvey Schwartz talking about, Mike, some of the recent concerns about the redemptions in private credit and kind of soothing those concerns when it comes to whether the risks are systemic, just how big they are. We were talking off camera about how software is actually not that big for Carlyle in particular. And he said when he first came in as CEO, he received a lot of heat from investors. Like, why aren't you in software? Why aren't you more exposed to software and private credit? And he was talking more about the roots of the company in terms of getting into defense and industrials, which, they're the only alternative asset manager based in Washington, D.C. And he said now that's actually serving them very well. And then the other point I got was on the private credit for them in particular, but overall, it's small when you compare it to some of the overall lending and balance sheets of these firms. For instance, investors there asked to redeem an estimated $750 million. They received $240 million. Those are the kind of numbers we're talking about. And just to put, when people draw comparisons to the global financial crisis, the leverage numbers, the exposure levels on the lending, much, much smaller here. And I thought that was an important point that maybe doesn't get talked enough about when it comes to some of these worries around private credit.
Yeah, for sure. I think that has been a pretty consistent theme among those folks involved in the markets, right? And I totally agree. Percent yields, right?
Yeah.
So percent yields, right?
Yeah.
So that's as a start. Sarah, thank you. Good stuff. Still ahead, Oracle expanding its deal with Bloom Energy. Shares of both these companies jumping for the second straight day. And Citi's conference call just getting underway this hour. We'll bring you the highlights in just a few minutes. Stay with us. Time now for a CNBC News update. Pippa Stevens has that for us. Hi, Pippa.
Hey, Mike. House Democrats on the Oversight Committee are threatening former Attorney General Pam Bondi with contempt of Congress, saying she's evading a lawful subpoena for failing to appear. Bondi was scheduled to give a deposition today in the Epstein investigation, but the Justice Department said she will not appear because she is no longer Attorney General. Novo Nordisk, the maker of Ozempic and Wegovy, is teaming up with OpenAI to help speed drug development. Novo says it will use OpenAI's technology to identify promising drug candidates and make manufacturing and supply chains more efficient. And Uber and autonomous tech company Nuro are testing a premium robotaxi service in San Francisco. Select Uber employees can now request a ride in a Lucid Gravity SUV ahead of a planned public launch later this year. Nuro tells TechCrunch the vehicles are operating in autonomous mode and have a human safety operator behind the wheel as a backup. Sarah, back to you.
I'm just waiting for them to come to New York. Thank you, Pippa Stevens. When we come back, individual investors want access to assets historically held by institutions. We'll hear how that's becoming a bigger and bigger business for Wall Street. Plus, the CFO of Wells Fargo is with us. Stock lower after revenue comes in light, becoming the first bank also to break out its private credit exposure. We'll talk about all of that with the CFO. We'll be right back.
Welcome back. Blackstone Private Wealth looking to capitalize on the interest in alternative assets. Robert Frank has that in today's edition of Inside Alts. Robert.
Good morning, Mike. Good to see you. Well, investors tried to pull more than $20 billion from private credit funds in the first quarter, but the head of Blackstone Private Wealth, Joan Solotar, said the short-term fears of a crisis may test the market, but they won't change the long-term portfolio case for growth. Now, Blackstone Private Wealth assets have soared from $58 billion in 2017 to over $300 billion today. It expects to reach $1 trillion in the coming years. Even if overall loan default rates in private reach 15%, which some analysts have forecast, Solotar said returns would still be around 3 to 5% in private credit.
I think it's a matter of staying calm, understanding what you own, what the real downside is. You'll have some natural rotation, I think, from credit to other asset classes. But the reason the funds are designed with caps is so that, unlike the public funds, your flows will not force you into realizing losses at an inopportune time.
She also said less than 5% of the assets in Blackstone's funds are exposed to AI. When I asked about the lack of transparency in private credit, or marks, she said disclosures on private loans are actually better than the disclosure by many banks, at least at the loan level. Now, for the full interview with Joan Solotar and some choice words she had for Lloyd Blankfein after his criticism of expanding alts to individual investors, you can sign up for the Inside Alts newsletter. That's out today at CNBC.com/InsideAlts.
You know, Robert, I would imagine that the profile of a client of Blackstone Private Wealth is exactly the sort that has a kind of large enough portfolio, diversified enough that they are the exact type of investor who could ride this out. I mean, that's what everyone says. Like, if you just hold, you're kind of going to be able to make it through.
That's right. Her point was you don't want to sell at a time like this when other people are trying to sell. And they've been a lot less impacted than BlackRock, than Ares, than Blue Owl with redemptions. So you're right. That kind of client has a pretty diversified portfolio, and they can ride this out, especially as we've seen equities kind of flatten out here and stabilize.
Right. Sarah, thanks, Robert.
Thank you. Thanks, Robert. Up next, Oracle expanding its deal with Bloom Energy. Look at what that means for both companies when we come right back here on Money Movers.
Welcome back. For the second straight day, shares of Oracle and Bloom Energy are jumping as the companies expand their deal. That is the focus of today's Tech Check with Seema Modi. Seema.
And Michael, a nice 2-for-1 deal here for Oracle as it furthers its relationship with Bloom Energy. First, the power side of things, this deal brings the total energy commitment from Bloom to nearly 3 gigawatts with full deployment by 2027. Today's announcement builds on a July agreement when Oracle and Bloom first came together to bring fuel cell technology to help power Oracle's data centers that it's building across the U.S. There's also a financial angle, Oracle receiving a $400 million warrant to purchase over 3.5 million shares of Bloom Energy at the end of last week. With this announcement, Bloom shares are already up about 20%, and assuming Oracle exercises the warrant, its investment is up about $300 million. A win for the company as it is carrying about $100 billion of debt on its books, with free cash flow having gone negative. But this investment, it certainly underscores how crucial energy security is becoming to the AI build-out of data centers, finding more clean energy options like fuel cells that primarily run on heat and water. And this deal does follow a number of other hyperscaler energy joint ventures or deals. Take, for example, Google, its partnership with Total Energies, Meta's deal with TerraPower, and Constellation Energy. As, Mike, you were just discussing, Oracle up another 4% following that 13% gain it saw just yesterday. So the market seems to like this one.
Without a doubt. And I guess this warrant piece of the transaction, you know, it fits in that profile of what we've talked about as circular financing to some degree, right? I mean, there is this kind of financial relationship. They're sort of helping to fund the actual creation of the energy resources. Market seems fine with that these days, at this point, at least from these stock price levels.
Yeah, look at the other circular deals out there, whether it's OpenAI, AMD, NVIDIA. The markets hasn't been too concerned about the circular nature of some of these deals. I would say this specific agreement comes following the announcement of Oracle's new chief financial officer who came in from Schneider Electric, Hilary Maxson, and what she's best known is for capital intensity and being able to use the company's balance sheet during a time where it's really exercising more of its capital towards data centers. So this specific deal, I think, is significant under her.
And I guess this new phase is considered to be some kind of an unlock for Oracle to be able to have, you know, a line of sight toward adding more capacity. In other words, was it considered to be in doubt that they would be able to complete this next round?
No, I don't think so. I think, to your point, this just helps them accelerate that broader timeline. Listen, it's currently in the midst of a big race. When you look at the broader data center build out, Google, Meta, all of them are putting so much money towards it. And I think what we're finding is that at first, when looking at capital expenditures, the focus was on GPUs, but now it's quickly pivoted to energy and which of the hyperscalers are able to create that on-site power generation resource and who's doing a better job at it.
And fueling the speculative momentum in Bloom Energy shares in particular, too. Seema, thank you. Sarah?
All right, CFO of Wells Fargo with us on the other side of the break. His first interview after reporting results. Right now, shares are under pressure, down about 5%. Plus, Citi conference call just kicked off at the top of the hour. We'll tell you what CEO Jane Fraser just said about any potential acquisitions. We'll be right back.
Welcome back. Citi's conference call is underway. Leslie Picker's been monitoring that for us. Hey, Leslie.
Hey, Mike. Yeah, the stock is higher as well. Citigroup posting sizable beats in the first quarter. The top line came in about $1 billion above the street's expectations, the firm's best quarterly revenue in a decade. The bottom line jumping 56% and beat by 41 cents per share. Net interest income also surpassed estimates. You can see the stock up about 2.7% right now. The markets division was a big driver of the beat, which with its larger fixed income division gaining 13%, while equities jumped about 39%. Investment banking came in a little light except for equity underwriting, which did surpass expectations. Wealth and U.S. consumer cards gained in the quarter as well, but the firm's provision for credit losses was higher than expected due to net credit losses in consumer cards and an allowance for credit loss and a build of $579 million. Despite, though, reports indicating that Citi might be interested in bulking up its retail banking presence in the U.S., Chair and CEO Jane Fraser said an acquisition is off the table.
We are only interested in and focused on organic growth. Period. End of story for the whole firm. We have achieved a lot in the last 5 years. We have a lot more to do. And there is a large organic growth opportunity ahead of us across all 5 of our businesses. And that is what we're focused on. And we're excited about it.
The firm's return on tangible common equity, that's a measure of profitability, coming in at about 13.1%. That's the highest since 2021 and above the firm's target of 10 to 11% ROTCE. Fraser said that Citi had entered the, quote, final phase of its divestitures, and 90% of its transformation programs are near their target state, guys.
Yeah, that's been one we've been following all over, the transformation of Citigroup with results, more results today. Thank you, Leslie. Leslie Picker, we'll see you in just a few minutes for your sit down with General Atlantic CEO Bill Ford at the firm's Investor Summit. That's where Leslie is in New York City. Meantime, Wells Fargo, speaking of banks, shares are down after missing revenue estimates for second quarter in a row, and the only big bank so far to fall short of the street's consensus on the top line. Primary revenue drivers like net interest and non-interest income also missing estimates. Shares down around 5%, though off the lows of the session. Joining us fresh off the earnings call, first on CNBC, is Wells Fargo CFO Mike Santomassimo. Mike, welcome back. It's good to have you.
Hi, Sarah. How are you doing?
I'm doing well. Trying to figure out what the story here is, because I was listening to the call and reading some of the remarks. Charlie talked about sort of steady growth in all the parts of the businesses and good underlying fundamentals. Do you think the market is missing something here?
Well, look, I think on any time on earnings day, the stock could be up or down. But what we just stay focused on is delivering on the plan that we set forth. And I think what you see in the quarter, and we tried to summarize this in some of our materials, is just good growth in really every part of the business. The momentum is starting to pick up across a lot of the key variables, that drive sort of not only the earnings in this quarter, but also the growth that we should expect to see over a long period of time. You see it in the consumer space, where auto originations are double what they were last year. Credit card originations up 60%. New checking accounts open up 15%. You can see it in the wealth business with all the recruiting and assets we've got. You can see it in sort of the commercial businesses with, markets revenue up 19%, banking up 11%. We're seeing good growth in new accounts and loan growth and deposit growth in the commercial bank. And so those are the variables you want to continue to see quarter after quarter, and I think that'll add up to a lot of growth. And you couple that with really good expense, containment again in the quarter. And I think that gives you good operating leverage as you look forward. And so I think we continue to be very excited and just focused on sort of the organic growth opportunities we have there. And I think you see some of the progress, each quarter.
The net interest income was a big focus of analysts on the call, obviously key profitability measure for you. Can you just talk about what's going into that and what you view going forward? Because some were wondering why you didn't change the estimates.
Yeah, well, look, I think the biggest driver that you're starting to see now, it's been a couple quarters in a row, where you've started to see really good loan growth. And that's going to be a tailwind as you sort of look forward, over the coming quarters. And it's really across the board as, in each of the businesses. You saw it in the auto business. In credit card, you always have a little bit of a seasonal dip in the first quarter, but we expect that, to grow as you look at the rest of the year. In our mortgage portfolio, it's the pace of decline is moderated, and I think that'll start to, flatline and potentially grow over a longer period of time. And then the commercial side is really where you've seen, good, strong loan growth again, without relying on clients utilizing the revolvers more. And so that's still an opportunity that's to come as people, get more and more comfortable with, the economic path. You then couple loan growth with what we're seeing on deposits. We saw good growth in interest-bearing deposits. We said that would be first as we sort of looked at this growth journey. We expect to grow non-interest-bearing over a longer period of time if we're successful in sort of growing our consumer side. And then it's just rates, in terms of where that ends up. And, certainly, the expectation today is that they'll be a little bit higher than people thought in the beginning of the year, but it's been really volatile. As we've looked over the last 3, 4, 5 weeks. And so we'll see where that ends up. But net, you can definitely see some scenarios where, we could outperform the guidance, but it's still early in the year.
Yeah, I was just going to ask what you're seeing from the consumer right now, overall, through the credit card business or the loan business, given, the macro uncertainty, the rise in oil prices, and the underlying backdrop, which you guys have said has been pretty positive.
Yeah, I mean, it's really resilient, strong performance. You see people out there continuing to spend. People are paying more for gas and fuel than they did, 30, 45 days ago. But nonetheless, overall, spend continues to grow week on week, every week, year on year, I should say, and that hasn't abated at this point. Strong credit performance on the consumer side. Delinquencies continue to be a little bit better than we model, not worse. And in aggregate, they're not getting worse. You certainly have, consumers on that, lower end of the wealth spectrum that, have worse impact from what's happening. But even there, for the limited credit exposure we have, we're not seeing deterioration there across the portfolio. So overall, just strong, resilient sort of performance so far.
Mike, you mentioned the pace of decline in the mortgage book has slowed. Obviously, it's a macro-influenced area. I just wonder in general about your appetite for home-related lending. There's this, kind of position that the administration has taken, and arguably, the Fed chair nominee Kevin Warsh, where the Fed balance sheet maybe could be privatized by having banks own more mortgage-backed securities, reduce the mortgage spreads, and then, maybe ease capital rules so that banks get back in a bigger way into mortgage origination. Is that something that you would have an appetite for under the right circumstances? Does that seem likely?
Well, I think, and nice to see you, Mike. And, I think you got to really separate it into two pieces. On the servicing side of the portfolio, where you service loans for others that are owned, that you securitize, that is something we've been shrinking for a while. That was part of a strategy we set out, 3 years ago. I don't see that changing much. There's a lot of other things that need to change for us to, reconsider that, and that's not on the table yet. Where we're focused on the origination side is really being there for our customers, our wealth customers and our consumer customers. And there, I think, rates and mortgage spreads are a big variable in terms of seeing some of the volume increase, come through there. But we're very committed to supporting our existing clients in that portfolio. And as both, interest rates, spreads, availability, housing, all of that comes together over a period of time, I think, we'll continue to support that. But on the servicing side, I don't see that changing much.
Mike, why did you decide to report the $36.2 billion of exposure to private credit at a time where there's a lot of nervousness around private credit and what might happen to that exposure?
Yeah, for that very reason, Sarah. I think there's lots of confusion out there in terms of, private credit exposures and so forth. And so, we felt it was important to not only, give, the private credit exposure, but just the broader backdrop around all of the lending we do for kind of non-bank, financial clients. And I think, on the private credit piece in particular, as you can see from the slide and from our commentary today, we feel really good about the risk that's there. We feel really confident in our ability, to originate these loans. And I think given the advance rates and all the work that goes into underlying the collateral, we feel really good about that exposure. We wanted people to kind of see some more of the details there to kind of get them comfortable and just kind of work through some of the noise that's been there, in terms of the confusion that was out across a bunch of different stakeholders.
It shows 17% exposure to software. It looks like software, business services, and healthcare are the biggest sort of categories there. What do you think is going to happen here ultimately with some of these withdrawal requests, and ultimately how big of a risk is it for the U.S. economy?
Well, we're not seeing anything that's systemic at this point, and in the vehicles that allow redemptions, it's about around 20% of the portfolio, maybe slightly over 20% of the portfolio for us. And so, almost 3/4 of the portfolio are in more traditional drawdowns that don't, structures that don't have, quarterly redemptions like you've been sort of reading about. So the vast majority really isn't as impacted by that. And then when you look across, the actual underlying, credits that are in there, we're not seeing like big broad deterioration, in the portfolio. And I think, we continue to spend a lot of time thinking about how to, evaluate AI risk for software and more broadly across the different, the different portfolios. But we're not seeing that at this point. And, for us, as I said, that BDC exposure is a relatively small piece of the overall pie.
It's good to get the information and really good to talk to you, as always, and get the color around what you reported. Mike Santomassimo, CFO of Wells Fargo. Quick note before we go, I am here in D.C. because tomorrow I'm hosting the CNBC Invest in America Forum. We are going to bring you some of the best moments right here on Money Movers tomorrow. Conversations with the Treasury Secretary, Apollo's Mark Rowan, speaking of private credit, many more top executives across industries. Rachel Reeves, Chancellor of the Exchequer, after a big downgrade for UK GDP from the IMF today, and the head of FIFA, Mike. So all the stories around investing in America. See you then.
I was going to say great lineup, Sarah. We look forward to that. Meantime, S&P 500 up just about 1%. Let's get over to halftime with Scott Wapner.
All right, Michael, thank you very much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, there's a rebound in stocks. As yes, the S&P moves closer to new highs. We debate, we discuss with the Investment Committee. Joining me for the hour today, Joe Terranova, Jim Leventhal, Brian Belsky, Josh Brown. Let's check the markets. Got a good thing going today. We're green across the board. NASDAQ's up 1.5%. Man, the Russell is up 9% year to date. Small caps have been playing ball big time. S&P now wipes out all the losses since the war began. NASDAQ's coming off its 9th straight positive session, or 10. We're going 10 now, longest since December of 23. The S&P is less than 1% from new highs. Can't believe you're saying that, Joe, after what we've been through recently, but the tide has turned.
It has. And we are rebuilding the growth trade. That is what is going on in the moment, has been going on for the month of April. Today, you have S&P growth up 1.7%. S&P value is up 15 basis points. For the month of April, you have S&P growth up about 9.5%. You have S&P value up 2.5%. I understand, I respect the narrative coming into the year that we were going to get a broadening out, that the S&P equal weight was going to take charge. In fact, that did happen. But right now in front of us, why you have to gain confidence is you needed to see the rebuild of the growth trade to restore the risk on sentiment. It's not just growth itself. It's internally, it's gold, it's silver, it's biotech, which is at its highest level in the last 5 years. The momentum factor is up 11% month to date. Semis are up 16% month to date. Even some of the private equity publicly traded names like Blackstone, like Evercore, like KKR, they are up double digits month to date. This is the formula that you needed, growth to make its return.
So, Brian, the tide's turned, sentiment's turned, right? Citi upgrades U.S. equities to overweight. Morgan Stanley's Mike Wilson, he was with me the other day on Closing Bell. He was on Squawk this morning, in which he said the lows are in for the year. The technicals are now your friend again. Wolf talking about that. Weekly trend work turning bullish for the S&P. Tony Pasquarello, Goldman Sachs, head of hedge fund client coverage, says, I spent much of the past 6 weeks trying to work out why the S&P was so resilient. In that search, a few things came up again and again. One, the market never lost confidence in the underlying durability of the economy. In turn, earnings expectations trended higher. That's the story. That's why people tried to look through the war and look through the spike in oil, because they believe that the economy and earnings were going to remain resilient. And that's why, as we said, you're about 1%. You're less than 1%. Now you're like 2/3 of 1% on the S&P, away from a new all-time high.
Yeah, I think the earnings and the fundamental situation help people stay in the market. Now they're going to get paid for staying in the market and paid for that earnings and macro backdrop. And I do think the momentum, obviously, when you have the snack back call plays on some of these stocks that are up double digits that were down a lot, Scott. But I still think that you're going to see, look at how small caps have done. Look at how value's done. I think from a longer term perspective into 2027, we are still going to see better areas work. It's not just going to be all about tech, but we'll take it where it is. We like the tech stocks when they go up. We're fully invested in tech and communication services, and so we've enjoyed this rally.
All right, from Jimmy Jitters to Jimmy Jubilant, because his tide has, in fact, turned as well, hasn't it, Mr. Leventhal? The good farmer on our desk today.
I think sometimes you need to listen to the markets. I mean, I can sit here and I can rationalize, the four of us can rationalize, and with Josh 5, where oil prices are, what's going on with the Strait of Hormuz, consumer sentiment. We can put all these things together, but sometimes the market just tells you what to do. And you've referred to it twice already, Scott. We're within a hair's breadth of an all-time high on the S&P 500. You've got a lot of stocks that under the current events conditions should be doing terribly. Look at the airlines and how well they're doing. Look at a lot of consumer discretionary stocks doing well. Look at a lot of financial stocks, not all of them, but look at a lot of financial stocks that are shrugging off the worries about private credit.
Now, why did you get so worked up negative? You were worried. You said as much sitting in Belsky's chair last week.
Well, I think about that, and where was the locus of that? It was when I sold On Holdings, and that also had that management change and the terrible price action. And I think, just to stay consistent, Scott, that I was listening to the market on Holdings at that exact moment. I mean, that slide, just on a seemingly fairly innocuous management change, told me something might be afoot that I wasn't paying attention to.
Literally
I actually didn't mean that. And
You
I
thought
added
that
to
On Holdings was giving you a broader market signal, Jimmy?
Well, I added to it with Nike, which had reported earnings. There were some rumblings, but look, my tone has changed. I'm listening to what the market is telling us. Yesterday, and I said this, when the market rallies on what was bad news, that's telling you to get in. And if we set a new high today, tomorrow, whenever, I think people are going to now pay more attention and get more into the markets. They're just going to have to get invested. Right. So I'm not playing around. I'm in.
Can he play on his Farmer Jim thing a little bit, though? I mean, when I think about you and you think about the Farmer Jim and you think about how your affinity and longer term outlook for the industrial stocks. Yeah. And you love industrial stocks, and you've owned industrial stocks for a long time. Did the shakeout or potential shakeout with respect to macro and the cyclicality of these areas, did that kind of worry you and cause some of your concerns?
Let me push back on the Jimmy Jitters. It's fun and I like it and it's cute and everything. But let's face it.
And it's legit, but go ahead.
But look, I mean, what do I hold and what have I been adding to? Like the Wynn Holdings, the Disneys, like holding a Delta Airlines. If I was really worried about the macro, to your question, I'm not holding Delta no matter how good its balance sheet is. And by the way, the earnings report from Delta last week kind of said, maybe you shouldn't be so worried, Jimmy. So look, I listened. You're right. I was a little worried. I said that. I'm not anymore.
Okay. Josh Brown has his NHL playoff beard coming in just at the right time. About to go to the postseason. And this market is ready to figure out where this puck is going to. And it seems like people think it's going into the right place.
Yeah. Before I get to that, I have to tell you, one of my favorite things about being on this show for as long as I have is getting to watch this character turn, this evolution in Jimmy Leventhal. When I first met him, he was this dyed-in-the-wool value investor. The market is wrong, the stock is cheap, and now I'm hearing all the right things. I'm hearing, listen to what the market is telling me, watch what the market is saying, and I absolutely love it. It's like I met him as young Anakin, and he is full-on Darth Vader, and I'm just so thrilled that we got him there. Jimmy, welcome to my world.
Josh.
Yeah. Listen, Joe said the most important thing, that momentum as a factor, like relative to, let's say, low volatility or dividend growth or book to market or whatever. This is a momentum market. This is my market, hence the playoff beard. I'm having a lot of fun this year. And I'm just like looking at some of the best stocks, just the ones that I've trotted out in the last few months. Sienna plus 128% since December 1st. It's insane. Lam Research, Newmont. Think about the names we talked about. I put Intel up on January 26th, up 40% since then. Valero, Exxon. It's just, the list is endless. And what's so cool about this market is all of those names defy the sort of traditional characterization. People, is it growth or is it value? Is it cyclical or is it defense? It doesn't make a difference. The buyers are overwhelming the sellers in these charts. So when you say take what the market's giving you or listen to what the market said, the market is telling you that there are so many ways to win. None of those companies I mentioned are in the same sectors or in the same industry groups. And you've got winners all over the tape. And so that's what the message of the market has been. And by the way, the street is now looking for 17.9% earnings growth in 2026. That number is up 3 full percentage points since January 1st. We have relearned this year that we are significantly less sensitive to oil prices in the S&P earnings than we were in the 70s and 80s. And as the mood lifts here, people are out hunting for new opportunities, and they're finding them in a lot of the best stocks in the market. They're pushing on winners. So it's nice to get the snapback in IGV names. We get one once a week. I don't know if anyone's paying attention. It fades pretty quickly. So if you're in those names and you've been wanting to sell, this is your chance.
Yeah. Well, look, speaking of what you just said, they're looking for the best stocks in the market. You've had a name on your own best stocks in the market list that now has made it into your own portfolio. To underscore this, it's when you highlight these names, you don't own all of them. You're just looking at things that tell you that they deserve to be on the list. You can't add everything until the time is right. NASDAQ's up 10 days in a row. It's up more than 2.25% since the war started. You pluck a name off your list into your portfolio, which is eBay, which Jim bought last month. So why do you buy it? Why'd you buy it now?
So I don't do waiting rooms, okay? I don't like to sit in the lobby. Let's put up a chart. Here you have a stock that's 11% above its 50-day. You've got a name that has made two separate. I need longer than 10 minutes, guys. You've got a name that you can see here has made two separate attempts above $100 a share, failed twice. We are now back above 100. Give me like a 1 year, for the love of God. But this was a stock that was in a 21% drawdown through February. It's exploded higher off of its low. Forward PE of 15 times earnings, expecting 9% earnings per share growth this year, 10% next year. Not a lot of expectations embedded in the stock, but when you look at RSI, you look at trend, it's stronger today than the last two attempts it made at 100. And so, like, why now? Why not a month ago? Why not 2 weeks ago? Why not at 85? Why not at 92? Because I don't want to sit here if I'm wrong and have capital committed to eBay. Literally, think about it, eBay in 2026. But I want the breakout. So what'll happen here as the stock continues through 100, I'm in it at 98 as of this morning, I'll roll up my stop, and I'll stay for as long as the ride continues. And what I'm trying to do is own it as it breaks out, not be like a lifer in a 9% earnings grower.
So let's kick it. I mean, you own it.
Yep.
Right?
Well, we bought it in October for the ETF at $81 for a lot of the reasons that Josh is citing. Very strong revenue growth. There's a lot of distrust about the ability for this company to sustain a breakout. As Josh pointed out, in August, it was up at 101. Look at the analyst community. Only 32% of analysts have a buy rating on this stock. The 12-month price target sits right here at $100. So we have not built in the confidence yet that this can take its place as a momentum name, that it could carry forward beyond 101. From a fundamental perspective, the one thing that Josh didn't mention that I think is important is the partnership that it established recently with Meta. So now if you are a Facebook marketplace seller, you're able to add your inventory directly from eBay itself onto that Facebook platform. So I see exactly what Josh is seeing in front of him. I want to get the breakout. I think the breakout is ultimately going to happen. They report earnings on April 30th, and the expectation would be that that would be the point you'll get the breakout.
Hey, they are buying. They are using 100% of their cash flow, 80 to 100% of their free cash flow to shrink the float, to buy back stock. There are not a lot of these in the market.
Oh, sorry, Josh. A little more on the fundamentals. You guys have given a good talk on the technicals, the momentum. Talked a little bit about the fundamentals. What are the drivers here? There's two, and these are things we may not be thinking so much about. Collectibles. eBay is becoming a marketplace for collectibles. That's a really big growth driver for the company. Also, in an environment of higher gas prices, tighter purse strings, this is a place for secondhand goods, for thrifting. That's another growth driver here. These are strong fundamental reasons that the revenue should continue to grow and the earnings with it for eBay.
This was also, if I recall, and I don't remember what the deal was, but this was the stock you recommended to Al Michaels, wasn't it? In real time, in which he bought it live on the program. Did take me through that again. Did you own it then, and then you sold out of it?
No.
What's the deal there?
I've traded the stock a lot over the last 15, 20 years, but this is, again, that's one of those failed attempts above 100. So it ran up, but it didn't quite, break through. And then a second time, as Joe mentioned, it failed. This is the third attempt. And in my experience, there are no such thing as every technician, actually. Bring them all on. Bring on Krinsky, bring on Suttmeyer, bring on Ari Wald, whoever you want to talk to. There are no such thing as triple tops. So, there obviously are, but like technicians look at the third attempt and the RSI is better than during the prior two. And I think you got to say the Bulls are taking control here.
Yeah, Al was in, and Al got out too. Maybe he wants to take another look. I don't know. But he's watching in real time too. What's up, Al? Always good to have Al in the stable. No question about that. Hey, there's another name that you wanted to highlight too. Flex. Because you mentioned it and it's ripped since, hasn't it? Let's look at that. I don't remember when you mentioned it, but talk about that for a minute. We wanted to highlight it.
It was Thursday morning, so we wrote it up that morning, 73. Stock is trading about 80 right now. It's so emblematic of what's going on in this tape. We bought it as it broke out. Like that's what I'm trying to do. They don't all work, and they certainly don't all work this quickly. But I did want to mention to people that took that trade with us on Thursday, what you're doing here now is you're rolling up your stop, you're playing with the house's money. So the way that I would think about this, we said 73 was the breakout, took that level out. There's a gap in the chart. I would take the top of that gap, which is, let's call it 68. I'd roll the stop up to 68 if I were a longer-term investor. If you're a shorter-term swing trader, what you're actually looking for is a 10-day moving average or something. I'm not really playing that game, but again, there are so many of these that just pop off as they break out, and Flex is like, to me, the prototypical stock that's keeping people engaged in this market because there are just so many of them.
All right. You have new names too, which are on this list, which are focused in the chip space, correct? Like the chip equipment names. Are those the new ones you wanted to add?
We wrote up KLA and Lam. So these were two names that we wrote up prior. The lesson here, Scott, this is one of the most important things that I can tell people about these stocks. We wrote up KLA and Lam on the first trading day of 2026. A lot of people were mad about it. People said, dude, KLA was up 94% in the year 2025, and now you want to get bullish on it? It's not that now I want to get bullish. By the way, it's up 40% since then. It's not that now I want to get bullish on it. It's a setup. It's a trade setup. Lam Research, same thing. It was up 140% last year. We wrote it up on January 2nd and brought it to the show. It's up 46% year to date. The lesson is, just because you weren't in a stock at the very start of the rally, or just because you watched it go by multiple times, it doesn't mean there's no opportunity left. And when a company is growing earnings as rapidly as these two are, and you've got a breakout setup, you kind of have to go like this and do a Men in Black and not get hung up on this thing that you're anchoring to. I should have bought it at 60. I should have bought it at 70. Forget it. It's not helping you. And it has nothing to do, Jimmy talks about this all the time, it has nothing to do with what's going to happen in the future.
Yeah, Joe owns both of these names. Let's talk about a couple other things, too, because the semis hit a record high today. They've had the best week since November of 22. The SOX is on pace for its longest rally since October of 2017. It's up 15.5% over the last month. Belsky.
Yep.
You sold Texas Instruments.
I did.
Joe owns it. Why'd you sell it?
Texas Instruments is one of 4 names that were casualties from our dividend growth portfolio that we sold. The reason being is that we see stronger dividend growth in other areas, including utilities. But in the case of Texas Instruments, one of our key metrics when we build a dividend growth portfolio is cash flow yields above the dividend yield. And given the poor performance of the stock over the last few years, dividend yield obviously has gone up, and the spread between dividend yield and cash flow yield has gone down. So there's other areas to buy, especially dividend growth areas, and that's why we sold it out of dividend growth.
You know, we're also looking at software today, which remains a pretty good story. Let's look at IGV. There it is. There's your run over the last, couple days. Not, it's not definitive of anything yet, but remember, $77. It's approaching 80. 77 was the Krinsky line in the sand. Now, once it got over that level, it was, at least to him, confirmation that maybe the bottom was in. And others have gotten on that bandwagon as well. The IGV is up 5% this week. Best day in a year. 52-week low on Friday. Josh got stopped out of it last week. Oracle is coming off its best day since mid-September. It was backing that up today, too. Let's look at that. Look at that week to date, 19%. Kidding me? You trimmed it because of the move that it's had, or you got other reasons?
No, we trimmed it again. That was another casualty from dividend growth, but we remain fully invested with respect to our U.S. focus portfolio and our value portfolio, the names that we are quite sizable in Oracle, and that's really what we talk about in terms of tactically over the next 12 to 18 months on a fundamental basis. We have not sold our Oracle. We've maintained our positions, and we believe in the company.
So one out of the 33 portfolios that you have, you
one out of the 4 U.S.-centric portfolios, yes.
Okay. Okay, but you still have it in the other portfolios.
Yep, those are our biggest positions, and our U.S. focus and our U.S. value for Oracle.
Okay. I got you.
You got me?
Yeah. Okay. All right, we'll take a break. Coming up, we have a halftime exclusive. Our Leslie Picker is live with General Atlantic CEO Bill Ford. It's their annual investor summit. Speak to him next. Welcome back to the Half General Atlantic's Investor Summit happening this hour here in New York City. Few firms have as much insight into the current investing landscape, from AI and software to private credit and far beyond. Our Leslie Picker joins us now for an exclusive interview with that firm's chairman and CEO. He is Bill Ford. Leslie Picker, take it away.
Thank you, Scott, and thank you, Bill, for having us here. What a time to have an investor summit, and you all are really at the center of everything that we're talking about daily on CNBC, from AI disintermediation to private credit to geopolitical strife. Maybe we start with software and AI, and I'm just curious, because you're also an investor in Anthropic. You have some software exposure as well. How are you thinking about the risks, the moats, especially as this type of technology is iterating and innovating so quickly?
Well, we've been a software investor for a long time, but we've been focusing on AI in a major way for the last 4 or 5 years. And one of the things that I think we can say today, and we're talking about at our meeting, is that AI truly is a technological revolution. It actually goes all the way back to the railroads, electricity, the PC, and the internet as one of the major technological revolutions of the last couple of centuries. And we think it'll be that big. And just think about the fact that Anthropic last quarter added over $20 billion of ARR. So the demand is there, the growth is there, and we're seeing significant opportunities. And I think it'll be the major source of capital allocation for investors over the next decade. And we're super excited about it because it fits our growth equity program, but also our infrastructure program, what we're doing with data centers and digital infrastructure, and energy transition, because energy is such a critical component to AI. Compute and energy are really the ingredients to create intelligence on demand.
Yeah, you have exposure across the supply chain. What do you think it means for some of the more legacy tech, some of the more traditional software, SaaS companies? You have exposure to those as well. Is it a zero-sum game?
Yeah, no, I don't think so. I think they're going to be winners and losers. And I think, unfortunately, the market took the view that everybody's guilty till proven innocent. But I think a number of companies are going to be able to harness AI capability to actually extend their businesses, and some will be more challenged. But all of them are going to have to go through a very important change, which is a move from user-based pricing to usage-based pricing. It's all going to be about how much use they have in the future that will drive their revenue model. So they'll have to go through that transition. But some application software companies, I believe, will be able to harness AI to actually extend their applications and add more value to their customers.
Well, how do you define usage-based pricing? Like, how does that transformation work?
Well, we know a lot about how companies are using this software. One measure of AI usage is token use. And token usage in AI has grown from 1 trillion per week a year ago to over 7 trillion today. So that measure of usage could be applied to software as well, to say how much usage is taking place at a customer site. And if we can shift pricing towards that, I think we're going to find a way for companies to still capture the value they're delivering to customers.
Interesting. Less about subscription, perhaps, and more about time spent using the platform. I want to ask you about private credit as well, as it fits into the whole software conversation. You have about $10 billion in private credit, relatively small exposure compared with many of your peers. One of the big headline risks, though, in private credit has, of course, been software and whether or not it's being valued appropriately. I'm curious what you make of this market right now. Is there stress or potential for future stress? Is it something you're concerned about?
Well, we're not seeing it now. I mean, if you look at our private credit business, our companies are performing well. We're not seeing any significant credit issues in our portfolio. Now, you're right, Leslie. It's a small part of our business, but still, we're really not seeing it. And all of our capital is long-term. It's a traditional locked-up vehicle, so we don't have any stress coming at us in terms of redemptions. But we're still quite bullish on our credit business, and it's performing.
Yeah, you mentioned the long-term nature, the institutional nature of your investor base. You haven't embraced retail structures as many of your peers have. And I'm curious if the recent events dissuade you from ultimately doing so, or making you kind of stick with that institutional fabric?
Well, the core of our capital base has always been institutions and family capital, and that goes back to the beginning of our 46 years in 1980, and that still is the cornerstone of the firm. But private wealth is going to become a more important component of our business. It's about 15% of our capital today comes from the private wealth channel, And that channel is shifting towards evergreen vehicles from traditional fund vehicles. And we'll have to keep pace with that trend, and we're considering that for the second half of the year. But I think institutions and families will always be at the core of General Atlantic's capital base.
What's the need to keep pace with that trend? I'm just curious, given all the headline risk around it and what at least seems to be a more, a less sticky investor class, as we've seen with the redemption figures over the past
Well,
few weeks.
I think it's clear to us that private wealth investors want access to private markets. I don't think that's going to change, whether it's private credit or, in our case, private equity. And we're thinking about it for our private equity fund. But I think they want access, and they want access in a vehicle that's convenient for them. And up till now, it's been in traditional fund structures. It seems to be moving towards these evergreen vehicles, and we'll keep pace with it. But I don't think it'll ever be more than 20% of our capital base.
Right. I want to ask you about the geopolitical environment, because you are one of the most global investors based here in the U.S. More than half of the capital that you've deployed over the past 46 years has been outside of the U.S. How are you thinking about deploying capital right now in places like the Gulf and China, which have been big growth markets and big target markets for General Atlantic?
Well, one of the ways we think about it, Leslie, is that in a world of elevated volatility and elevated geopolitical risk, one of your best risk management tools is diversification. And we're strong believers in global diversification. As you said, half of our investment activity is outside the U.S. Europe, India, China, Southeast Asia, Latin America, so even well diversified outside the U.S. But we see strong growth in these markets. India is having its digital decade and growing very, very rapidly. We're seeing good growth in Latin America. And China remains a strong innovation economy. And so we want our investors to have access to this secular growth that's taking place. And half the world's unicorns are outside the U.S. Unicorns being companies valued over $1 billion in the private market. And so we want to access those opportunities and deliver that growth to our investors.
So you're not concerned about the war or the deglobalization that's taking place, obviously?
Well, I think all investors are concerned, and they know we're in a world of elevated geopolitical risk, and they worry about it. And those are issues we're going to have to navigate. But they also believe in diversification, and they also believe in secular growth. And we're strong believers that secular growth is your port in the storm, because in a more complicated, challenged world, if you can be in a sector like technology or healthcare or financial services, you can capitalize on secular growth to drive investment returns.
You mentioned the unicorns being outside the U.S. There's some pretty big ones here, too. You're invested in Anthropic. You're invested in ByteDance. This was supposed to be the year that the IPO market saw its big unlock and these companies went to market. Given the volatility we've seen recently, do you think that's still a possibility?
Yeah, I think we saw a really nice rebound in the IPO market in 2025. IPO activity was up almost 50% last year, and we came into 2026 with a nice pipeline of companies preparing to go public. I still think we're optimistic that we'll have an IPO market this year, and some very important companies, maybe even SpaceX, will get public, and that will create some real momentum for the IPO market. Clearly, right now, it's a little bit more challenged because of what's happening geopolitically. But when I talk to company CEOs, they're still thinking seriously about accessing the private markets, even in a more challenging environment.
Fascinating. Well, Bill Ford, thank you so much for being here, talking software, AI disintermediation, private credit, and of course, the geopolitical environment. We appreciate you letting us attend your Investor Summit today.
Great. Thanks for being here, Leslie.
Thank you. Scott, I'll send it back to you.
All right, Les, thanks. Always good to hear from Bill, especially on days like these. So thank you very much for bringing that to us. That's Leslie Picker. Coming up next, I got to tell you about two really important stocks. They're not that far away from new highs in their own right. I'll tell you what they are. You probably own them when we come back.
We're back on Halftime Report. I'm Pippa Stevens with your CNBC News Update. A federal appeals court ordered a judge to end the contempt investigation into the Trump administration over deportation flights. Federal Judge James Boasberg said last year that the government was in criminal contempt for defying his orders to temporarily halt the deportation flights. The federal appeals court says Boasberg's decision was an abuse of power. Super Typhoon Sinlaku is traveling through several remote U.S. islands in the Pacific. It is the strongest tropical typhoon on Earth so far this year. Winds reached 173 miles per hour Monday, and the storm is expected to cross the northern Mariana Islands this evening as a Category 4 or 5 typhoon. And a $1 million painting by Pablo Picasso was raffled off for less than $120. The Alzheimer's Research Foundation in France sold tickets for €100 to raise money for research and a chance to win the prized painting. Picasso painted Head of a Woman in 1941. Sounds like a pretty good deal, Scott.
I'd say so, Pips. Thank you, Pippa Stevens. Take a look at shares of Amazon. We need to highlight those because, first of all, they're acquiring Globalstar and expanding Amazon Leo satellite network. So that's sort of news of the day. But this stock has been on a run. It's up another 4%. It's not that far away from new highs.
That's right.
It is not, Josh, that far away from new highs. In fact, I've got it 3.5%.
Yeah, this is one of my bigger positions personally, and we have an island reversal in the chart. I was emailing with my friend Stephanie Link this morning about it. I can't show you that on screen here because we don't have candlesticks, but suffice to say you have a big gap down, and then you have this kind of consolidation period between 200 and 215, give or take.
Yeah. Give me
and
a
then
month,
you have
guys.
another gap up on the other side. And what ends up happening is the sellers get trapped on that island, so to speak, metaphorically speaking. And you never want to fade an island reversal, a bullish island reversal. And that's exactly what's taken place here over the last year. Now you have a company that seems to have made all the right moves in the AI side. They're also getting more credit for what they're doing on chips. They're involved in Anthropic. They're involved in Mythos. They're talking about selling chips to third parties to alleviate some of the constraint for GPUs. And while they're at it, they've kept costs down in some of their core businesses and maintained a fairly high growth rate for AWS. I really don't know what's not to like. Out of all the Mag 7s, this is my number one favorite chart of the moment.
So you see the move, 20+% over the last month. Alphabet in its own right is less than 6% away from its own all-time high.
Yeah, and it's each Alphabet and Amazon that are driving the performance for mega caps so far year to date. I'm with Josh on Amazon. I think that Amazon will exceed an all-time intraday high.
You don't own that. Just be
soon.
clear. You do not own Amazon,
So
right?
we sold Amazon at the end of January at $239.30.
Right, so that's what I thought.
And on a 12-month basis, Amazon was flat at that point. I would imagine we'll see at the end of the quarter what happens, but based on what Josh is saying,
buy high, sell higher.
Things look
There you go.
Things look really good right now. Alphabet is the other name that I love. Alphabet looks phenomenal, whether it's the YouTube business or really more importantly, it's the tensor processing units that have they've worked on them for the last 12 years, but now they've got prominence in the headlines. So I think both Alphabet and Amazon, those are the two mega cap names that are going to make all-time highs relatively soon.
Jimmy?
You know, I'll just go to where you started this on the Global Star acquisition. Josh and Joe, you've already covered, the big fundamentals. This is a company, Amazon, that has a history of making these acquisitions that seem a little bit afield from what they normally do, but they make a lot of money from it. Think about Whole Foods. Think about MGM. I was in the movie theater this Saturday. I watched Project Hail Mary, and that is an Amazon movie. Go back 10, 15 years ago, Amazon was not in the movie production business. They have this habit. They have a history of building new businesses, and I think the Global Star acquisition, along with their existing satellite and rocket business, is going to be terrific.
What about Alphabet?
Big Gosling guy.
Love Alphabet. Alphabet, as we know, had a great 2025. I actually came into this year, and I said it on air, that I think Amazon will do this year what Alphabet did last year.
Let's go 1 month on Alphabet, because it's been on a similar trajectory, not as obviously strong, but we'll go 10% in a month.
Yep, and I think actually if you take it back to the start of the year, that what you saw at the start of the year was a lot of profit taking. I did a little trimming at the beginning of the year. It just grew to be too big. But now the fundamentals are there. And for a lot of the things that Josh was talking about, it's not just the Google services, it's the chips that they're making as well, in addition to their bread and butter businesses of YouTube, of Waymo, of search, et cetera.
Okay.
Meta's coming on strong as well. Meta's up 16% for the month. So right now it looks like it's NVIDIA, it's Alphabet, it's Amazon, and it's Meta.
Meta, I think, is off its best week in like 2 years. All right, so we'll take a break. Belsky's got some new buys, right? New buys.
New buys, brand new buys.
Brand new buys.
Brand new buys.
All right, so we're not talking like...
We're not confusing trims.
Portfolio A versus F versus G, H,
Brand
and Z.
new.
Like,
Fresh
just straight new
ideas.
buys.
Fresh.
All right, good. Thankfully. And Jimmy has a new buy, too. Well, it's buying more of something that he really likes. We'll tell you that next. Welcome back. I told you about the committee moves we have. Brian Belsky has several new buys, one of which, it's always kind of awkward when it's our parent company, Versant Media. We're happy to have you as a shareholder. I'll say that, but I don't
Why?
need to.
Yeah, they're like, why?
Yeah, well, because we got it going on. I don't know. Well, just tell me about the other ones.
Okay.
Tell me about the other ones. It feels like self-serving to have you do that.
No, I mean, let's just say I love the communication services sector. And I think cash, content, and consolidation. And Versant fits all of those themes. So let's move on.
Okay, so Versant Media was on the list. Mobileye.
Yep.
Revolve Group. What is that? And Cognex and Gates Industrial.
Mobileye's autonomous vehicles.
I know what Mobileye is. What's Revolve Group?
Revolve is an online retailer where the Gen Zs are buying stuff, and I think that's going to be a big thing for them. Cognex and Gates Industrial are two industrial companies that really focus on robotics, and we're adding all of these names to our small mid-cap portfolio because, as you mentioned at the top of the show, small cap stocks have been ripping. We think you need to own more names overall, so we're going to continue to add more names as we go on, and 3 or 4 new names a month.
Okay, appreciate that. There's the rise in Mobileye. Jimmy bought more Win.
I did.
Right?
I did. You know, I took a chunk out of the portfolio, a chunk of Win out back in August at 126. Stock went up to 130. It's now down in the low 100s. And why is that? Because estimates have come down, understandably, with everything going on in the world. I think the estimates are too low for Las Vegas in particular, where Wynn really is the top-end resort. And they, you know, look, as much as we talk about traffic going down to Las Vegas, Wynn keeps its traffic up. And then they do have this Abu Dhabi resort, which is a main reason that the stock has come down over the last month and a half. It's being built. It's going to open next year. And by then, I think the hostilities will have died down. It should be a moneymaker.
I didn't get to one of Brian. So you sold Warner Brothers Discovery. Was this a swap?
1 for 1.
Versant.
Yep.
In
1 for 1 switch.
Warner Brothers.
Yep.
Out.
Warner Brothers out.
Because the event has happened.
The event has happened. We think it's going to go through. At the end of the day, we kind of like the turn. We like this Versant company in terms of where it's going and where the content is.
Okay. Okay. We do too. Yeah, I'm just throwing it out there. We're happy to have you, B. All right. Mike Santoli's next. Senior markets commentator and overtime co-anchor Michael Santoli is here for his midday word. This market just wants to go up. I don't know. What else can you say?
Well, that's for sure. And I think it sort of gains confidence that we're in the post-crisis re-risking phase at this point. Certainly on a short-term basis, some things looking like it's running pretty hot, but that's kind of what you want to see. You want to see the market able to get overbought on a tactical basis, and that probably means maybe the turn has come.
That's one of the notes that was out today. It's like the biggest risk right now is overheating in the stock market.
In the very short term, yes. I mean, I think you did get much more of a cleanup in positioning that it's a while before people are genuinely back over their skis. The thing is, and I guess we'll have to deal with this down the road at some point, is as much as you want to map last year's experience onto what we're doing in terms of the tariff panic and the comeback, you just didn't reach the same kind of depths. Therefore, probably just means you're not going up 40% in 6 months, which is exactly what happened from the lows last year. The other piece of it, I know, Joe was talking about the growth theme is really dominating right now. It's absolutely true, and it's also re-narrowing. Okay, even though breadth in terms of the number of stocks going up versus down has been very strong on this comeback, it's really what's driving the indexes are the few and the dominant. Everybody was so happy about the broadening going into the peak, and 60% of all stocks are beating the S&P. You know what it is in the last month? 29%. And people feel better about it, and the VIX is down to 18 because that's how it works.
Software. I mean, people feel better in part, I think, about the makeup of the market, but because look at what software has done this week. Palantir's up 6%, Salesforce is up 5%, Snowflake's up almost 13%, IBM's up a bunch. We showed the IGV. A lot of the names within that universe have had a nice little comeback. It's not confirmation of anything yet. However, it's what you would really like to see.
Well, sure, because what it is confirmation of is you absolutely, in this re-risking process, you're just penalizing shorts of all sort, and people have to just liquidate on that side. You're still at 80 on the IGV. I mean, the lows are like 75, 76, and so it needs to prove a lot more.
Oh, for sure. But you got open at 77 we were talking about,
Yeah.
like Krinsky was highlighting. 77 was an important line in the sand.
Right. So I mean, we spent enough time maybe digesting the problem parts of the market. Again, we're still at these really familiar levels. Let's remember, 6,900, 7,000. We spent months there going into the downturn.
All right, good stuff. I'll see you on the bell. That's Mike Santoli. Finals coming up after this. All right, welcome back. I want to call your attention to CNBC's next big event. I will be in Singapore next week at Converge Live. We'll be speaking with some of the world's brightest minds shaping the future of business, sports, and entertainment. And for more details, you can go to convergelive.com. We'll do finals next. All right, we'll see you on the closing bell at 3 o'clock Eastern Time. Richard Saperstein, Bryn Talkington, Warren Pies, Rich Clarida, Bill Miller IV, and Alexander Wilson Elizondo of Goldman Sachs. We're going to have an interesting market to talk about, too, as the S&P is less than 0.75% away from a new all-time high, which was 7,002.28. Josh Brown, final trade.
Uber hiding in plain sight, 30% growth next year, 15 times earnings.
Who's got Wells?
I do. Wells Fargo, I believe in the turnaround, especially within capital markets and wealth management.
Okay. Jovial Jim, Jittery Jim's
Jim.
left.
Happy Jim.
Happy Jim?
Jovial Jim.
Jumpy Jim?
Jovial Jim's fine. Listen, if we're seeing the IGV come back, that would imply that maybe private credit isn't so bad. Look at Apollo Global.
Okay.
Jimmy told us to listen to the message of the market. On the first day of the conflict, I bought CF Industries and I bought the Israeli ETF. Israeli ETF all-time high today. What's the message in that market, Jimmy?
Okay.
Go long.
Good stuff. I'll see you on the bell.
All right, thanks very much, Scott. Welcome to The Exchange. I'm Dominic Chu in for Kelly Evans today. Stocks are higher at this hour with that tech trade and small caps leading the gains, both up more than 1.5% at this stage. Software is having another big day, and I mean big one. Oracle is building on yesterday's gains, up another 4% on the session, with deal news alongside Bloom Energy now up 18% over the past 2 days. All of the Mag 7 are higher now. Apple had been lagging for most of the day, but is now in the green, as you can see there as well. Autos and airline stocks seeing nice gains on a combination of news, including analyst upgrades, merger rumors, lower oil prices, all helping the story there. And the momentum trade going strong with the iShares Momentum ETF hitting a new all-time intraday high. Bloom Energy, Credo, Robinhood, your outperformers in that trade so far. But we're going to begin with the markets as the S&P fully erases all of its Iran war losses. The Nasdaq is now up more than 4% since the war, and the Dow just barely negative. Our next guest remains bullish from here and sees the markets climbing by another 5% before July, before growth starts to then slow down, perhaps. Here with me now is Oh-Sung Kwon, the chief equity strategist over at Wells Fargo. This conversation has been daunting. I mean, if you look at the way markets have performed, who would have thought that now at this stage with the war still going, that if you looked at the indices, you'd recover most of the losses, if not all of them, and those people looking at their 401k balances are pretty much back to where they were at the end of February. What happened?
Yeah, I mean, this basically shows that the market and the economy are largely insulated, at least for now, from the oil shock that we saw from Iran. I mean, if you look at oil intensity of the economy, it's down 75% since the 1970s. And only 1.4% of S&P's OPEX is coming from oil, even at $100 oil. And that's basically in line with the late 90s level when oil was $20, adjusted for inflation. So, I think there's still a lot of tailwinds from the fiscal stimulus from One Big Beautiful Bill that's going to provide cushion, at least for the next 6 months. And I think the market's going to be on a sugar high for the next 3 months.
So the sugar high is interesting because, as you point out, energy does not have a massive influence on the markets. It's a very small sector compared to the other ones in the S&P 500, but it has been a massive outperformer. We are seeing a catch-up trade happening with technology amid the sell-off that we saw, not even since the war began, but even before then. What exactly has been propelling that interest, renewed interest in tech, and can it last this time?
Yeah, I mean, the answer to your last question is yes. I think tech is going higher. We like the hyperscalers, the Mag 7. We were bearish hyperscalers for the past months. We turned bullish recently, a few weeks ago, really on the idea that their free cash flow might be inflecting higher. And that was really the reason why we were bearish before that. That free cash flow estimates for 2026 for the Mag 7, the hyperscalers, has been cut by 70% over the past year. And now our analyst actually thinks that that number is inflecting higher because their top line is about to accelerate going forward. There's a lot of capacity that's coming online, and everyone still says demand outpaces supply. And if that's the case, I think revenue is going to accelerate going forward. And the biggest conviction that I have is the compute power is only going higher. AI is really good. That's essentially what the market is saying through software stocks. And if that's the case, hyperscalers probably now overinvesting, and compute power, we're just going to need more compute power going forward.
But that story was also there, to be fair, over the past 6 months, and certainly since the record highs in the Nasdaq that we saw back in October. But there was a souring sentiment about AI, about free cash flow, about OPEX, and everything else that was going to happen with there. What exactly then, sentiment-wise, could change? What exactly was the big catalyst for the shift in narrative away from the bearish side of AI, more towards, hey, maybe it's right-sized and growing?
Yeah, so that happened already. We already saw 70% estimate revision down in free cash flow already. We think that's inflecting higher going forward, which is going to be the positive inflection for sentiment. Also, sentiment was really bearish for hyperscalers for the past 6 months. And that was really the funding short for a lot of hedge funds. And valuation has contracted by about 30% already at the lows for the Nasdaq. So I think this was a valuation reset as well as the positioning reset that we saw in March. And now, I think the risk is to the upside going forward.
All right, speaking of the reset, one of the consensus trades that we saw play out over the course of the past several months, maybe even going back to April at this point, was this idea that some folks out there, a lot of folks to be honest, were long semiconductor names and funding those long positions by borrowing and shorting software names. Mm-hmm. The divergence was massive. It was starting to close at one point over the course of the past couple of months. Do you see that tech trade being that kind of massive split again between hardware type names and software type names?
Yeah, we like the Nasdaq more broadly. And you're right, over the past, it's almost been 3 years since semis really started outperforming software. I think software to me is more dead money. I think there has been a significant valuation reset. I mean, we have a funny chart that shows that software now trades in line with department stores, right? So basically, the retail disruptees versus the digital disruptees are trading at the same multiple. So that's how much software has derated already. That being said, I don't really see that much upside catalyst in software because it wasn't really earnings driven, right? Earnings continue to get revised higher for software, but the stock continued to deteriorate. So I still like semis over software, but the broader theme that we have is we think AI bull market is maturing from a capex driven bull market to a monetization-led bull market. So I think we're heading into a healthier phase of this bull market.
Does this then mean that that so-called broadening out trade for value cyclical sectors is pretty much done, the ones that had been outperforming tech over the past 3 to 5 months?
I think for the next 3 months or so, I think a lot of stocks are going to rally together. But as you think about the second half of the year, and that was really our view heading into this year, we said the first half of the year is really going to be driven by reflation, and the second half of the year is going to be back to AI. And we see the same thing happening still. I think that trade is still intact, that we see more risk to growth in the second half of the year. So there's usually about a 3-month delay between the oil shock and when growth starts to deteriorate. And that's essentially when the One Big Beautiful Bill tax return money gets wiped out in about 6 months. So I think I see more risk to growth in the second half of the year. And if that's the case, I think the reflation trade that really drove value and cyclicals earlier this year is probably going to slow down as you move into the second half of the year. And we're back to AI again.
This conversation about the second half of the year will have to continue with us next time because it's a midterm election cycle as well, all kinds of variables. Oh-Sung Kwon at Wells Fargo, thank you very much.
Thank you.
We appreciate it. Okay, now tech momentum is continuing with the NASDAQ closing higher for a 9th consecutive session yesterday. That's its longest daily winning streak since December of 2023. And as we pointed out, software is making a notable turnaround after a sharp sell-off earlier this year. The IGV software ETF is posting its best day in over a year. So what's the setup for that sector heading into earnings? For more, let's bring in Gil Luria, the head of technology research over at D.A. Davidson. Gil, this is an interesting conversation because Oh-Sung and I just chatted about software. He calls it dead money. What exactly is the view from your side of things? Let's see if we can get a debate going.
Well, I'll contradict that in a second, but I'll agree with the broad statement that I don't see why the narrative around all of software is going to change. AI, the tools are very powerful and they keep coming out with more and more interesting things. So I'm not expecting a broad change in narrative, but there will be groups within software, individual companies within software that are able to do very well. There's software companies are going to have accelerating growth for the balance of the year. Think Microsoft, Oracle, Snowflake, Datadog. There's going to be pickup in M&A. Think of some of the sellers as being Dynatrace, JFrog, Elastic, GitLab. And then there's also going to be a category of companies that eat their own food. I won't say dog food, they eat their own food and start using AI to really reduce cost and generate a lot of upside to earnings. Think companies like Amplitude, Braze, Zeta have a lot of room where as they deploy AI internally, their margin's going to go up very significantly and they could have very big beats. So those 3 categories of stocks, revenue acceleration, M&A, and earnings upside, those stocks can perform very well for the balance of the year since they're all starting at such low valuations.
If those low valuations are there and that attractive right now, and you have to be that hyper-specific about the places within software that you have to do it, does it then mean you have to be a little bit more active with regard to how you allocate towards that software trade? In other words, I could just buy IGV or I could not. Is this now the quote-unquote stock picker's market?
Yes. On the software side, it's a stock picker's market. It's not an IGV call. When you start talking about chips and data center, that's a really broad call that the positive inflection in AI and the usage and the ramp in the results of some of these frontier model companies, that's going to have broad benefits across chips, NVIDIA, Broadcom, AMD, Micron, et cetera, where on the IGV side, the narrative will remain negative for a while It's just specific companies that can outperform this year for the balance of the year.
All right, now your coverage universe is rather expansive. So as you kind of tier out, you decile out, you quartile out the coverage universe, are there extreme favorites that you have in this? Should we be still looking at some of those larger mega cap type software names, or do we have to become a little bit more idiosyncratic with regard to some of the smaller mid cap names that might have more upside potential because of their earnings growth trajectory?
I would argue that some of the best performance should come from the very top. To the point of the conversation you had earlier, some of the mega caps have really underperformed over the last few months. So now you have a situation where Microsoft and NVIDIA are trading at market multiples. These are the two companies that have captured the most value in AI and will likely continue to capture the most value in AI. And they're going to grow very significantly. Microsoft close to 20%, NVIDIA somewhere between 40 and 60%, and yet they're trading at a market multiple. So those may actually be the best opportunities, since it's very unlikely that AI will be successful with without those two companies.
All right, hyperscalers and NVIDIA is still a focus there. Gil Luria of D.A. Davidson, thank you very much. We'll see you soon, sir. All right, coming up on the show, day 2 of bank earnings season, failing to impress investors. Citigroup is the only name in the green on that board so far, but why is the group lagging? Is it bank-specific or a possible canary in the coal mine situation? That story's coming up next. And as we head out to break, some nice gains across the alt asset space. As you can see there, a Blue Owl private credit fund raising $400 million from bond investors, marking the first deal of its kind in over a month. Shares of Blue Owl, as you can see, they're up 7%. Ares and Blackstone on the private side of things also higher as well. Moves higher for private capital. The exchange is back after this.
This is The Exchange on CNBC.
All right, welcome back to The Exchange. It's been a mixed trade so far for shares of JP Morgan Chase, Wells Fargo, and Citi following their respective earnings reports. So Leslie Picker joins us now to dig into those results and maybe why some of the idiosyncratic points are sticking out for certain investors, especially when it comes to, say, a Wells Fargo versus a Citi, Leslie?
Yeah, you're spot on, Dom. It's very much the micro that's the story this quarter. Wells Fargo, the biggest laggard this morning, today, down about 4.5%, with misses on the top line as well as for net interest income. That's, of course, that profitability metric for loan making. Rates causing J.P. Morgan to pare back its NII guidance for the year, now back to $103 billion, including markets. Citi outperforming. You can see up 3% right now, with beats pretty much across the board there, although provisions for loan losses a bit higher due to credit cards and a reserve bill. Speaking of credit quality, a lot of commentary across the calls today and yesterday about private credit. J.P. Morgan chairman and CEO Jamie Dimon saying, quote, the actual credit hasn't gotten worse, although he said there are pockets where it has.
I don't think it's systemic, but I do think with the credit cycle, and I'm not referring to private credit here, because of underwriting and leverage and picks and competition, and we've had a cycle for a long time, a lot of people are late to this game. I just don't expect every player is going to be the same. I think it won't be a bell curve. It'll be something different than that, and people are going to be surprised that some of the players aren't particularly good at it.
Wells Fargo including a new slide today detailing the granularity of their private credit exposure. The firm disclosed $36.2 billion of loans to private credit funds out of about $1 trillion balance sheet. Software comprising 17% of that private credit collateral. Business services is about 19%, and healthcare 15% for Wells Fargo exposure. Now, tomorrow we'll round out the big bank earnings with Bank of America and Morgan Stanley. John.
All right, Leslie Picker there with the state of play on banks early in the season. Thank you very much for that. Financials are the worst performing S&P 500 sector so far this year, down by more than 5% since January. Our next guest warns that if banks cannot rally on the back of strong earnings reports, it would be a canary in the coal mine sign for the overall economy. For more on that case, let's bring in Victoria Green, G Squared Private Wealth CIO. She's also a CNBC contributor. Victoria, thank you so much. Leslie laid it out kind of very well here with regard to the early part of the reports in this season. What exactly is the canary in a coal mine aspect, if it's NII related, net interest income, if it's loan loss provisions, if it's outright capital markets beat and misses? What exactly would you be watching out for?
Sure. It's just that sometimes where the financial sector goes, the S&P ends up following it later, especially if you look at different crises that came from the credit side of the world. Obviously, 2008, financials were famously selling off. In 2007. We all ignored that. You go back to 2011 when we had the Euro crisis and the debt crisis, financials again front ran that a couple of months. And then obviously with the Silicon Valley banks, you were already seeing stress in the banks before the market followed it. So we are watching this. Is this a canary in the coal mine moment? Are the financial sector telling us, hey, there's more stress in the system? That's why we're not able to rally, because we are concerned of a credit event. And obviously the whole elephant in the room here is what's going to happen with private credit. And they wrote coming off of COVID, when everything was dirt cheap and you had a bunch of capital pouring into these sectors, and everybody started writing and not really doing his best underwriting in 2020 and 2021. And I think we're starting to see some of the loans hit those books right now. I mean, you just saw Red Lobster today. I think I saw that article that they wrote that down from 98 cents to zero just today.
So credit cycles are certainly something people are focused on vis-a-vis that bank trade overall. Gil Luria, we spoke to him earlier about the tech trade, and he mentioned that this is certainly more of a stock picker's market than just, say, buying a sector or industry ETF. When it comes to the financials, your view is, are we safe just buying bank ETFs or financials ETFs, or do you have to become more granular about how you pick these particular stocks?
Absolutely, you need to be granular. And look what's happening today between Citi and Wells Fargo. One company that's executing well on their turnaround, another company that's struggling, even with a lot of the regulatory constraints behind it. Wells Fargo disappointed everybody today. Citi executed well. We saw Goldman stumble yesterday with their fixed income and currency trading, but their equity trading and deal making was so strong. And JP Morgan struggled a little bit today with net interest income. But again, $4 trillion, huge bank. We always consider JP Morgan our port in the store bank. If you want to own a bank, you own JP Morgan, right? You own Goldman for their trading and deal making, and now you're looking at Citi as a potential a very strong hold here in the financial sector. I think you do need to be picky. You need to understand their exposure and what are their drivers of this revenue? How durable are these revenues and the trading revenues that they just generated in Q1? Can they continue to execute on this for the rest of the year? And the markets have been mixed on that. So I think some of this is saying, okay, what are you going to do for me going forward? If net interest income compresses, we don't get any, the rate situation doesn't help you whatsoever. We have some credit concerns. We have some pressure on consumer spending. What is this going to do for bank earnings? And I think you're seeing that with some of these reactions today. So be picky. I tend to lean a little bit more into quality whenever we see times of stress. And I'm not going overweight yet. It's the second largest sector in the S&P 500 at about 12.6% weighting. It's not an inconsequential sector. I'm not moving overweight yet. I think there might be a little bit of a washout as we see what plays out here with private credit.
Victoria, if I could ask you for your top pick within those banks and the one that you would stay the most away from, what would they be, both sides of the spectrum?
For me, I love JP Morgan. I'm going to ride or die with them for years. We've been a long-term holder there. Just such a quality bank and such a well-run bank on risk management. Hopefully, Jamie wins his argument against Basel III regulations and they get their $20 billion back. On the other side, the ones I don't want to own, not a big fan of Wells, not a big fan of some of the others like Capital Farm, or not Capital Farm, I apologize, Capital One. On the lower end, on the banking or Ally, I think they're going to see a little bit more stress and a little bit more stress on their consumers than, say, an upper-end echelon bank like a JP Morgan Chase.
All right, Victoria Green, G-Squared Private Wealth on the bank trades. Thank you very much for that. Coming up on the show, Bloom Energy shares are soaring and pacing for their best day since October as Oracle extends its deal to buy fuel cell power from that company. What the move means for Oracle coming up next. The Exchange is back after this. Welcome back to the Exchange. We're going streaking. Well, the markets are anyways. As things currently stand, we are on pace for what could be 10 straight days worth of gains in the tech-heavier NASDAQ 100 index. Now, during that span, the Invesco QQQ ETF, which tracks that index, has gained roughly 12% in that move higher. And we're just, again, just a few percentage points away, 1.5 percentage points away from a record high that we saw last time back on October 29th. Now, one of the big drivers of that tech trade has been those computer chip stocks, as we alluded to earlier. The VanEck Vector's semiconductor ETF, ticker SMH, is also on pace for its 10th straight daily gain. And during that streak, that fund has doubled the 10-day return of the NASDAQ 100 ETF because this run is 24% on that move higher. And then continuing on that streaking theme, some of the most important stocks behind those index moves have been on tears as of late. NVIDIA and AMD are both working on their own 10-day winning streaks. Amazon is working on a 7-day upside run. And then Facebook parent company Meta Platforms is on pace for a 6-day run of its own. Qualcomm and Netflix are both on 5-day runs. You get the idea here, so keep an eye on those big winning streaks. Now, Oracle is expanding its deal with Bloom Energy just days after receiving a $400 million stock warrant. The news is sending shares of both stocks higher today. Our Seema Modi has the big story in that big power tie-up. Seema.
And it's a big one, Dom. Oracle deepening its relationship with Bloom Energy underscores the insatiable demand for energy security. As the latest chips do require more power, the hyperscalers are in a rush now to ink more deals with energy providers to get that on-site power generation. Take a look at Google with Total Energies, Meta with Constellation, Amazon with its nuclear small modular reactor partnership. Oracle's tie-up with Bloom specifically builds on a July agreement when the two companies first came together to bring fuel cell technology to power its data centers. Experts highlight the benefits of fuel cells. They're quick to implement, reducing the likelihood of delays, less noisy than generators, and more environmentally friendly. Analysts say that is key given the recent pushback from local and state jurisdictions. Case in point, Maine looking to implement a statewide ban on data center construction. But this deal, Dom, suggests Oracle is not slowing down its AI ambitions. $50 billion in debt and equity being raised, a new chief financial officer who brings in deep experience in power and energy from Schneider Electric. The company continues to put money where it sees opportunity, and that is AI, and the market is responding positively.
How much, Seema, have investors either moved away from or evolved their views of the capital spending picture and some of the maybe capital structure adjustments that have to be made at Oracle with regard to debt and equity finance raises and everything else about paying for all of this?
Well, following that $50 billion debt and equity raise that was announced in January, the company then in February said it had no plans to raise additional debt this year. So since then, the conversation has shifted to what are you spending the money on? And I think this deal with Bloom Energy is reflective of how Oracle sees energy as a key priority as it looks to expand its data center pipeline and become more competitive with other hyperscalers that, as we were just mentioning, are also investing in on-site power generation. So the conversation now is expanding, Dom, around CapEx, not just to the GPUs that all these hyperscalers are buying and borrowing, but to what type of energy resources they have to ensure that these data centers can be powered up and be able to run these AI models.
The power play in AI vis-a-vis Oracle and Bloom Energy. Thank you very much, Seema, for the report there. We appreciate it. Now to Pippa Stevens for a CNBC News update. Good afternoon, Pippa.
Hey, Don. Former White House Chief of Staff Mark Meadows is asking the Justice Department to reimburse him for legal fees he incurred from investigations into President Trump. That's according to CBS News, citing sources familiar. Meadows was a key supporter of Trump's efforts to overturn the 2020 election. The request was made by his attorney in early February, according to the report. It is not currently known how much money Meadows is seeking or whether the DOJ plans on honoring his request. Harvey Weinstein is once again going on trial on a rape charge in New York City. Jury selection is set to start as soon as today. Jurors will weigh for the third time whether he sexually assaulted Jessica Mann in 2013. This time around, the focus will be on only one charge based on one accuser rather than multiple allegations. And a former advisor to Mike Pence is launching a bid for Congress as a Democrat. Olivia Troy resigned from the White House in 2020 and became a vocal critic of President Trump. She's set to run in Virginia's new 7th congressional district and faces a crowded primary field. Dom, I'll send it back to you.
All right, Pippa, thank you very much for the news update there. Coming up on the show, more U.S.-Iran peace talks reportedly are in the works, while Israel and Lebanon are at the negotiating table for the first time in decades. The latest and what it could mean for the U.S., its involvement in the Middle East, and everything else next. The Exchange is back after this. All right, welcome back to the show. Secretary of State Marco Rubio is hosting a meeting with the ambassadors of Israel and Lebanon in Washington, D.C. today, while another round of peace talks between the U.S. and Iran is reportedly in the works. Megan Casella joins us now with the latest on all of the meetings and progress. Megan.
Hey, Dom. So these trilateral talks with the U.S., Israel, and Lebanon, these are aimed at clearing up what has been a major sticking point in the U.S.-Iran negotiations, and that's Israel's ongoing attacks against Hezbollah in Lebanon. Secretary of State Marco Rubio sat down with Israel's and Lebanon's ambassadors to the U.S. earlier today, and he told reporters that the meeting was focused on bringing a permanent end to Hezbollah's influence in the Middle East. Now, Rubio acknowledged that nothing would be solved today, but said that the goal was to build a framework that could ultimately lead to resolution. The immediate question, though, is whether Israel can be convinced to at least pause its attacks in Lebanon. Remember, Iran believed that was part of the ceasefire deal. Israel has insisted it was not, and that disagreement is one of the biggest threats to the fragile truce that we're in now. And then, in the meantime, the U.S. is carrying out its military blockade of Iranian ports. And U.S. Central Command said in a statement this morning that in its first 24 hours, no ships made it past the U.S. blockade, and 6 merchant vessels complied with direction from U.S. forces to turn around and re-enter an Iranian port on the Gulf of Oman. And then, Dom, as for the path forward, a number of reports out now about what meetings may or may not be scheduled. For now, a White House official telling CNBC that a second round of talks between the U.S. and Iran is under discussion, but that nothing has officially been scheduled. Dom?
All right, Megan Casella there with the latest on the state of play vis-a-vis the Middle East. Thank you very much for that. Now, oil is slipping below $93 a barrel on the possibility of a second round of those peace talks with Iran. Our next guest expects the ceasefire to be extended as negotiations continue, but also says Iran will get more aggressive if the blockade is still in place when the 150 million barrels of its own oil currently on international waters and the revenue that goes along with it are depleted. So joining me now for this conversation is Jonathan Panikoff, director of the Snowcroft Middle East Security Initiative at the Atlantic Council, someone we turn to for some color and context on the Middle East. Jonathan, you heard Megan's report here with regard to just what could happen between the U.S. and Iran. How critical is Israel and Hezbollah to this conversation about the U.S. and Iran and the Strait of Hormuz?
Great to be with you. Look, it's probably not going to rise or fall on the Israel-Lebanon conflict, but it's going to be part of it. The reality is, if Israeli strikes continue, then it frankly gives another excuse for Iran not to engage in negotiations. It becomes another sticking point. I don't think the issues between Israel, Hezbollah, Lebanon more broadly have to be resolved, but they probably do have to be tamped down. And I think that's what Secretary Rubio was aiming at here, to try to create a situation where there's at least enough space for U.S.-Iran ceasefire talks to be able to continue without the Hezbollah-Israel long-time war somehow interfering.
Just how much influence and how much capital does the U.S. Secretary Rubio and others, how much do they need to spend on Israel and Hezbollah vis-a-vis this? Do they make this a priority? I know it's part of the puzzle, but just how much effort goes into something like this?
Yeah, I think it's going to be enough to try to get them to both take a break. In other words, look, on the Israeli side, the U.S. clearly has significantly more ability to influence this in the near term, not the long term, but the near term, given how close the U.S. and Israeli militaries have been working together related to the Iran war, the relationship between Prime Minister Netanyahu and President Trump. I think the U.S. really feels like, look, if it can get Israel to stop strikes in Lebanon right now, then it's most likely that Hezbollah will also halt as well. But it's not a guarantee. And the reality is, Lebanon, the state of Lebanon, has very little control over Hezbollah. It's been a long-term problem. It's been a long-term frustration by the U.S. and by Israel that, frankly, the Lebanese armed forces haven't been more aggressive in trying to take on Hezbollah, especially over the last 12 months.
Jonathan, we're showing oil prices right now, and the way that they're moving, it maybe somewhat implies that things are cooling off a little bit with regard to the aggression, and maybe this idea that the U.S. now effectively asserts control over the Strait of Hormuz without any kind of international coalition backing it up. That implies now that the only two players involved in the Strait of Hormuz are basically the U.S. Navy and the Iranian Revolutionary Guard Corps. Is that a safe assumption to make? And if so, how exactly do the scenarios play out with both the U.S. and Iran trying to control the strait?
I think it's a safe assumption for the short term. In other words, look, right now, I think there's another week left in the current ceasefire. I do think that there's potential that if negotiations, either in the next couple of days or this weekend, do go ahead and start to make progress, you could see an extension of that. And so you also combine that with the fact of what you said up top. The Iranians have over, I think, 157 million barrels of oil on the water right now. So revenues aren't going to be cut off immediately. But if you don't get an agreement and you have a situation in the next 2 or 3 weeks where there's a challenge because the Iranians don't have any revenue coming in, they can't get oil out, then all of a sudden, I think they're going to be faced with a decision about whether they need to increase the costs to the U.S. and to international allies and Gulf allies, and that means striking regional Gulf energy infrastructure, means going after the U.S. And so the blockade right now is in its very early hours, frankly, and it's obviously limited to Iranian ports. You're going to see ships going in and out, in theory, that can go to the UAE or Oman. So the question still becomes how this plays out. Right now, I think nobody's willing to really heavily break the ceasefire. I think they want to see if negotiations can create the opening to move this conflict and to end it. But if it doesn't work soon, it'll get more difficult in the long term.
Jonathan, this is a much bigger, I mean, we don't have the time to go through all of it, but I wonder, is there a scenario ever in the future where the Strait of Hormuz functions more akin to what's happening with the Suez Canal? Is there anything that can happen that makes this a commercially viable and at least a cooperative agreement to kind of keep the Strait of Hormuz open for a passageway like we see in other parts of the world?
I think it's possible it's going to be a challenge. I mean, this is now all of a sudden strategically the best leverage the Iranians have had in years. And they've shown that not only can this impact the US and Europe, that this impacts the entirety of the global economic and commercial trade, maritime efforts, frankly, to go through the straits. And so they're going to be hard pressed to just trade it. I think this comes down to a question to them, therefore, long term. Look, do you have to have an international coalition, even if European states, East Asian states resent how they were pulled into this? Do they have no choice that in order to keep the strait open in the type of Suez-like effort that you're saying, that they engage? And so even if the Iranians take some money, or you have a toll road that it's not completely free like it was before the conflict, at least it's navigable. At least people know with confidence that their ships can get through. Insurance companies know that the ships will get through. They're not going to be under permanent threat. All of that is still to be worked out, and it's a real challenge going forward.
All right, benchmark crude prices, as you can see on the screen, they're drifting towards session lows right now. Jonathan Panikoff with the Atlantic Council, thank you very much, sir.
Thank you.
All right, coming up on the show, Maine's data center ban, just one example of the growing AI backlash that's out there across the country. We're going to dig into the shifting sentiment around that tech trade as major players like OpenAI and Anthropic prepare to try to go public. And speaking of OpenAI, shares of Novo Nordisk are up more than 3% on news it is partnering with the AI startup to, quote, bring new and better treatment options to patients faster. Novo is on pace for its best day in 2 weeks. The Exchange is back after this. All right, welcome back to the exchange. From data center bans to plummeting public perception, AI companies are facing increasing backlash ahead of what could be historic public debuts. Kate Rooney has more on today's Tech Check on data centers and AI. Kate.
Hey, Dom. So the mood around this technology is increasingly negative. Investors do see that as a real threat as OpenAI and Anthropic especially look to go public. Plus, you've got big tech, which does plan to spend hundreds of billions of dollars just this year on that data center build-out. The latest signal, an attack on OpenAI CEO Sam Altman. A man is now facing attempted murder charges after throwing a Molotov cocktail at Altman's San Francisco home. Prosecutors say it was motivated by a hatred of AI. Altman did respond to this over the weekend, acknowledging anti-technology sentiments. He says, clearly, this technology isn't good for everyone. He and Anthropic CEO are among those in tech that have warned of widespread unemployment and some social unrest as this technology really takes off. Feelings, though, around AI do appear to be getting worse nationwide. You've got recent polls from both NBC News and Quinnipiac showing more than half of Americans now say the risk of AI outweighs the benefit. The tech, they say, or at least according to these polls, will do more harm than good. Pew shows some similar trends. And that is all, Dom, spilling over to the data center build-out. 48 projects totaling at least $156 billion were blocked last year, or at least delayed, according to some sources, ranging from local opposition. You had litigation as a cause as well. And in just the past week alone, you've had a handful of projects been called off. You had a $6 billion Missouri plan, and then Maine moving forward with a statewide data center ban. It does come ahead of midterms, where AI is also expected to come up in that and really be on the ballot as a key issue. As for some of the companies and the impact, I mentioned OpenAI at least has framed compute, which does include data centers, as a strategic advantage as they battle Anthropic. You have the hyperscalers, Amazon, Google, Microsoft, also have major data center commitments. And then finally, the IPOs. So OpenAI at least has told us that it is going to be reserving a portion of its eventual allocation in an IPO for retail investors, where, Dom, you know better than anybody, sentiment really matters when these are publicly traded names.
Absolutely, Kate. There's no doubt about that. Speaking of that sentiment and that kind of public relations aspect, I've spoken to at least a couple of data center CEOs who keep telling me that, a lot of the reason why people have this fear is that there's a gap in information about what data centers really do versus what the public understands or knows. How exactly does that kind of reconcile ahead of this big election season?
I think that is a good point. You're seeing it on sort of a micro level, on with these pushbacks on the data centers. If you go to any of these data centers, it really is an empty warehouse with a bunch of computers. Essentially, is a way to think about it. The issues you hear are noise. You hear about the community impact, what the jobs are actually going to look like, and you're seeing some of the companies really try to get ahead of this. I think of Amazon. It's got a $25 billion statewide project that they just announced. And they really, the first thing they say in these press releases is, hey, we're actually investing in STEM. We're going to make sure that energy prices don't go up. So you do have this disconnect. A lot of this is going to be on communication on the company side, saying, hey, here's the actual impact. Here's what we're doing to also make sure that there is not an impact. Energy prices is the other big one we should mention, where people are worried, where they see a data center go up and say, wait a minute, what is that going to mean, for my PG&E bill out here, for example? So I think that the companies, there's a big onus on them. And then also on the political side, is it politically popular to fight back against a data center? And I do feel like we're moving towards that with the midterms, and it will definitely be a topic of discussion. You're already seeing it in Maine.
A very public debate for sure. Kate Rooney with the latest there. Thank you very much with our Tech Check today. Coming up, American Airlines shares are on pace for their best day since August on reports that United is possibly considering a merger deal. What a deal between the number 1 and number 3 carriers could look like, and would it pass regulatory scrutiny? That coming up next. Welcome back to The Exchange. United Airlines CEO Scott Kirby reportedly pitching a tie-up between United Airlines and American Airlines. Phil LeBeau has the details. Phil, could this perceivably happen?
Theoretically, yeah, anything's possible, Dom, but most people that I've talked with have said, look, it's a long shot at best. And let's be clear here. When you look at this story, the important word to consider is that Scott Kirby has mentioned or floated the idea of a potential deal with American Airlines to Trump administration sources or executives, including the president. Those are the reports that are out there. He hasn't made a deal or a pitch to American Airlines. Both airlines have declined to comment. And again, I can't stress this enough. There are no talks between United and American right now. If American were to be acquired, and I want you to wrap your head around this a little bit, it is the largest airline in the United States. And when you look at its hubs and its market share, we're just showing you 5 of their larger ones here. You think regulators are going to sit there and say, yeah, go ahead, you can take Chicago or Dallas or Miami. They have a huge presence in all these cities. We're not even including Charlotte and Phoenix, 2 of their other big hubs. One thing that United does have going for itself, if it were to pursue this and they were to go to American or to American investors, they could sit there and say, now look, this is not an airline that has been successful. Look at the market cap between United compared to American. No comparison at all right now. Part of the problem here is that American has a lot of debt and it's just not as profitable as United Airlines. Look at the last 2 years. Profitability has soared for United Airlines. That's not been the case at American. United last year, $3.35 billion net profit. What was the net profit at American Airlines last year? $111 million. So Dom, that is the story here. Again, I can't stress this enough. There has been no formal proposal. There's no talks going on here. What this is the word got leaked out, maybe on purpose, that Scott Kirby is interested in acquiring American Airlines and has mentioned this to the Trump administration. As you know, I talked with the Secretary of Transportation last week, and he said, yeah, we'd be open to a deal if it's the right deal and if it makes sense for consumers and for the industry. But we're a long ways from seeing something form and actually take place.
All right, and of course you juxtapose that against the deal that was killed for Spirit and JetBlue, and everything else kind of gets a little bit more confusing there. Phil, thank you very much for the update. We appreciate it. And while a deal between the two airlines is far from certain, as Phil points out, deal-making activity, though, has actually picked up this year, believe it or not. Just today, Amazon announcing it will buy satellite operator Globalstar as advised to compete with Elon Musk's SpaceX. Shares of both Amazon and Globalstar are higher on the news. So joining me now to discuss whether the momentum will continue is Dan Primack, business editor over at Axios. Deal making is happening. It just has been put on hold for the past couple of months given the Middle East and everything else that's associated with it. So can we expect the back half of this year to actually see a pickup in activity, even with growth slowdown concerns and, of course, a midterm election cycle coming up?
Yeah, I think we can. You know, again, things slowed down a little bit with Iran, although it's picked back up again. And again, we're up in the U.S. I think it's about 50-something% this year over last year, which again was the first part of the Trump administration. So it's not like you're comparing Biden to Trump. It's over Trump. And I think the United American thing is kind of instructive. Not, you know, everything Phil said was correct about kind of the consolidation and the market share. But what's notable is that Kirby floated it directly to Trump. And I think that shows kind of this new world in which everybody understands that antitrust now is top down. You don't go to lower level officials anymore. A lot of them at DOJ have either been fired or forced to resign. This all comes from the White House now and from the top. And if you're a deal maker and you can kind of get in his ear, there is value there.
All right, what exactly does it say then about this particular administration and its future, I guess, anti-monopoly type behavior, its regulatory behavior, if in the beginning, when President Trump was first going through the election cycle and got elected this time around, that there was a perceived benefit to companies because of a more relaxed regulatory environment? Has that played out largely in your mind, or will it play out differently in the coming months, given what we've seen from the administration so far?
It has played out. It's ultimately played out. You know, when he got back, for starters, in Trump 1, in his first term, it was actually pretty tough when it came to antitrust, particularly when it came to tech companies. In the beginning of this term, it seemed like that was going to continue. You know, J.D. Vance was very big on breaking up big tech companies. He named Gail Slater as head of DOJ's antitrust unit, and she was considered to be a hawk. but she's out. And it really does seem a bit like the Wild West right now.
All right. What types of deals, what types of industries do you think will get more of a green light in this coming administration?
I don't think it's about getting more. I legitimately think it's kind of across the board. I mean, look at what we've seen recently, right? We saw the HPE deal get done over antitrust approval. That's a tech deal. You see, and this wasn't a deal per se, but the Live Nation Ticketmaster situation, that breakup, at least in terms of as far as the feds were concerned, that got stopped. That's about live events.
Right.
We don't know what will happen in the airline sector, but as Phil said, Sean Duffy did say, the transportation secretary, that they were at least open to tie-ups.
Sure.
And the Biden administration clearly not, because they blocked JetBlue's Spirit, which was a much smaller deal than American United would ever be.
All right, complex for sure. Axios' Dan Primack, thank you very much. Thanks for watching us in The Exchange. Power Lunch picks it up right after this quick break.
The brave bulls that hung on are being rewarded as major markets get back to near all-time highs. Welcome to Power Lunch, everybody. I am Brian. Kelly is on Squawk Box all this week. And your money, it is ripping higher right now. Everything is up. Big tech up about 4% in 2 days' time. We're in the middle of some pretty incredible streaks. In fact, here's one. The NASDAQ is on pace for its 10th straight day of gains. That is something that has not happened in over 4 years. We have got a huge hour ahead here on Power Lunch. More on your money with Michael Aroney, how the data center boom is helping pipeline giant Williams companies, and our friend, the great Halima Croft, laying out how Iran likely plays out from here. Welcome, everybody. It is a huge hour ahead, but let us begin with the fast-moving world of energy. Oil prices, they are down again, about 4.5% to 5%, after Vice President J.D. Vance said the U.S. and Iran could return to the table for another round of talks. A big could, but it's moving the market right now. In fact, oil for June delivery is back below $90 a barrel. Maybe a little bit, a touch of relief for your gasoline prices. But for natural gas, it's a different story altogether. Natural gas prices are still very low. They're at $2.60. They actually moved down since the war began. So what exactly is driving that disconnect? Well, your first guest today can help explain. Joining us now on a CNBC exclusive, is Chad Zamarin. He is the CEO of Williams Companies. They operate more than 33,000 miles of pipeline across the United States and handle about 1/3 of all of America's natural gas. And today, breaking ground on a new pipeline in the tri-state area, bringing gas to the New York area. Also, the company expanding and empowering AI data centers. Here's a video of a project in Ohio. And Chad, glad to have you on set here. Welcome.
Thanks for having me.
Get to the New York thing in just a minute, but I want to pull back, focus on the national story right now. Even as an observer in the energy markets, I'm a little surprised natural gas has not moved higher.
Yeah.
Do you know why?
Yeah, I think it's pretty clear. You know, natural gas production is our country's superpower. We produce 40% more natural gas than we consume domestically. You know, when you talk about liquid fuels, we only produce about 3% more than we consume domestically. So it's no surprise that when global disruptions affect energy, you're going to feel it on the liquid side. Because we're such a dominant producer of natural gas, that is an incredible buffer, and it's going to really protect us from volatility.
Well, it is. So you've got, and we're going to zoom out to global affairs. Obviously, Qatar Energy, Ras Laffan, which is the biggest single natural gas processing facility in the world, it's offline and maybe for years. Right. Okay, I understand they've got a new project that recently opened up with ExxonMobil outside the Houston area. That's a lot of natural gas offline. Is the United States, on the gas side, not oil, insulated from a lot of the global war and issues right now?
Yeah, absolutely. This is the blessing of the innovation of America over the last decade. You know, a decade ago, we didn't export any natural gas to anywhere else in the world. We were importing natural gas. And in fact, we have now, in just under a decade, become the largest exporter of natural gas globally. And when you think about global production, we're the largest now gas producer. We produce about the same as the next three largest countries combined, and that's Iran, China, and Russia. So you think about how important this last decade has become for energy in America. It's been an incredible, but very important, and it does insulate us from a lot of volatility and threat around.
Energy is getting a lot more attention nationally, and there's these things called the midterm elections coming up later this year. I don't know if you've heard about them, but
yeah.
There was an article out somewhere today that basically electricity prices are going to play a big role in maybe how people vote. I don't blame it.
Yeah.
It's been highly inflationary. People want more energy, and they want lower electricity bills. But they also are very distrusting and nervous about more pipelines.
Right.
How do you square that at Williams?
Yeah, this is the challenge. I think we've got to do a better job of educating folks. The reality is natural gas production in the United States, and you mentioned the price for natural gas, it's actually less than it was in 1985. The price of natural gas today, our largest energy resource here in the country. You talk about inflation and affordability. We have an energy resource that is cheaper today than it was 40 years ago, but we haven't been unleashing it to its fullest potential. In many parts of the country, we've been able to maintain low utility prices. That's where we've leaned into natural gas. In the places where we haven't seen the same.
Well, and that's why this New York story, and I understand we've got a national audience, so I don't want to get too regional, folks. Don't worry, I'm not going to dive into local New York politics. But this has been an area that has been worried about pipelines. It's been worried about the climate and the environment. It's been worried about natural gas. This pipeline that's coming into Brooklyn for you guys that you launched earlier today, it feels a little bit like a sea change.
Yeah.
Is it?
I hope so. And it is a message for the entire country. There are many parts of the country that still, you know, we've grown gas demand by 50% in the United States. We've only grown pipeline capacity by 25%. And the markets where we haven't grown pipe, on average, energy prices are 3 times what they are in places where we have. And so this morning was a great day for New York. It's been over a decade. That decade of growth we've seen as a country, New York and New England missed out on it. And so it's been over a decade since we've built new pipeline into New York. We kicked off, broke ground this morning. We had Secretary Wright, Secretary Burgum, Administrator Lee Zeldin, the chair of FERC, Laura Sweat. I think a great day for New Yorkers. It's going to drive down costs, expand economic opportunity. It's going to be the amount of gas that can power over 2 million new homes and businesses.
2 million?
In New York. That's right.
2 million new homes.
That's right.
So when we look at the energy mix in this country, and I know you're a natural gas guy and you're a pipeline guy, so I get it. We've talked a lot with Secretaries Burgum and Wright about wind and solar and about how there has to be an always-on component. Right. If you were in charge of energy policy in America, maybe someday you will be, Chad, who knows? What's the proper mix?
Yeah, look, our company's been around for over 100 years, built some of the country's most important energy infrastructure in that history. We're headquartered in Oklahoma. In Oklahoma, we actually do a really good job. We've got a tremendous wind.
A lot of wind in Oklahoma.
The only way that it works, the only way we keep the lights on, we keep the systems running when the wind slows down is we pick up the slack with natural gas. It is our dispatchable, but also our most affordable resource. So we can invest in other technologies where we've done that across the country. Oklahoma has some of the lowest electricity prices in the United States. We do a good job of balancing the intermittency of renewables with the power and affordability of natural gas. That's how you build.
My late great good friend Boone Pickens was originally in Oklahoma. Everybody thought he was from Texas. No, he's from Oklahoma. In fact, he's got his name on the side of Oklahoma State University. And he called your area and going up all the way through Iowa and Nebraska, the Saudi Arabia of wind. He was big into wind. It all kind of fits together because when you look at the data centers that are coming to you and saying, Chad, we need help. Talk to us a little bit, just in general terms, about can you quantify the electricity demand requirements that are coming?
It's massive.
They're actually like Carl Sagan looking at the skies. They're inconceivable.
Yeah, it is incredible. And we've already announced just for Williams, what we're trying to do is bring American energy, domestically produced, affordable, reliable, to consumers and companies that need it the most. And if we're going to win the race for AI, we're in the process of commissioning our first power plant, not built on the grid, but built on the gas grid, so that we're not going to stress local utilities.
What does that mean? Explain what that means.
Yeah, so in Ohio, it would take 6 to 8 years.
That's that video I think we had at the top. We could run that video again.
Yeah, you showed our Socrates project. It would take 6 to 8 years to build new generation in Ohio, and then to even build electric transmission lines. On average, it takes 7 years to build a new electric transmission line in America. And so we are siting data center projects directly on top of natural gas infrastructure. I mentioned we produce 40% more than we consume domestically. This is our nation's superpower. So we're now siting power plants directly on the gas grid. We're going to bring power to these data centers in Ohio in under 18 months, not 6 to 8 years.
Okay, so I want to repeat what you said. And I want our audience to really, if you're, whatever you're doing, just listen for 1 second, because this is critical. If you're driving, just keep driving. 2 eyes in the road, but listen on Sirius XM 112. So I could have a fully ready-to-go data center, fully built, ready to go, boom. I could have a fully ready-to-go power plant or power source here, and you're going to tell me it could take over 5 years just to string a wire between the two that can make it work?
Yep. The average time for a new interconnect in PJM, where these plants are being built, where our existing data centers are, where they want more power for this next generation of technology, just to get a connection to the grid will take 6 to 8 years.
And that PJM, by the way, we've talked about it, about 61 million homes or so, basically North Carolina to top of New Jersey, as far west as Chicago, where you're originally from. How do we fix that?
Yeah.
So I know regulatory reform, everybody talks about it, but it doesn't seem to be getting any better.
Yeah, no, we do hope, and we're very focused on permitting reform. It has become incredibly difficult in the United States to build infrastructure. I mean, we built the war emergency pipelines in World War II from Texas to New York in under a year. Today, it can take 5, 7, sometimes 10 years to build a large piece of infrastructure. So we're hopeful the House passed legislation last year. We need the Senate to act. We've got to get back to building as a country. But the reality is we're building transmission lines at a third of the pace of 10 years ago. We're building pipelines at a third of the pace of 10 years ago. This used to be our country's superpower. We've got to get back to building if we're going to unlock our full potential.
Stock's down a couple of bucks from its. I had a huge run, so I mean, big run up, down a couple of bucks. All your investors are probably watching or listening right now. What's the message about Williams as a company and as a stock?
Yeah, well, first thing I'd say is today was a great day. I brought you actually a hat from our
You actually brought 3 hats.
I brought 3, so yeah, that's for you and the team.
Gray.
Yep.
Tan. It's tan.
That's tan, I think.
My wife says I'm partially colorblind, so this is gray.
Yeah, we had a camo version too, so I can bring you that. But I think the message is, look, it's a great day for New York, but it's just the beginning. We've got to build more infrastructure if we're going to keep energy affordable, if we're going to unlock our country's full potential. Williams, our job is to be right in the middle of making sure we can bring energy infrastructure solutions to our consumers, to the companies in America, so that we win this next generation of opportunity. And so, been around for over 100 years. I'm focused on making sure that we're going to be a strong company.
I haven't been doing this 100 years. Not yet. But I'm getting close. But I don't think I've ever talked about a natural gas or pipeline company launching a new project in Brooklyn. Every day, that's what I love about this job. There's something new, and that was new. New hats. Chad, really appreciate you coming on.
Thanks for having me.
Thank you very much.
Thank you.
And congrats on the project. Thanks. All right, by the way, speaking of energy and power, sign up for our new Power Insider newsletter. It officially launches tomorrow. It'll be a weekly piece, key news, power players, and more. I look forward to working with all of my friends and colleagues here at CNBC and putting on the best product every single week. Scan the QR code on your screen and sign up today. A lot of you have, and now all we got to do is write the doggone thing. All right, we are just getting started. And up next, the rally to end all rallies. Jeff Kilburg on the stock that he said would run, and it did, and keeps running in nearly record fashion. That and more next. All right, we are only 2 days into the week. We get it. But so far, so good, particularly for software. The IGV, one of the big software ETFs, is up today along with the broader markets. But if you zoom out, the damage from the sell-off is pretty doggone clear. Microsoft, Palantir, Oracle, ServiceNow, all down 50 to 30% from their 52 weeks highs, which, while painful, has also led some to ask, are some of these stocks and companies now just too cheap to ignore? Let's talk about that and a big-time run with Jeff Kilburg, founder and CEO of KKM Financial, also a CNBC contributor. We'll get to the run in a moment, Jeff, and welcome. Software, though, is this just some sort of a weird rebound off a technical bottom or a technical low or a real turnaround? How do you read the software sector writ large?
I think a real bottom has been put in software. And if you look at IGV, which is ETF we love to talk about, if you look at the dispersion, compare IGV to SOX, the semiconductor ETF. Wow, what a story this is telling. About a 50% dispersion year to date, Sully. So what I think is that maybe some of the semiconductor names maybe are a little overbought here, but more importantly, the IGV, the software names have just been thrown out, and we're seeing a terrific rebound. I think it'd be very particular in some names. Oracle, almost back-to-back days up 10%. Yes, it's only been 2 days, but they were oversold. You saw relative strength index way oversold. I think that's an opportunity if you're selective in software.
Yeah, so why are we looking at it relative to the stocks? What is it about the semiconductor index and the software index that makes us interested in both together?
Well, it's a great point you bring up. And what we think about, go back to 23, 20, even 25, it was a broad swath exposure to anything and everything technology. That stopped. Now in 2026, we have this dispersion inside of technology between software, which seemingly is being replaced, or maybe it's not being replaced by AI. And now all of a sudden the semiconductors, this need for chips, this CapEx expenditure, which Amazon just recently talked about, that is insatiable. So that's where I think you're going to see some of the semiconductors names continue to prevail, but also some of the software names. We still need software. We still need Palo Alto Networks. We talk about some of these names that have just been thrown out. There's value in those growth names.
All right, so let's talk about Intel. Well, I mean, this is
another chip maker.
Yes, I know, but it's a different thing because I think this is a massive thing. Okay, Intel may be kind of down a little bit today, but it's up 60% in 10 sessions. It could have its 10th straight positive session if it ends higher today. It doesn't look like it will, but if it did, it'd be the first time that's happened in 21 years. Even if we don't get to that mark, it's been an unbelievable run. What's been behind this insane reversal in Intel?
A couple inputs. So let's go back to last August when it was trading under $20. Yes, under $20. That's when the government, I don't know what the exact transaction was, if they took shares, bought shares, acquired shares, but they picked up about 433 million shares of Intel, around $20.50. That was the catalyst for this essential chip maker. And why is it an essential chip maker? Intel, which certainly has had a rough and rocky, volatile road, it's here. It's U.S. economy. This has been a U.S. soil chip maker. And when you talk about sovereignty, we talk about security with our military, that's why this chip maker, when it was back at $20, was of value. And that's why we bought it. This is actually our largest owned stock in our Essential 40 portfolio because it is essential. But when you saw last August, it's up over 220% since last August. But what happened? You continue to see it gain momentum, and all of a sudden it became relevant again. And Terafab, that is the new deal with Elon Musk down in Austin, Texas. So they are coming in with their foundry business. If you think about their foundry business, they did $300 million in external sales last year in 25, 300 million. What did TSM, what did Taiwan Semi do last year? They did 122 billion. So now with Terafab, Sully, you are gonna see Intel potentially do $2 or $3 billion in revenue. Now they have a template. Now they have a foundry business.
So
not only
fine.
designing,
So what happened to it then?
And packaging.
You're making a good story, but that didn't happen 10 days ago. Somebody rediscovered something.
Yes, once they realized, I think the Terafab, that was really the component. When you look at the margins inside of designing, fabricating, and packaging, packaging is probably the most lucrative of those three inputs when you're doing chips. And now with these margins up at 40 or 50%, or even above 50% with the packaging, they can rinse and repeat because you're not going to see NVIDIA go down. NVIDIA is up $10 since this was announced, right? So despite the fact that NVIDIA tax, which was all the margins that now Elon Musk is going to be making internally, you're going to see other folks look to do and replicate the same foundry business. So the foundry business for Intel, that's the aha moment. And if they can take any market share away from TSM globally, even if they just take 10%, they went from zero to hero in that business. It's dropping all of the bottom line. So that's where Intel, I'm not taking any chips off the table. Unintended. This is our largest holding. It was our largest holding last year. We want to continue to own this essential chip maker here in the United States.
Well, if it's your largest holding, then you printed money because a 60% gain in 10 days and you're not selling, you're not selling.
We're not taking any chips off the table.
Okay.
I think you can look at some of the options. If you want to look at selling calls, Sully, you can up at $70. But we just made a new all-time high yesterday. The momentum is still intact for Intel.
Got chips off the table. I heard the dad joke. I got it.
Yeah,
it didn't go by me. We're both dads.
You're
Jeff
the best.
Kilberg,
You're the best.
appreciate it. Thank you very much. All right, chips off the table. All right, coming up, the S&P 500 pacing for its 9th straight up session. We're going to ask the chief strategist of one of the largest asset managers in the world what he thinks about these markets. Stay tuned. All right, welcome back. The markets, they are rallying again today. And don't tell anybody, all right, you promise? The latest up move now makes the S&P 500 higher on the year. Small caps now up 10% in 2026. That's actually one of the greatest starts ever to a year for small caps. We're not soaring, the S&P's up 1.5%, but we are up on the year. So is it possible to sit here right now and say this, the worst may be behind us for stocks this year? We don't know, but our panel does. Ari Wald is Oppenheimer's head of technical analysis, and Michael Aroni, State Street Investments chief investment strategist, are here with us. Aroni and his team oversee $5 trillion with a T in assets under management. Michael and Ari both, thank you. Michael, make it make sense. We're at war, energy prices soaring, and yet the S&P is positive on the year. I don't understand it.
So the economic data continues to be pretty solid. It's certainly not dismal yet. And we have fiscal stimulus, the potential for monetary stimulus. And Brian, overwhelmingly, the biggest fuel to the rally is earnings. Earnings results are outstanding and are expected to continue to be outstanding. So for this year, you're looking at 17% earnings growth for S&P 500 companies on almost 10% revenue growth. So those numbers are outstanding.
Okay, listen, you're a Boston guy. You know, Boston been known to be a little cynical. Okay, so I'm putting my Boston hat here. It's early. Goldman's numbers weren't bad. Fixed income was a little bit on the weaker side. Citigroup's numbers, pretty doggone good. We're very early into quarterly earnings. You sound pretty confident that what we're going to see from here on out is going to be pretty good.
So you're looking at, for this quarter, year over year, about 13% earnings growth. So Brian, if the companies beat those earnings, which they always do, by the amount in which they normally beat them, you're looking at earnings growth of close to 19% year over year for the first quarter earnings. And so I'm very confident. Profit margins have rarely been higher. And the great news is, as you're highlighting, you're seeing breadth. All 11 economic sectors are going to experience revenue growth. So this is what is fueling the market rally. They're ignoring the geopolitical news and kind of the highlights from that perspective. More than 20 times there's been airstrikes in the Middle East and North Africa over the last 4 decades. 8 weeks later, 95% of the time the S&P 500 is up. And boy, Brian, we're right on track for almost that exact timeline.
I know, Ari, you're champing at the bit here because you're like, no, I'm a technician. I don't really care about earnings. Did we hit something technically? Because you heard me ask Jeff Kilberg about Intel. It's not like these numbers that Michael are giving are brand new. The street has been expecting good earnings. Is there something technically that we touched that caused this big reversal?
I mean, just the action over the last week is undeniably bullish to have such a breakaway type move in the markets. And this is coming after a pretty tough 6-month period. I know you were talking about some year-to-date stats, but when you really consider that the NASDAQ had peaked in October, and through that we were kind of in this 5-month malaise and that final washout, our kind of take is the action we've seen over the last week is marking a low. I think, at least from the near term, the worst is behind us. It sets up this multi-week rally into the summer.
Really? So, okay, dig a little bit deeper. What are you seeing technically? You said undeniable. That's a strong word. What are you seeing under the hood of the market that's giving you this optimism?
Well, I'll take off of one of his terms. Breadth of the market is strong, both from the economic sectors and the equity perspective as well. Again, a lot of rebroadening and participation. Really, we're coming off a point where small caps had made new highs. It was very concentrated weakness. It was essentially just the Mag 7 that had broken down. A lot of the key small cap averages, equal weighted averages, came right into the 200-day average. They turned higher. They're gapping higher. And so I think it's just this broad-based type move, which is what is the key positive that leads us to say that.
Michael, you and your team recently upgraded tech, materials, and energy. Great call, by the way, on energy, because that's been rocketing for obvious reasons. We do have a new Fed chair, we think. He's got to be confirmed. Okay, we plan to have a new Fed chair. Market's kind of vacillating about rate cut or not, whatever. Do you care? Will it change your view on equities in America, depending on if we get no rate cuts, one rate cut, two, whatever?
It won't change my view on our bullish outlook for equities, whether we don't get any rate cuts or we get a few rate cuts by the end of the year. Now, I do expect that Warsh will be confirmed, and he will cut rates later on in the year, and at least probably twice, I think, towards the end of the year.
Do you think the bond market will care, though? Because we've been signaling rate cuts, and all that's happened is yields have actually gone higher.
Well, I think yields are going higher for different reasons. Certainly, most recently, the spike in energy prices has put upward expectations on inflation. That's certainly part of it. Given the fact that the war is going to cost more and tariff revenue is going to be less, and now we're asking for a significant increase in terms of the defense budget, we're going to have to borrow more, and we're probably going to have to borrow more, we being the U.S., at higher rates. And of course, the economy's still expanding. So I put those three things together, and I'm not surprised that rates continue to be range bound. Brian, this is where they've been now, from 375 to, let's call it 475. That's a wide range for the better part of more than a year. I think we're stuck in that range, and that range doesn't change my outlook for equity.
And it doesn't change your outlook, Ari, for Citigroup, which is one of the names that you like. Obviously, the numbers were good. As a chartist, though, you're looking at it. I guess what looks attractive in Citi's chart?
Right. Well, to follow up on that, for us, intermarket stability, it's range-bound rates. It's neither high nor low rates that equities have historically responded favorably to. That's what we have.
So they kind of want to be in quicksand.
Not too hot, not too cold, and I think that helps keep the equity market afloat. Are conscious of mid-term year seasonals that do typically are a headwind as you push into the third quarter, and you'll reset into a better Q4. Why Citigroup comes up, it's not really a call on banks and brokers. It's a call on high beta, high momentum. The momentum factor, we're momentum investors, which has really been the key factor coming out of this turn in the markets as well. We're seeing areas both that work a lot, high betas working, cyclicals, and it's stocks that have already outperformed. Winners are continuing to win, and Citigroup included, best of the big banks and brokers.
All right, and State Street upgrading technology, energy, and materials. Michael Aronia, State Street Investment Management, Ari Wald, really appreciate your time. Gentlemen, thank you. Have a great day. All right, so we just talked about bond yield. Let's get a quick check on the bond market. 10-year yield breaking back below 4.3 today. If it does hold, it'd be the second day in a row that it closes below that level. Some have said rates may be too high in the U.S. Take a look at the UK. 10-year yield there, 4.76. In a bond offering today, the UK Central Bank sold 10-year bonds, the highest yield since the global financial crisis in 2008. So what they're called gilts. If you see a four-letter word on your crossword that says UK debt, the answer is going to be gilt. 4.76, higher than us. All right, going back to energy, oil back below $100 a barrel. White House considering a new round of possible peace talks with Iran, but what's the real likely outcome here? RBC's Halima Croft been in D.C. talking to power players the last couple of days, and she will tell you what she heard. Next. All right, here's a look at the most important map in the world right now, and that is the Strait of Hormuz. U.S. Central Command reporting that no ships made it past the American blockade within the first 24 hours. They do add that 6 merchant vessels complied with direction from U.S. forces to turn around. So there you go. For more now on the Iran war and its impact on the energy markets, let's bring in Halima Croft, Global Head of Commodity Strategy at RBC Capital Markets, CNBC contributor, and as somebody you can see from the beautiful Capitol building, I assume that is not Austin, Texas, behind you, Halima.
Not.
It is not. You are in Washington. Austin would be a little higher, actually. You are in Washington, D.C., huge meetings, IMF, World Bank, big CNBC conference, IEA is there. What are people talking about? What's the global expectation of how this plays out?
I mean, Brian, there continues to be a divergence between experts like Fatih Birol, IEA executive director, who yesterday said, look, 13 million barrels a day are disrupted. 80 facilities in the Gulf have been damaged, 1/3 severely damaged. It could take 2 to 3 years to bring those facilities back. Warning about the dire economic impact if we cannot get a resolution to this war. And yet there's a large segment of the market, if you just look at the prices on your screen, that are pricing the end of this conflict based on the prospect of continuing talks. Now, you put up that map of the Strait of Hormuz. A map I'd like to see is airport maps in Washington. Which officials from Washington are actually getting on the plane to have talks on Thursday? We've had these press leaks of talks on Thursday. We've had President Trump saying we may have talks in the next couple days. Really unclear at this point who is going to be leading those talks. And that's important because so many market participants are pricing endgame for this war.
They are. And the one, okay, I will see your Flight Radar 24 map and raise you a little bit of China. Because quietly, the Crown Prince of the UAE, Al Nahyan, is in Beijing, or was. What is China's role in all this, Liam? It seems like nothing's ultimately going to get resolved until Beijing, which is the primary buyer of Iranian oil, and not right now, but down the road, will be the most impacted by any continued blockade. They're going to have to be involved in this somehow.
Well, I mean, I think that's why we had the blockade announcement. I think the White House is hoping that basically if ships are not going with Iranian cargoes to China, China will become more active in trying to convince the Iranians to take the deal on the table. The challenge, though, is, Brian, is that China exercised prudent risk management before this war. They were basically buying aggressively for their strategic stockpiles. Also, there are reports that with that 400 million SPR release, a coordinated release from stockpiles, China was a big buyer. They put the barrels in their strategic reserves and then slapped on export restrictions. So the question is, how much economic pain is China feeling right now from this? And then there's the other side benefit. We've moved military assets from the Asia theater to the Middle East. Do they have a freer hand now strategically to think about Taiwan policy? So again, question is, what's going to incentivize China to really pressure Iran to take the deal?
I know you had an interview, sort of a panel with Fatih Birol. He is the head of the International Energy Agency. My great colleagues here at CNBC also had a piece out about how they're worried. The IEA is worried, or even sees its demand destruction from higher prices coming. And there's this huge divergence between, or convergence between, the numbers we show on the screen, that's the futures market, the paper market, and actually trying to buy a physical barrel of oil. What are they really worried about?
I mean, what everyone is worried about, in Washington or at the IEA in Paris, is that divergence between the price you have on the screen and how much you have to pay to buy that barrel now if you're a refinery, that it's going to ultimately converge, and we're going to have much higher prices flash on the CNBC screen. Now, people have been saying that for a while. The question is, when are we going to get convergence? And the more people in the market think this war is about to end, we have the continuing divide. That's why I think it's so important, these peace talks. I think we have a very limited window. I mean, this ceasefire expires on April 21st. If we're not further along in getting a deal at that point, the market participants start to say, wait a second, we're going into summer driving season and no barrels are moving through the Strait of Hormuz. Like, this might be a more serious outage as we think about who's going to be on the road.
Well, I also feel like, let's say we get a peace deal. We all hope that. We want a peace deal. It doesn't make up for the fact that for 5 weeks, we've had maybe the greatest energy supply shock since the pandemic, or even worse than that for specific regions. because of the near total and complete shutdown of 20 to 30% of critical minerals. What's going to happen the next 5 to 6 weeks or 2 months when it comes to helium and natural gas and all the other stuff that's not called oil?
Brian, it's really important because think about it. Those last ships that left the Middle East on February 27th, before the bombing started and the straits closed, those last ships are reaching those markets. So we are now going to really start hitting that wall in terms of the disruptive impact of this war. So it is so important to see, are we any closer to bridging this divide? And again, the Iranians say they want to retain their right to enrich uranium. Maybe they'll pause for a few years, but the U.S. continues to say no enrichment or you have to pause for 20 years. And by the way, we don't want the missiles and we don't want support for proxies. And we may want to operate a JV for the toll booth on the Strait of Hormuz. So not clear we're bringing our sides closer together. And again, I'm not sure who's taking off from Washington to fly to Islamabad.
Well, we'll watch the flight maps. We're going to watch the Strait of Hormuz, and then we're going to put the flight maps up next to that. Halima Croft, great idea as always. Halima, thank you very much.
Thank you.
All right, let's get out to Seema Modi for a CNBC News update.
Hi, Brian. Here are the stories we're watching. The Department of Justice said today that it is suing the state of Connecticut, Governor Ned Lamont, the city of New Haven, and others. The lawsuit is challenging sanctuary city policies that the DOJ says are interfering with the federal government's enforcement of immigration laws. The lawsuit targets state law and local rules that limit cooperation with the feds. When the World Cup arrives in New York area this summer, New Jersey Transit is reportedly planning to charge more than $100 for return train tickets from MetLife Stadium to New York's Penn Station. The tickets normally cost about $13. That's according to The Athletic, which says the final decision on the price is expected in the next few days. A spokesperson for NJ Transit telling CNBC in a statement that the pricing for match days has not been finalized. Just 2 weeks before it was set to shut down, one of the longest-running newspapers in America has found a buyer. This Pittsburgh Post-Gazette, founded in 1786, says it is selling to the nonprofit Venezuela's Institute for Local Journalism. Financial terms were not disclosed. Brian, I'll send it back to you.
$100 for a possible train ticket.
Can you believe it?
I actually can believe it because everything around the World Cup, Seema, that I've seen, every single thing is just like a money grab, and it's sad. It's sad.
It is.
Watch on television. Seema Modi, thank you. All right, still ahead. Wall Street bending the rules for the next generation of tech giants to fast-track their inclusions to the major indexes when they IPO later this year. A lot of words there. What does that mean? We'll explain in your Market Navigator.
All right, welcome back to Power Lunch. I'm Dominic Chu with your market navigator today. Now, a slew of high-profile IPOs are in the pipeline in the coming months with names like SpaceX, Anthropic, even OpenAI possibly in the offing. So with the NASDAQ looking to change its rules to possibly fast-track some of these offerings into index inclusion, what could that mean for index funds? Joining us now for this conversation is Victor Haghani, the founder and CIO of Elm Wealth. Victor, this is an interesting proposition because if you're going to fast-track some of the most well-known privately held companies out there, what exactly could it mean, risk-reward-wise, for those people who own, say, the Invesco QQQ ETF or other index tracking instruments?
Sure. So I think people are right to be thinking about this because there's a long history of IPOs not performing very well over longer horizons. So the idea of getting these IPOs into the index funds sooner has some people worried. And indeed, NASDAQ has already changed the rules to fast track. And MSCI is looking at that, and we're kind of worried about that a little bit. But the main thing to realize is that, like last year in 2025, we had $80 billion roughly of IPOs. But the size of the whole stock market is $80 trillion. So that's 1/10 of 1%. So it's kind of much ado about nothing, because even if these IPOs, if these stocks, which might do great, but if they don't do well, it's not going to hurt index fund performance that much, because even if we get twice the amount of IPOs in 2026 or over the next 12 months as we had last year, that's 0.2% of the whole market. And if they went down 20 or 30%, you'd be losing a very small amount on your index.
Victor, we're looking at some of the private market valuations for names like OpenAI, SpaceX, and others. These things have ramped up tremendously in valuations. So the momentum is there.
Yeah.
But valuations are also arguably elevated, given what we've seen. Is that a risk as well?
I think that people are right to be concerned about what the performance of these stocks will be. But again, they're just going to be a really small part of most of the indexes. Now, NASDAQ is a little bit different, but all the rest of the indexes, they look at how much of the stock exists on the marketplace, and that's how much weight they put on them in their indexes. So you can just look at how much money is raised in the IPOs, divide that by the total market cap of the whole market, and then you're like, wow, these things are just, it's much ado about nothing, I think.
All right, so the valuations there are concerned, but maybe not as much for you as some others out there. Victor Haghani at Elm Wealth, thank you very much. We appreciate it. Brian, I'll send things back over to you.
All right, Dominic, Victor, thank you very much. All right, coming up, cruise stocks. They seem ready to set sail. If oil prices keep coming down, what's it going to mean? Contessa Brewer is down in Miami with a lot more, some of the news that is looming on the horizon. We'll get more with Contessa coming up. All right, let's have some fun. Let's talk about a big business and some big ships. We're talking about cruise lines. Fuel prices, they've been up the last couple of weeks and months. And so what happens with the cruise lines really depends on where energy costs go and consumer spending is going and how many people want to get on one of these amazing ships that I've never been invited on. Contessa Brewer, though, has been invited. She is at the Sea Trade Cruise Ship Industry Conference in South Florida. What's the mood? Is it still good?
Very upbeat because the cruise industry is going into 2026 with very strong demand. They say that they're not just in the United States, but in Europe, in Asia. They're seeing people ready to cruise, and the big driving factor here is value, the kind of value that you get for your dollar when you go on the cruise ships, Brian. So the mood is very upbeat. They've got a lot of destinations represented here that are trying to get a piece of that action. But of course, you mentioned the fuel. That's a big headwind for these companies. Today, the stocks are up. Norwegian Cruise Line up 4.5%. Viking is up 4%. Carnival up 4%. Royal Caribbean flattish to, it's in the red right now. But what I heard about the fuel is that it's a cost headwind across the board, especially for Carnival, though, because they don't hedge. So he said, look, it was great when fuel prices were low. Now we're getting hurt more than our competitors because we don't hedge. Royal Caribbean hedges at 60% for the year. Norwegian hedges at 50%. And they have a brand new CEO at the helm, John Chidsey, who I talked to, and I asked him, how are you thinking about this big issue of unstable oil prices? Here's what he said.
I think as a whole, yes, it's a headwind. And if you're very short-term focused, I get it. If you're a long-term investor, I would look right through it and just have confidence in how the industry has always maneuvered its way through these different issues.
But look, the stock charts of these companies over the last 3 months, year to date, over 12 months, they look like rough seas. They're going up and down. And Norwegian especially, he's got the added pressure of Elliott as an activist investor. And I said, well, here you've been on the job for about a month. How are you dealing with Elliott? And he goes, it turns out that Elliott's priorities for this company and my priorities for the company are about the same.
So I got to imagine fuel's a big issue, as you just mentioned, but people, I think, correct me if I'm wrong, Contessa, don't they buy their tickets really far in advance for a lot of these cruises? So the people that are booking now, they what kind of prices are they paying? Because I don't even know where fuel is going to be in 9 months.
That's right. And so then that's one of the reasons why it hurts the cruise line so much, because those people that booked 6 months ago, they've already paid their tickets. And it's not like they get on board and then you say, oh, now you've got to pay an extra fee because fuel's really high. But the other thing that's happening is people are spending more on board than they ever have. They're spending more on excursions than they ever have. So there is some leeway with pricing when it comes to that things. The other thing is they have globally a little bit less than what Las Vegas sees for annual tourism. 37 million people on global cruises. And I said, look, if you look at Las Vegas, their prices went sky high after the pandemic, and they got hit really hard with people all of a sudden pulling back and thinking that Las Vegas was not such a great value. Are you taking any lessons from that? And they said there's still such amazing value. When you book that ticket, you're just getting the attention of the cabin steward, the food, the entertainment, and then going from place to place. Yeah. Nothing beats that. Nothing else in travel and tourism.
We need like a Las Vegas cruise ship, like a Wynn on the water. You can make it happen. I don't know. Don't give me that look. You can make it happen. I think it's gonna.
No, yep. You could make that happen.
We could see it. All right, more Power Lunch right after this. We got to end the show with this RBI on just beautiful cars. This is a Rolls Royce called Project Nightingale. Put it up. Look at that. Custom built, 2-seat drop top, fully electric. Only 100 will be made. And if you want one, you got to be invited. That car, Nightingale from Rolls, invites only. By the way, it's going to be like $6 million, so we're not going to have one anyway. Thanks for watching, everybody. See you tomorrow. Closing bell.
Brian, thanks. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make or break hour begins with stocks nearing record highs, continuing their remarkable run from the lows of the war. That's a scorecard right there with 60 to go in regulation. S&P 6950. It's like 0.75% from new highs. We've been green all day long. Tech is certainly one of the bright spots today as the software comeback continues. Names like Amazon and Alphabet surge towards new highs of their own. We're going to have more on those moves in just a little bit as well. Elsewhere, Citi is higher today. Shares of Wells, though, are lower. JPM is in the red. The bank's reporting today. We'll follow it. We'll discuss coming up. It takes us to our talk of the tape, the road to new highs and how best to be positioned right now. Well, let's ask one of this country's top financial advisors. He is Richard Saperstein. He's founding principal and CIO of Treasury Partners, and he joins us now. Welcome back.
Thank you.
You surprised at the resiliency of this market?
Not at all.
Not at all?
Not at all. Stocks went from a PE of almost 23 in October to 19 and change 2 weeks ago. And it's important to look past this conflict to the underlying fundamentals that are in the economy. We're going to have the 6th consecutive quarter of double-digit earnings growth, record profits, record margins, and the stocks have become way more attractive now with the conflict, much like after Liberation Day last April.
Yeah, but I mean, it's easier to dial back tariffs than it is to just dial back what's been taking place in the Middle East, because part of that's not in the president's control in some respects at this point. None of that factors in. You're just playing it like you would play that. Look through it and focus on the fundamentals.
The fundamentals are what counts. So let me give you some numbers.
Okay.
All right. So if we go to the operating cash flows of the S&P 493, it's roughly 6% for the next 12 months, the estimate. If you look at where, let's say, Amazon and Microsoft are, they're 7 and 7.5%. So you can basically buy a large growing company at an operating cash flow greater than the overall S&P 493, and that ties into the PEG ratios. So if you look at the PE ratios to the growth rates of different sectors, if you look at the large cap tech right now, it's 1 to 1.5. If you look at it in Coke or let's say Kimberly-Clark or Procter & Gamble, it's 2.5 to 5. So you're paying way more in staples or in the 493 for growth than you are in large cap tech.
All right, so Goldman's Tony Pescarello today, I feel like you guys are on the same wavelength. He said, I've spent much of the past 6 weeks trying to work out why the S&P was so resilient. Kind of the same kind of question I asked you. In that search, a few things came up again and again. Number one, the market never lost confidence in the underlying durability of the economy, right? You agree with that. In turn, earnings expectations trended higher. That ended up being the story, more so than what took place in the Middle East and what's been taking place, or the spike in oil prices. Until the fundamentals of earnings and the economy change, you just were not going to change.
No, because the conflict ultimately will have a resolution. It's not going to go on forever. And the economy is benefiting from this surge in CapEx, favorable employment. Think about it, 300,000 government jobs were lost, and they've been absorbed into the private sector. So a privatization of the labor market. We've got deregulation, ease of permitting. There's a host of factors going to lead to rising profits and earnings, and stocks follow earnings in the long run. They don't follow the conflicts that are going on around the world.
Well, I mean, our Citi today upgrades the U.S. to overweight. They were at neutral. I feel like everybody has swung, like the tide's turned, right? Yeah. In for the market and the narrative, and technology obviously has a lot to do with that. The software rebound is in full swing today. As you know, again, Seema Modi joins us now with a look at the names that are jumping, and there are many for the second straight day.
Yeah, there are, Scott. Today's rebound in software primarily driven by Oracle and that partnership being expanded with Bloom Energy that not only gives the company access to about 3 gigawatts of power by 2027, but warrants in Bloom shares, which continue to run up. Overall, the deal underscores, Scott, how critical energy is becoming to the AI build-out. With today's move, Oracle has gained roughly $74 billion in market cap since Friday. Also lifting sentiment for software, a report from the Financial Times that OpenAI investors are questioning its mega high valuations. But get this, Jefferies cautioning today that the price action we're seeing across software is more reminiscent of a squeeze that we saw back in March versus a fundamental shift in how long-only investors are thinking about the space. As we know, though, the narrative can shift very fast. IBM set to report earnings. That will be the first software company to give us a good read across growth and AI. Scott, that's next week.
Good stuff, Seema. Thanks so much for that. That's Seema Modi. I mean, IGV's up 5% this week already. It's coming off its best day in a year, and it hit a 52-week low on Friday. And the mega caps are playing a role, too, in all of this. The moves in Amazon and Alphabet, both of those stocks are approaching new highs, as we said. Kate Rooney has more on Amazon's big run, and it's up a lot in a month.
Yeah, Scott, right now it's on track for its highest close since November. Amazon has been leading the Dow today after announcing a deal to acquire Globalstar. This is a roughly $11 billion deal, really meant to help Amazon beef up its satellite internet business known as LEO, and then to help connect consumer smartphones and devices with those satellites. Amazon has been trying to make a dent into Elon Musk and SpaceX's dominance with Starlink. Amazon says it does plan to launch a new satellite to cell phone service in 2028 and then provide this service to smartphones. Globalstar already has a network of satellites out there and has provided Apple with links to support some of the iPhone features. Emergency call assistance, for example, when you don't have cell service or that's not available. Amazon has also said it did agree to a deal with Apple to power satellites for its phone networks and then plans to work with Apple in the future. Spectrum rights are becoming a much bigger deal, a lot more valuable as SpaceX and Apple do start increasingly using these satellites to connect to phones instead of just telecom providers, Scott.
All right, Kate, thank you. That's Kate Rooney. So this plays right into something that you've been doing. You added 2 mega cap tech, Alphabet, Amazon, and Microsoft.
Yeah, I think
just thought the multiples had compressed and they were too attractive to pass up at these levels.
there are companies you date and companies you marry. And when these companies that you want to get married to go down and their operating cash flows and earnings keep going up, you want to add to them. And they suffered from a couple of hits in the last 60 days, whether it was the fact that they're spending all their CapEx, all their operating cash flows on CapEx, or a host of factors that have affected large cap tech. Great opportunity to add.
What about the idea that multiples have come in, right? So you already knew that you were going to get durable earnings growth, right? Better than most other areas of the market. The AI spend doesn't appear to be slowing down anytime soon. And now you can get, slightly above a market multiple for most of these names, rather than a little bit more of a premium like you had to do before. It all plays in the story, right?
It does. And you can also buy them. The market multiple might be elevated, but the PEG ratio is below the 493, and the operating cash flow is above the 493. So while the PE might be higher, the growth rate is expected to be higher. The market's basically saying, hey, look, guys, you're spending all your operating cash flow on CapEx. We're discounting that. We don't believe in that. All right? I take the other view. I think that these CEOs know their market, know their business, and they're deploying capital efficiently, and it's going to benefit shareholders.
You must think that software's bottomed if you initiated small positions in Palo Alto and CrowdStrike. Is that right?
It's probably like catching a falling knife, which I don't like to do. I just wanted to get my feet wet, so I added a very small position. But I do think that there are certain software companies with embedded books of record, proprietary data, regulatory requirements, transactional records that are going to thrive because they're going to adopt AI, and they're going to actually benefit when all this is said and done. I don't see an AI agent coming in and disrupting these software providers that are in the stack of a company.
But you're tactical, though. I mean, you're looking obviously at cyber as a place that you don't think is going to be disrupted as much as the stocks would have suggested they would be, because Anthropic, every time Anthropic was in a sentence, the software stocks and these things went down a lot.
Exactly. And I also added Booking and Expedia, because like the world is not going to stop traveling. Remember, the underlying economic condition of the country is fine. People are going to resume traveling, and those stocks are selling at very high operating cash flows, which is what I like.
Okay, well, we'll talk to you soon. Thanks for sharing the knowledge. Rich Saperstein, we'll see you soon. Mixed results from the big banks means mixed trading in today's session. We showed you a little bit of that at the top of the program. Dom Chu joins us now with a little bit more, even as Wall Street continues to grow more bullish on earnings overall. Dom.
Sure, Scott. So earnings season is gaining steam, and it's the banks always getting the focus, the bulk of attention in this early reporting window. So let's start with today's action. JP Morgan Chase, as you see there, biggest bank in America by market value, down about 0.5% or so after beating expectations for both profits and revenues, but it did lower guidance for net interest income. So that's the reason there. Shares of Wells Fargo lower to the tune of just about 5%, and the single worst performer in the S&P 500 financial sector so far. This is after a mixed report where profits appear to top estimates, but we're still being evaluated for comparability to analyst consensus estimates. Revenues, though, did fall shy of expectations. And then Citigroup, that's the outperformer, up about 3.25% today after handily topping estimates for both profits and revenues, with the revenue mark, by the way, coming in at the best levels in a decade. Citi was helped along by strong performance in both its key fixed income and its equities divisions. Now, it's early stages, as you point out, but we are starting to see some more bullish commentary coming from strategists. One of the latest is via the team at UBS, which put out a note to clients saying they expect first quarter earnings growth for the S&P to come in around 17%, which would be the fastest pace in 5 years. They also add they think U.S. stocks remain attractive, and they favor financials, consumer discretionary, healthcare, industrials, and even a more defensive utilities trade. So keep an eye on some of those movements in sectors, Scott. I'll send things back over to you.
We will do. Appreciate that look. Comprehensive, too. Dom, thanks so much. Dom Chu. Now let's welcome in our panel, CNBC contributor, Requisite Capital's Bryn Talkington, and 314 Research's Warren Pies. Nice to have you both. Bryn, you first. Do you agree with the bullishness from UBS and Mr. Saperstein?
Well, I think UBS put some math, right, to their earnings estimates. So I think that tracks. You know, you and I have talked about how much NVIDIA and Micron are going to contribute to that first quarter earnings. So it is very, very narrow, by the way. If you take those two companies out, you get single-digit growth. That being said, I mean, I love how tech is trading right now. NVIDIA is participating. I mean, we haven't talked about it yet, but NVIDIA is at 195. You know, if we can get above 200, I think that really brings back a lot of good things to come for big cap tech. And so we'll see what happens with the Strait of Hormuz and President Trump. That can always throw a wrench in it in the short term. But I think this year, definitely with earnings, we're setting up for a very constructive year.
I guess, I mean, Warren, it feels like the market has just moved on from the war and the spike in oil and the Strait, and it's focused on the economy and earnings, and it just isn't as complicated as some have tried to make it.
Yeah, I mean, I think equity investors have a longer time horizon than physical oil market participants, for instance. You know, I'd say oil is the shortest duration asset on the menu. So it's just a fundamentally different asset. But if you rewind the clock a little bit, and you think about the equity perspective, the fear going through the first part of the year was all of the CapEx spending from Mag 7. And was there overspending, and, you know, is there going to be a glut and a data center glut and things like that? And what we've talked about and what's been developing, I think, under the surface throughout the war, and it's been, you know, the war's been on the headlines, but the real trend for the market under the surface is this growing shortage of compute and the realization that this AI appetite for compute is insatiable almost. We see this. I've talked about this with you over the last month going into the GTC conference. We track GPU availability every day, and what we're seeing is just record lows, all-time lows in GPU availability, which indicates excessive demand. And I think Rich hit the nail on the head when he was talking about the reset in PE ratios. We looked at every 9%, 10% correction we've had going back since the 1980s, and we have 63-day forward earnings growth of 8.3% at the trough of this market. You just really don't see that. So fundamentals accelerating while price is declining, and you're getting some of the things that market was worried about on the compute side, the semi side, the CapEx side, cleaned up. And so all you needed was a little bit of good news to come out of the Middle East. And so that's what the market's grabbing a hold of here. And I think it's warranted for now.
Let's show that chart of the S&P that we just were showing, because what it does show over the last year, Bryn, is a V shape. Every single time something upset this market and we thought a correction could be deeper than it was at the time, this market has showed a resiliency that continues, I think, to surprise a large number of investors, because the things that it's been upset about have been legit. You're talking about extraordinary tariffs on the better part of the world. And yes, I understand that they were dialed back. The market just jumps right when that news hits. Now you have an even more serious situation of a war in the Middle East. Things are unsettled as it relates to the Strait of Hormuz and oil prices. And here we are again. The common denominator in all of that is, even through Liberation Day or now, economic expectations never really changed. Earnings expectations never really changed. In fact, in this instance, they've only been going up.
So I think even if you go back to 2020, minus 2022, we've had what I call whipsaws, right? Where you get these violent downturns, and then within a month, you're all the way back, and you've retraced those all the way back up. And so I think investors need to understand these whipsaws in the market are becoming more and more normal. And I think that when you go back, even though we had like a blip of a recession, in the summer of COVID, the U.S. economy is so incredibly resilient, and we have a very different economy than we have in the 70s and 80s. And so I think that when we had people saying stagflation, every once in a while they keep using that word. It's just like the economy in the U.S. is a very service, more asset-light economy. Even with all the data center spending, yields, which I'll have up right there, are very anchored. The 10 years solid here. Unemployment's low. Earnings are good. And so I just think you have to take from what the market's giving you and not getting shaken out, because what ends up happening, Scott, is we learn in investing to buy low, sell high, but investors get panicked and they ended up buying high and selling low when they get panicked out of these markets, when we have these tantrums from real events, by the way, real events like what's happening in Iran.
Yeah, good reminders from you both. We'll talk to you soon. Brennan Warren, thanks so much. Now to Christina Partsenevelos, who's got a look at the biggest movers as we head into the close today. Hi there.
Hi, Scott. Well, shares of Bloom Energy are soaring after the company said it expanded a prior partnership with Oracle to build out its AI cloud computing capabilities. Under this agreement, Oracle will purchase as much as 2.8 gigawatts of power from Bloom. Bloom shares are up 140% year to date, but up 20% just today. Credo Technologies, another company soaring today after the electric cable provider said it agreed to buy chipmaker Dust Photonics for roughly $750 million in cash and stock. Credo makes the copper cables needed to connect all the servers so they can talk to each other, and it's expected to expand its optical division, and which would bring in roughly $500 million in revenue for fiscal 2027. So this is about a pivot into optical. And then last but not least, CarMax shares sinking after its latest quarterly earnings surpassed estimates but reflected declines from just a year ago. The company also paused its share repurchase program to save cash for its turnaround plan. The stock pacing for its worst day since November, down 15%, Scott.
Wow. Okay. Christina, thank you. We'll see you in a little bit. Christina Partsenevelos, just getting started here on The Bell. Coming up next, a reversal on rates. What Treasury Secretary Scott Bessent said about the Fed's next move raised a lot of eyebrows today. I'll tell you what it is, and we'll get instant reaction from former Federal Reserve Vice Chair Rich Clarida. The Bell, the stock exchange. Back after this. All right, welcome back. Some new comments today from Treasury Secretary Scott Bessent about the timing of the Fed's next move, raising a lot of eyebrows today. Our senior economics correspondent, Steve Leisman, joins us now with more to tell us exactly what he said, whether your eyebrows were among the raised.
You know, Scott, my eyebrows have pretty much been raised for quite a while now, but for most of the past 15 months, the Trump administration has done little but criticize, often harshly, the Federal Reserve interest rate policy. But over the past 2 days, Secretary Scott Bessent has relented at least a little bit. Speaking to reporters on the side of the IMF World Bank meetings today, Bessent saying, quote, "I believe that their framework had been wrong. I believe that will be proven wrong. But that if they want to wait for some clarity, I understand that." Now, that was a little less definitive than he was yesterday when he said the Fed was doing, quote, the right thing by sitting and watching. But it's still an acknowledgement by the administration and a top official at that the surge in oil prices complicates the Fed's job of just cutting rates. And it's a long way from the barrage of criticism from the president and the administration, especially the president, who has never quite missed an opportunity to lambaste the Fed for not cutting rates deeply. Bessent added that the Fed Chair Powell should let Trump's nominee Kevin Warsh lead the way on the next cycle of interest rate cuts, and that inflation, he believes, will come down. He noted that the 10-year yield, which had traded as high as 4.5% at the end of March, has come down. It's now around 4.25%, a sign of less inflation concern in markets from the oil price surge. So, Scott, a little bit of leeway here from the Treasury Secretary to the Fed, but the question is how much it matters. The Fed was doing its own thing anyway.
I mean, it matters to us, I suppose. In a way, it had Mr. Bessent sounding more like the very successful investor that he used to be, rather than a member of the cabinet, which has been pretty consistent in advocating, obviously, for lower rates. You also do today, Steve, have a bunch of Fed speak. What are we hearing there?
Well, we had who was it that spoke today? Goolsbee spoke earlier today. Goolsbee, and some of the discussions over the past several days, Scott, is, the Fed is very firmly in this wait-and-see approach, very much the way the Treasury Secretary is talking about it. And I like the way you put it, because it's very hard to look at the current situation, Scott, of oil prices surging and say, there's a clear path here for the Federal Reserve to cut rates. There may be a clear path, and it may emerge, but certainly it's not now, where the Fed has to be concerned of monetizing the oil price surge and not really giving it any fuel, Scott, and essentially let it play out. If it's a one-off thing, and Bessent has actually used the word transitory with this oil price. If it turns out to be that, well, then the Fed can get along to the idea of cutting rates, but not in the teeth of what's happening right now.
Sure. Well, I mean, I think for decades, really, the Fed has sort of tried to look at a spike, for example, in oil prices as transitory, thus not to make any critical monetary policy decision based on that, which could be fleeting, which then leads me down the road to the next presumptive Fed chair himself, which is Kevin Warsh, and we have learned a little bit more about him today too, didn't we?
Yeah, and Scott, I just want to go back real quick to what you were talking about earlier, which is that there's two definitions out there of look through, and I'll get to Kevin in just a second, but look through to some has meant look through and cut. But I think to the center of the board, and I know you got Clarida coming up, I wonder what he thinks about this, but to the center of the board, I think look through means hang tight. Don't do anything. Don't cut. Don't necessarily hike. But look through means to keep policy in place. On Kevin, we learned he's pretty much what we knew, Scott. He's enormously wealthy. His wife is enormously wealthy. He's done quite well. He has a broad array of investments, at least a minimum of $135 million in his own name. There you go. There's the Juggernaut funds, two separate funds. There's a series of investments that look tied to Stan Druckenmiller, THS, DFS, that we calculate as a minimum amount of 22, as much as potentially 75 million. Series of stock ownership in an Asian retailer, or looks like a tech retailer as well, 3 to 15. A variety of stock ownership in UPS, 2 to 10. And then a company, DCM Investments, that looks like it's a venture capital fund, providing a lot of seed capital to a lot of very interesting businesses. SpaceX is one of them, but there's also a company that does an automatic robotic arm for coffee makers.
All right. Hey, wherever you get it from. It's, at least we know now.
Well, you know, the main thing is he's very into tech. And we know that, and that's another discussion, Scott, for another day, how much his belief in the outlook for tech is a part of his outlook for policy.
Well, he's very into markets, and we know that, and he's been a trusted advisor to one of the greatest to ever do it in Stan Druckenmiller. So that is an interesting story within itself, and we'll be focused on that a lot, I think, in his tenure. Steve, thanks as always.
Yeah.
Steve Leisman, our senior economics correspondent. Now, too, Rich Clarida. He's the former Federal Reserve Vice Chair, now Global Economic Advisor for PIMCO. Welcome back. It's good to have you.
Yeah, looking forward to the conversation.
What do you make of the Bessent comments? Are we reading too much into that, or is he saying something here?
I did take note of it for the reasons that you and Steve Leisman mentioned. First of all, we haven't heard a lot about wait and see from Secretary Bessent until the last day or two. And then what I really took note of is when he said that he wanted the next Fed chair, which will be Kevin Warsh, to kick off the rate easing cycle. And I took note of that as well. Now, that's not really news in the sense we know the Secretary is in favor of lower rates, but the mention of the timing I thought was interesting.
Well, it remains to be seen whether June is going to actually happen. And I suppose a lot of that will have to do with what oil does. But I mean, you would agree, though, with Mr. Bessent, if we want to take it for what it is, for what it's worth, that the Fed is right to wait and see and just see where all this goes. There's no rush to do anything.
For a couple of reasons. One, obviously, inflation's moving in the wrong direction. Secondly, there is a lot of uncertainty about the persistence of this shock. Maybe if I can parachute in a little bit, when you talk about looking through oil shocks, a lot of oil shocks in the last 50 years have really been mean reverting. Oil moves up and then it comes down quickly. You can also have an oil shock that's more persistent, as we saw like in 2010, 11, and 12 with oil at 100. But even there, the inflation effect really only directly is within a year or so. But I do think that there is more than the usual amount of uncertainty because of the nature and the potential duration of the hostilities in the Middle East. So I think it's very sensible to wait and see at this juncture.
And I thought Steve was very astute in how he, in a way, corrected my language by saying, you know, when you use the words looking through, it can mean different things to different people, especially when you're talking about the Fed. It seems to me that he's correct when he says, essentially, don't overreact to something that truly has proven to be transitory, right?
Sure, and I think he's also, not for the first time, Steve's on top of the pulse of the committee, in the sense you have 19 folks, and they each give speeches, and they each give interviews, and you do have a group, it's not a majority, but probably 7 at least of those 19, some of whom are voters, who basically think the Fed is done. They think the policy rate is close to where they want it to be, but at least a majority of the committee as of March, after the initial oil shock, felt that a couple more rate cuts would be appropriate eventually, but obviously in no rush to do that this year.
As a former central banker, where's your temperature on private credit? Are you at 98.6, or are you a little elevated, but not yet in need of something to deal with a fever?
Look, it's a very broad asset class, and parts of it have grown rapidly, in particular, direct lending to middle market companies. And obviously, it's not been stress tested in a downturn, but there are other elements of the private credit universe, the asset-backed elements where you're lending against tangible collateral. So we think it's important to really take a granular perspective on it for sure.
You think Chair Powell feels the exact same way? How do you think they're feeling about it?
Well, I wouldn't know. I haven't talked to him about it. What I would say is the Fed is the primary regulator and supervisor of bank holding companies, and at minimum, the Fed will want to be comfortable with the direct and indirect exposure that large banks have. Based upon publicly available information, the exposure looks to be pretty modest relative to the size of their balance sheets, but of course, I'm no longer an official, so I haven't seen the detailed data. But I think that's probably the Fed's primary focus right now, is just making sure that it understands the exposure of the banking system to private credit, which, as I said, based upon the information I've seen, does not appear to be a concern right now.
Okay, I have to run, but real quick, chances of a June cut by Kevin Warsh and company are what? What do you think the percentage chances are?
I think pretty close to zero, because it's not clear that Kevin Warsh will be there by the June meeting, depending on what happens in the Senate. And I don't think we're going to know a lot about the prospects for the oil market then necessarily either. So I would say close to zero.
All right, talk to you soon. Thanks as always.
Thank you.
I appreciate the time and the conversation. Rich Clarida.
Thank you.
Still ahead, are we on the cusp of an everything rally for stocks? Our next guest weighs in as record highs are once again within reach. Bell's back after this.
Discovery's 4 computers now have primary control of critical vehicle functions.
All right, welcome back. With stocks nearing new highs, our next guest says rising earnings expectations are a high hurdle to jump over. Alexandra Wilson Elizondo is co-head and co-CIO of Multi-Asset Solutions, here with us at Post 9 from Goldman Sachs. Of course, good to have you.
Thank you for having me.
So a couple things stood out in your notes today. That in everything rally, the market's going to attempt an everything rally, but it's going to be short-lived.
Yep.
Why do you think short-lived?
I mean, like ceasefires, they stop the clock. They don't rewind the clock. We're still looking at, commodity markets that are pricing in December higher rates, and we're 30 basis points higher at the front end of the yield curve. So there's been a lot of movement that's not going to unwind. But when you take off $150 oil from the table and the possibility of outcomes, you start to get a lot of momentum. You're going to get a, technical relief rally.
Are you surprised at the resiliency of this market? I've asked a lot of people the obvious question, but I'm curious to what your answer is. Others have said no because the fundamentals of both the economy and earnings have remained robust.
I think you would have to be fundamentally changing your Fed call and your earnings forward call to think that the market was going to totally, go south. That being said, I think when you start to look at relative value, U.S. market versus others, you're starting to see rolling blackouts in Asian markets and, putting constraints on oil usage. So I think all the capital that was starting to get deployed to this, reflation rally elsewhere is starting to come back here.
Okay, that's a really good point you make. So do you think the war dynamic has changed that? Because we had heard from many strategists and portfolio managers outside the U.S. presented the best opportunity, and now maybe you feel like that's switched back.
Yeah, I think on one hand, diversification really matters for your portfolio in this type of a market and what all the different things that are happening across the world. But I really want quality growth in my portfolio, and one of the best places to do that is in the United States.
So does that also mean that what looked to be a pretty robust broadening trade before this whole thing started is also kind of over too? X your everything rally, which is going to be short-lived, we go right back to the growth trade?
In the U.S.,
yes. Yeah.
And in fact, I think, some of the most compelling parts of the market are some that have done really well, right? So I think this is don't fight the trend, don't be a contrarian. Semis still look really good. AI is still a theme. Keeping with some of the structural growth trends, which are driving the U.S. economy, these are still great places to invest.
The other conversation I've been having with people who like tech around the mega caps is the multiple compression.
Mm-hmm.
It's like you needed another thing to make these things more attractive?
Yeah. I mean, honestly, you're looking at, 5-year lows in some cases, like incredibly compelling place to put money to work. And that's the other side of this coin is there's still a lot of money to put to work. And you see that in these big relief days like we saw yesterday.
What about some of the areas that have been hated, like software? Now even they look like they're waking up a bit. Are you a fan in any way of that?
I mean, like there's going to be some winners and losers in there. I think ultimately, AI disruption is a real trend and something we have to be careful and thoughtful around, but it's going to be a slow burn. I don't think it's going to happen overnight.
Yeah. How do you see, since we talked a little bit about the Fed and your look ahead and what your idea of calendar looks like for the Fed cuts? You still think cuts this year?
We're still expecting cuts, but towards the end of the year, and we're going to have to see unemployment tick up in order to see that change in mindset from.
And it doesn't matter if we've pushed that off because, as we already said, the economy and earnings are good enough that the market, quote unquote, doesn't need it.
This is why I think it's not an everything rally sustained, because you do need cuts, for some of that real beta, deep beta names that are highly levered, floating rate debt. They need to see cuts in order to really rally from here.
Well, like small caps, like I feel like you're kind of talking about those.
Yeah, but small caps have done so well because there's so much energy in small caps.
I mean, it's like up 9%. The Russell is year to date.
Yeah.
You have to look at it like 5 times to make sure you're looking at it right.
Yeah.
It's so outsized relative to everything else.
It is, but again, there's a sector that's done incredibly well that's in small caps. That's skewing a little bit of the output there.
Appreciate you coming on.
No, thanks for having me.
Talk to you soon. All right, Alexandra Wilson Elizondo again from Goldman Sachs. Up next, we track the biggest movers into the close today. Christina Partsinevelos is back. Tell us what you see.
I am back. A major tech denial sending 1 to 2 stocks lower right now. An airline merger pitch that could create the world's largest carrier, and a pharma giant teaming up with an AI powerhouse, of course, to speed up drug discovery. We'll have those stock movers next.
We're about 10 from the bell. Back to Christina now for the stocks she's watching. Hi there.
Hi, Scott. Well, let's start with Dell shares because they're down after NVIDIA denied an unconfirmed report that it was weighing a deal for a large PC-focused company just yesterday. You had Dell shares rise about 6%, HPQ shares over 2% on that news. But the moral of the story is don't believe every headline. American Airlines and United both moving higher after United CEO Scott Kirby pitched a merger between the two airlines during a meeting with President Trump. If the merger actually happens, it would create the world's largest airline. American pacing for its best day since August on just that development. Scott.
All right, Christina, thank you. Coming up next, Robinhood, the best performing stock in the S&P 500 today. We'll tell you what's driving it next in the Market Zone. We're now on the closing bell Market Zone. Mike Santoli and Miller Value Partners Bill Miller are here to break down these crucial moments of the trading day. Plus, Rick Santelli standing by live from CBOE Global Markets in Chicago. Mackenzie Segal tracking the big bounce today in Robinhood. Michael, I'll begin with you. Your thoughts?
Yeah, I mean, obviously this market is kind of penalizing anybody who wanted to wait and see for a little more clarity on exactly the outlook on geopolitics. It's obviously been a broad rally in the sense that most stocks are up, but it's also been really driven by some of the old favorites. And essentially, I think it's investors marking to market the intensity of AI spend compared to the last time they were focused on this and these stocks are down so much. When you see CoreWeave up 50% in 2 weeks, right? SanDisk, we've all talked about what that's been doing. So it's a little bit grabby on that end. I'm not sure the market is making much of a macro call here in terms of whether there's going to be, we're going to escape any real friction in the real economy. But for now, it has been tough to fight. I do think it's running a little hot in the short term, probably need some time to take a break, but it's definitely affirming the way the market is going to essentially look through the near-term nuance and just figure that the peak uncertainty is already passed.
Yeah, what do you make of the bounce in software over the last couple of days? Are you a believer yet?
I don't know about whether I believe it in terms of it being like, some long-lasting recovery that we're in for here, but I think it's all part of, again, the market penalizing people who are leaning against the beaten up areas. And arguably, things like Microsoft leading, it's been a huge upside contributor, Salesforce coming to life, Oracle felt like maybe it got a little bit too bruised. All those things together make some sense only in the context, I think, of people going to where the earnings story hasn't changed very much and the prices have come down a lot. That's the stage. That's enough for now. I'm not sure that you have enough to kind of completely overcome all of the disruption fears that we've been dealing with for months.
Quick look ahead to 4 o'clock.
Yeah, all of this, of course, but also emerging markets and whether the story there has changed as to whether the rest of the world can outperform and whether the oil shock is going to hit harder out there.
All right, see you in about 5 minutes. Good stuff. Thank you very much for that. To Rick Santelli at the SIBO. What do you see there, Rick?
Well, it's all about risk-reward. You heard Mike. If you wait till geopolitics puts up the white flag and says everything's great, all the moves are over. To that end, I continue to be optimistic, and I think energy prices are going to continue to go down. So let's look at Devon Energy, exploration, production. Let's look at their puts, because if we continue to go down in price on oil, I would think maybe their stock would go down as well. So we're going to look at the 44 puts. They're trading a little over 45.30 right now on the stock, and the expiration will be the 24th of April, Scott. The cost will be 50 cents. Of course, 100 shares, so it's really $50. Your break even will be $43.50, and I think it's actually a really good trade, especially considering you have a little time, the 24th, and just always remember, follow the dollar. If the dollar keeps going down, you want to definitely look for the energy to be going the same direction as the dollar. Back to you.
I love these options looks from you, Rick. Thank you. Rick Santelli for us at the SIBO. We said Robinhood is the best stock in the S&P today. Let's find out why. Mac.
Scott, yes, it is. Robinhood shares jumping more than 10% going into the close after Bernstein reiterated its outperform rating with a $130 price target, implying more than 65% upside from here. Now, the bull case really comes down to two of Hood's core businesses. First, prediction markets. Bernstein expects that segment to nearly quadruple this year, making it the single largest revenue driver for 2026. Analysts point to the FIFA World Cup this summer and midterm elections in the back half of the year as volume catalysts. And then there's crypto, where Bernstein is notably more bullish than the street, forecasting over $1 billion in revenue this year, 31% above consensus, on the view that a rebound in Bitcoin will bring back retail trading activity starting in Q3. And Bernstein's broader thesis, Robinhood still only captures 4% of the total U.S. retail brokerage revenue pool, leaving plenty of room to grow. Scott?
All right, Mac, thank you. Mackenzie Segalis. All right, Bill, what do you think of this market?
Look, we're bullish, and there's various ways you can play it, Scott, but we're most bullish on the small and mid-cap value space, which, if you look at the market texture today, it's very reminiscent of what happened actually in 2022, which in 2022, if you recall, Russia invaded Ukraine, price of oil went to the moon. This year, where there's a conflict with Iran, price of oil is going to the moon. What I think is really interesting is earlier, someone mentioned they thought that if oil is going down, energy equities would continue to go down. I actually take the other side of that, which is if you look at what happened in 2022, oil price was going down consistently from June to the end of the year, and the energy space outperformed the S&P through the end of that year. So, if you look at the energy space as a whole, it's underperformed for so long. There's been so much underinvestment there. Expectations are so washed out that there's a lot of names in that space that are trading at massive discounts to what we think they're worth.
And you don't think that area of the market specifically, let's say small cap value, is highly dependent on rate cuts, which are highly uncertain as we have this conversation?
Well, I think small cap value is going to actually be potentially more dependent in this decade on the real cost of capital. If you look at what happened between 2010 and 2020, money really generated, or capital generated no returns. The 10-year yield then was roughly 2.4% on average versus inflation averaging 1.8%. That gives you very little difference between the two at 60 bips roughly of real return potential. Today, you got a much different dynamic where the 10-year yield is roughly 4.2, inflation's about 3, so you have 2.5 to 3 times that real rate of return. Securities that kick off real cash flows today are going to be much more valuable, and investors are going to value them that way, we think, moving forward. So that would benefit small cap value.
Sorry to step on your toes there. My apologies. I'm looking at Bitcoin, 74,655. It's up about 5%, just shy of that over the last month. To what is it trading on these days in your mind, considering we have this war going on? And we're trying to figure out, where commodity markets are going from here, where the dollar's going to go. What is it moving on now?
Well, day to day, it's going to be very hard to say just because it's a leveraged asset. There's leveraged liquidations that occur from time to time, leveraged forced buying that occurs from time to time. But I think fundamentally, this is one of the best setups I've ever seen, just because what you saw recently saw a 50% pullback. That's the 5th largest pullback in Bitcoin history. Drawdowns are getting shallower over time. And we also have some real fundamental benefits here, which is deficits are through the roof.
Talk again soon. Into overtime.
The bell's ringing into the trading day at the NYSE INQ, ringing the bell, and at the NASDAQ, Veer Biotechnology doing the honors. Welcome to Closing Bell Overtime. We're live from Studio B at the NASDAQ market site. I'm Melissa Lee along with Mike Santoli. And we had another big day for stocks today. The Dow with a gain of 300 points, the S&P 500 higher by 1%, the NASDAQ up nearly 2%.
The S&P 500 is now just about 10 points from the late January record close and less than 1% from its intraday all-time high above 7,000. Our markets team is at the ready. Christina Partsinevelos on the big moves in tech, Rick Santelli on bonds, Pippa Stevens on the drop in oil, and Steve Leisman on the efforts to get Kevin Warsh on the Fed. A lot going on, obviously, and the market is just kind of just grabbed taking the bit in its mouth and run at this point. And I think it was always the case that the market was going to just look for that window when it felt as if we were in a denouement phase of the conflict.
Right.
It's all very contingent. We know it could go either way. But at this point, just kind of grabbing for the old themes in semis and AI is the rule.
Yeah, I mean, Meta, Google, Amazon, Apple, all of those names were higher. So the old playbook is back in play. And it's really a terrible setup going into earnings season for us to levitate to these heights just before we report. We get all the cautious commentary, which many people expect will come.
It is true. It was looking like we might have a really undemanding setup before this 10% rally off the lows, by the way, from the intraday lows on March 30th. The S&P 500 is up that much. It's also interesting, if you look at what's not almost back to the highs. Industrials are more than 3% below the highs. Equal weights consumer cyclicals have only regained about half of what they lost, during the post-Iran conflict losses. So it shows you that the market isn't really saying everything's fine. The market is saying we can have some kind of conviction in a few themes, and also people were underpositioned in a lot of those fast-moving stocks, and they're getting punished for it, I guess. Well, the NASDAQ stretching its winning streak to 10 days, up 13% over that span. Christina Partsinevelos watching today's big winners for us. Hey, Christina.
Well, markets keep climbing as investors really turn their focus from headlines to earnings, hoping they'll provide some stability and maybe even push stocks to new highs before May. The rebound is really just reinforcing the idea that you don't need to overtrade geopolitics to stay in the game. Momentum's alive, or as you both said, the old playbook in the chip space again. Micron and Western Digital closing higher. Nvidia now up 10 days straight. Credo soaring after saying it would buy chipmaker Dust Photonics to strengthen its position in AI connectivity. Normally, when you see a rally in chips or semiconductors, it comes at software's expense, but not necessarily this week. Oracle's higher again, and confidence is building in newer cloud plays like CoreWeave as well as Nebius, as just these AI deals keep stacking up. The risk-on mood even stretches to crypto and quantum technology. Robinhood and Coinbase advance higher. They're seen as proxies, crypto miner, and also data center provider IREN up nearly 10%. And then quantum names like D-Wave and IonQ up about double digits today, fittingly on World Quantum Day. Yes, April 14th. On the earnings front, JP Morgan trimmed its 2026 net interest income outlook, I should say. Wells Fargo saw pressure from fees and expenses, but Citi stood out with stronger growth across lending, fees, and trading. Tomorrow, Bank of America and Morgan Stanley are out. Guys?
Christina, thanks. Christina Portnevelis. Today's rally coming as oil falls, and energy is by far the worst performing sector. Pippa Stevens has more on this. Pippa.
Hey, Melissa, oil prices tumbling as the White House considers additional talks with Iran. Meantime, the IEA releasing its monthly report today saying that demand destruction has already kicked in as product prices top $200 per barrel in some countries in Southeast Asia. The agency now forecasting an annual demand contraction for the first time since COVID, after previously forecasting demand growth. Dated Brent, which is for the most readily available oil, trading around $125 per barrel today. That's according to S&P Global Energy. That is down from a record high of $144 last Tuesday, but still a $30 premium to Brent's front-month contract at around $95. Now, one trader telling me we've now hit trigger levels below the low settles of last week and that a pattern is emerging where Monday and Tuesday are risk-off, but heading to the weekend, it shifts to more risk-on. SocGen adding that open interest is now building in Brent's July contract with call open interest increasing most notably at the $110 strike, which could indicate some now preparing for a longer conflict. Mike?
Yeah, all right, some bets at least that it's not quite over. Pippa, thank you very much. Well, the drop in oil prices and this morning's PPI report helping to send bond yields lower. Rick Santelli joining us from the CBOE. Talk more about that.
Yeah, Mike, I'll tell you, it's a weird setup because the month-over-month data was cool in PPI. The year-over-year data was hot. But let's go over what cool represents. It's representing against expectations. So the headline number was up 0.5%, up 0.5. But yet we're expecting up 1.1. Up 0.5% is not normally considered a cool PPI. But when you're looking for twice as much, it is. The year over year, they were definitely on the hot side. All the metrics, except for ex-food and energy year over year, were higher than last month. That one equaled 3.8, double. That's the same thing it was last month. Look at a 12-hour chart of 2s and 10s. Not long after that 8:30 Eastern data came out, the market started moving down. Why? Oil prices, when every expert says we're going to 150 in regular crude futures, going to 175, well, we're not. We're going down. And boy, the dollar paid attention and interest rates did. Look at a year-to-date chart. We closed 10s at 417. Look at all the inflation data we've had, hot PCE data. And where are we now? What? We're less than 10 basis points higher on the entire year. And if you look at the dollar index, should it close where it's trading right now, it'd be the lowest close since the day before the war started on the 27th of February. So a very big day to pay attention to, Mike. Melissa Lee, back to you.
Rick Santelli, thank you. Let's turn now to the big market driver, technology, as the Nasdaq leads once again and is now up 7% in a week. The gains are broad-based with software, semis, and big caps all seeing gains. The XLK, including Nvidia and AMD, stretching their winning streak to 10 straight days. The IGV closing higher after posting its best day in nearly a year yesterday, and the semis ETF, the SMH, hitting an all-time high today. Joining us now on these big moves is T. Rowe Price Science and Tech Fund Portfolio Manager Tony Wong. Tony, great to see you.
Thanks for having me here. Yeah.
We're just touting some of the gains made in IGV just very, very recently, but we're still back, towards lows that we saw back at the end of February or so. And I'm wondering what you make of this sort of the theme of AI destruction in the space? Because just this afternoon, we get a headline from The Information saying that Claude is going to release another model, a web design model. We see Adobe, we see Figma trade lower. Again, on the same news, basically, that they're going to be disrupted by AI. It happens again and again. And this group just can't, catch a break on that front.
Yeah, so I think that what's going on is that software is being refactored for agents and not for humans. And so I think that's a big change in the industry, and it changes the unit economics when you think about the amount of deflation that can come to the space. In addition, I think the large language models, they're progressing at an exponential pace. And so the models are getting better, the agents are going to get better. And I think that just creates a really competitive dynamic for the legacy software companies to keep up.
Have you been adding to software positions during this rout, Tony, or are things just too uncertain still and you'd rather stick to some of the larger names in the AI trade?
Yeah, so I think, longer term, I still like the AI infrastructure names, especially within semis. And so, the way I think about it is that all these agents are going to need a lot of compute, and a lot of times better memory, better networking is going to be the bottleneck here. And as a result, I think that, you can see a multi-year build out, in those names.
And so, Tony, that being the case, and of course, the market is really seized on that, right? It's going after the parts of the food chain where there's scarcity and there's pricing power. We talked about, SanDisk and other storage and memory stocks and things like that. Are we going to be okay with a lot of the hyperscalers still sacrificing all the free cash flow for multiple years? Or is this kind of a one-year lull and then they can start to earn it back?
Yeah, well, I think that, the market will be looking for top line growth here. And so I think the last few years have been funded by the existing free cash flow. And going forward, they need to produce more free cash flow, better top line growth for them to continue spending at these levels. And so I think the ROI is going to be the thing that this earnings season is going to be really important. But I think if you look at what's going on, enterprise adoption for AI and Anthropic especially is really inflecting. And so I think this is like the time period, the time that we've been waiting for in the market to show ROI beyond just the consumer apps. And so I think that's as long as they can grow top line growth, they can continue spending CapEx and build out intelligence.
I want to ask you about Intel. It's broken its streak, Tony, today. A lot of good news being pointed to as the reason behind this torrid streak that it's been on. Are you an Intel fan? I mean, do you now believe that, for instance, being part of the Terafab validates or confirms that 18A is a commercially viable technology? I mean, all these sort of positive conclusions being drawn from a Google partnership and its involvement in Terafab.
Yeah, well, no doubt. The last year, the terminal value of Intel has expanded tremendously. I think the announcement that you talked about, the partnerships, and then also I think when you think about agentic, it requires a lot of CPUs actually, because these agents are opening up browsers, doing things. And so previously it was now limited by a number of humans, but now agents create this new TAM, and you're seeing that there's a CPU shortage right now, and there's, more need for capacity, and Intel has built out its capacity over the last few years as others were probably, not as aggressive. So I think that they are in a good place. Obviously, a lot from here to the next 5 years, but I think they are in a special position in terms of where their fabs are located and technology that they have.
Tony Wong, thanks very much. Appreciate it.
Thanks.
All right, let's turn to the overall markets with the S&P now back above its pre-war level and less than 1% from its all-time high as investors turn their attention to corporate earnings. So is the worst behind the markets despite the Iran war and global energy concerns? Our next guest says he sees the market continuing to broaden out in 2026, but the puck is shifting. With us now is Brent Schutte. He is Northwestern Mutual Wealth Management CIO. Brent, good to have you on. So from I guess on the spectrum of the market has it perfectly right, and this is a justified risk-on rally to, it's assuming too much and going too far. Where do you sit?
I think more towards the latter. I don't think we're done with the conflict yet, and I think there are plenty of concerns still out there. That being said, as you open up with, I do think there are plenty of long-term opportunities for investors to lean into, largely outside of those areas that you spent the prior 10 minutes talking about, which the broadening was occurring prior to the conflict, and now you're seeing investors run back to their favorites, which I think going forward, especially for an intermediate to long-term investor, the opportunities are in things that haven't done as well the past few years in this narrow market that we've had.
Yeah, I was going to say that, we've re-narrowed. As of this morning, I think on a 1 month basis, only less than 30% of the S&P 500 stocks were outperforming the index itself. Before the war, we were running at around 60%. Now, I guess that was somewhat based on this idea that we're going to run the economy hot and get Fed rate cuts, and Treasury yields are going to stay tame. So have any of those inputs changed in the last month or 6 weeks?
I think that's the risk, and that's why I opened up by saying that I think there are still some risks that are out there. Look, this economy is doing okay this quarter, but that's because of the large fiscal impulse that we had coming into the quarter, where you had fourth quarter government spending that was deferred because of the government shutdown, moving to the first quarter, plus the tax refunds that are a one-time event that are out there. That was expected to add 2.1% to overall economic growth in Q1. And as of last week, the Atlanta Fed GDP now is running at 1.3%. The Fed also cut rates last year, which pushed the 10-year Treasury, as Rick opened, up down to, I believe, 394 earlier. It's back up, but it's coming back down. That's where I think there could be a bump in the road here. We'll see where we go with the conflict. But I do think if you pull back and focus on the things that you can control, which I don't know what's going to happen in Iran, and I don't know that any other guests are, this is where I think there are still opportunities in those areas for the market to broaden as AI adoption becomes much more prevalent in companies. And so we move from the conversation of hyperscalers and people are bringing it to life to society, which is going to use it to make their employees more efficient and their companies more profitable.
What are the sectors, what are the companies, Brent, that you think will benefit the most from AI, aside from the companies that build out AI? And is that a major factor in your investment thesis in any sort of non-tech companies at this point?
It certainly is. And that's where, if you look back to 1999, a period of time which I think rhymes a lot with this, where you had obviously internet spending keeping the economy going after the Fed had raised rates and cut rates and then re-raised rates. You had an incredibly bifurcated economy there that was driven by internet spending. Much like the past year and a half, we've had a bifurcated economy that's been driven by AI spending. Back then, a narrow group of companies, as Mike mentioned in his opening, talking about 30% outperforming. That's where we've been the last few years, and that's where we were back in the 1998-99 period. It then broadened back out to the broader U.S. economy as a whole and the companies that used it. And that's where I think you'll see broader participation, broader leadership in the stock market. And I think you'll see small and mid-cap companies, which trade at historically lower levels of valuation. I think they will do better in the coming years as those benefits become more readily available to them.
Okay, Brent, we just want to put a pause in the conversation. We're going to go to Chicago here and show you the closing bell at the CBOE in Chicago. FactSet is doing the honors today. And with the bell, that ends the regular trading day for options. Brent, back to the small mid-cap sort of theme. Are there sectors in particular that you're looking at?
I think when you buy small cap, you're buying more economically sensitive sectors and segments versus the tech sector, which has kind of held the economy and the markets up the past few years. And so I would suggest more along those lines. I tend to focus more on broader markets rather than the narrower aspects. But generally, when you buy small and mid-cap stocks, you are definitely buying more economically sensitive. And that's why they've been harmed the past few years and not done as well, because the broader economy hasn't done as well. It's been carried by a narrow sliver of companies tied to AI or tied to the higher consumer.
And Brent, a quick word on bonds, whether you see value there, whether it's investment grade yields or even on the riskier end?
In the here and now, I see value in bonds. I think certainly there is a gap, a real earning, or a real yield that you're actually earning. I think longer term, the answer still is more inflation in this economy, and so that may twist in the future. But for right now, given the economic questions that are still out there, I think bonds offer value, but I would suggest in the future we may be looking back towards more inflation protection as we progress throughout the year, and perhaps this conflict does go in the rearview mirror. And as you mentioned before, we run the economy a bit harder with the new central bank president.
Brent, great to speak with you. Thanks, Brent Schutte.
Thank you.
The administration moving ahead with the nomination of Kevin Warsh to Fed chair. Not only did Warsh disclose how much money he has, which is a lot, but there was also an interesting comment from the Treasury Secretary. We'll dive into all of it. You're watching Closing Bell Overtime live from the NASDAQ market site.